Hello students, I hope you enjoyed part 1 of revision marathon of CA final direct taxation. Now I welcome you all for part 2 of revision marathon of CA final direct taxation applicable for September 25 and January 26 attempt. This is part 2. In part 2, I covered complicated chapters which students feel as tough. Entire marathon will be in 100% English. I have revised assessment procedures. Easily you will get 6 to 8 marks from assessment procedures. Appeals and revisions. Easily you will get 4 to 8 marks from appeals and revisions. DTAA. You will get from 6 to 10 marks from DTAA. Taxation of business trust, investment fund and securitization trust. You will get 6 to 8 marks from this chapter. TDS and TCS. Easily you are going to get like 6 to 8 marks from TDS and TCS chapter also, especially non-resident taxation. So whatever the TDS that is required to be deducted for non-residents, that is being specifically tested in the examination. So overall you can easily expect 35 to 40 marks again from this revision of part 2. Another important thing, the duration will be around 9 hours to 9.5 hours. As this lecture is in 100% English, please share with all your friends who wanted to listen CA final direct taxation in 100% English. Okay, thank you very much. Let's begin the journey. Okay, now I will start with balance assessment. I will discuss with you 142.1. Then I will discuss with you 142.2a special audit. Then I will discuss section 141 intimation. Then I will discuss with you various assessments 143.3, 144 best judgment assessment, 147 we will discuss income escaping assessment. Then we will discuss block assessment, which is recent amendment made in Finance Act number 2 of 2020. So these are the concepts that I will discuss with you with regard to assessment. So I will quickly start section 142.1. There are two subsections, 142.1 clause 1 and 142.1 clause 2. See, as per 142.1 clause 1, they will ask you to file return of income. As per 142.1 clause 2, they will ask you to submit information, and generally 142.1 clause 1 will be given on standalone basis, but 142.1 clause 2 will be given along with assessment note, along with assessment notice under section 143 2 or section 148 or best judgment assessment. See, department, if you do not file ITR, then department will issue notice to you under section 142.1 clause 1. It will ask you to file income tax return. Yesterday we discussed the due dates for filing ITR. Maximum I can file ITR up to 31st December of assessment year. After 31st December of assessment year, I cannot file ITR. I can file ITRU. That ITRU also I did not file. Then what department will do? Department will issue notice to me section 142.1 clause 1 and department will ask me to file ITR. Able to understand? So department, what it will ask through 142.1 clause 1, it will ask you to file ITR. 142.1 clause 2 and 142.1 clause 1 can be issued standalone basis. That means it can be issued independently. But 142.1 clause 2, it is not issued independently. Department wants to do assessment, regular assessment, 143 2, or department wants to do best judgment assessment or income escaping assessment. In those cases, along with assessment notice, department will also ask you to submit certain information. Then it will issue along with notice under 143.2, it will ask information under 142.1 clause 2. It will ask you information and accounts. We will discuss about 142.1 clause 1. Sir, there are around 140 crore population in India. out of 140 crore, maximum 8 crores ITR will be filed. 8 crore people will file ITR. Balance 132 crore people, they will not file ITR. Na? For every person, whether notice will be issued under 142 1 clause 1 to file ITR? No. Department is very intelligent. Department is having risk assessment procedure. Department gets information from various sources. Now, what department will do based on that source? Let's say in 24-25, I purchased 40 lakhs worth of car, but I did not file my income tax return. Now, income tax software will trigger. This guy purchased 40 lakhs worth of car, but he did not file ITR. Then department will issue notice. So department gets various information from various sources. Department will cross check whether you have filed ITR or not. If you do not file ITR, then department will issue notice to you under 142(1) clause 1 and it will ask you to file ITR. Are you able to understand? 142(1) clause 2. Department along with notice for assessment, it will also ask information under 142(1) clause 2. Sir, what is the information it can ask? It can ask for books of accounts. If department asks books of accounts, you need to submit books of accounts. Sir, for how many years books of accounts can be asked by department? Sir, for 2005-6, department can ask books of accounts as per 142(1) clause 2? No. The year for which they are doing the assessment. Apart from that year, for last 3 years, books of accounts can be asked. What do you mean by this? Let's say assessment notice was given for previous year 22-23. So apart from 22-23, last 3 years, previous year 21-22, previous year 20-21, previous year 19-20. For these 3 years, department can ask books of accounts. Previous year 18-19, can it ask books of accounts of previous year 18-19? No. Are you able to understand? So as per 142(1) clause 2, department can ask maximum 3 years books of accounts preceding the previous year for which assessment is being done. Here assessment is done for 23-24. Apart from 23-24, last 3 years books of accounts can also be asked by department by issuing notice under 142(1) clause 2. Are you able to understand? Sir, like I am professional. I am in a chartered accountant in practice. I filed my income tax return. I will purchase my personal assets. Na, I purchase costly watches. I purchase costly cars. I purchase jewelry. So all these personal assets will I disclose in my professional balance sheet? I will not disclose in my professional balance sheet. But can department ask? Can department have power to ask personal assets and liabilities? Yes. Department can also ask your personal assets and liabilities information, but prior approval of joint commissioner is required. Only with prior approval of joint commissioner, personal assets of SSC can also be asked by income tax. Able to understand? Yes, Niranjan, hi. Sir, what if I do not comply with notice under 142(1)? Department asked me to file ITR. I ignored. I did not give reply to that notice. I did not file my income tax return. Department asked me to submit my personal assets and liabilities. I did not submit. Department asked me to submit assets and liabilities of my parents. I did not submit those information. Then, if I do not furnish the information that is required to be furnished under 142(1), then department have power to do best judgment assessment on me. Are you able to understand? Sir, what do you mean by best judgment assessment? I will discuss little later. But the thing is, whenever I do not furnish the information that is required as per 142(1), department have power to do best judgment assessment on me. In addition to that, they will also levy penalty on me. Penalty is 10,000 rupees under section 272. Are you able to understand? So this is the consequence. Okay, till here, are you clear? Next, I will discuss with you 142 2A special audit. See, whom we can call as assessing officer. We can call income tax officer as assessing officer. We can also call assistant commissioner of income tax or deputy commissioner of income tax as assessing officer. We can also call additional commissioner of income tax or joint commissioner of income tax as assessing officer. Am I correct? Now, assessing officer is doing assessment of Niranjan. So he is doing assessment of Niranjan. When assessing officer is doing assessment of Niranjan, like uh, during the assessment, they are verifying books of account. Whatever the books of accounts are there, books of accounts are very complex, or whatever the books of accounts are there, in those books of accounts, multiple entries are there, duplicate entries are there, huge volume of entries, 5 lakh entries are there in that tally, or in that SAP 5 lakh entries are there, or whatever the business that is done by Niranjan, that is very complex. Okay, what Niranjan will do? Niranjan will buy cryptocurrencies. He will buy 1,000 cryptocurrencies and he will sell all those. Like he deals in buying and selling of 1,000 cryptocurrencies. See, hardly we know 10 to 15 cryptocurrencies. How do we know remaining cryptocurrencies? How can we know the value of that cryptocurrency is that particular amount of rupees? We do not know. So whatever the nature of business that Niranjan is there, the nature of business is very, complex. So in this case, what assessing officer will do? Assessing officer will give show cause notice for special audit. Are you able to understand? So in this case, assessing officer will give direction to Niranjan that his books of accounts are required to get special audit. He will give show cause notice why his books of accounts are not required to get special. Then Niranjan, like Niranjan will be given opportunity of being heard after listening to Niranjan. Like if reason is sufficient, well and good. If reason is not sufficient, then assessing officer will give direction to Niranjan that his books of accounts are required to get special audit. You know, right? Audit under section 44AB. Generally, if turnover is more than 1 crore in case of business, in profession, if gross receipts are more than 50 lakhs, they are required to get their books of accounts audited under section 44AB. Whatever the books of accounts of Niranjan are there, they are already audited under section 44AB. Sir, already tax audit was done under 44AB. Again, whether special audit is required to be done? Yes. If department wants, again your books of accounts will be specially audited under section 142 2A. Are you able to understand? So, sir, who will do special audit? Special audit will be done by chartered accountant. Okay. Department also have our assessing officer can also issue directions for inventory valuation. For the purpose of inventory valuation, who will do inventory valuation? Inventory valuation will be done by cost accounting in practice. Are you able to understand? So whenever assessing officer finds books of accounts are very complex, multiple entries are there, duplicate entries are there, huge volume of entries are there, nature of business is complex, then assessing officer will give direction to SSC that is books of accounts are required to get special audit done under section 42 2A. Opportunity of being heard will be given to the SSC. Thereby, directions are given for special audit. Who will conduct special audit? Chartered accountant. Inventory valuation will be conducted by cost accountant. Sir, who will pay fees to chartered accountant and cost accountant? Fees to chartered accountant and cost accountant will be paid by central government. Modi will pay fees of chartered accountant and cost accountant. Now, sir, like whether assessing officer give entire books of accounts for special audit? it is up to the decision of the assessing officer. If assessing officer wants entire books of accounts are required for special audit, he can issue directions for entire books of accounts for special audit. If assessing officer wants only receivables for special audit, then he can issue direction only receivables are required for special audit. If assessing officer wants only P&L account is required for special audit, then he can issue directions for only P&L account. If assessing officer wants special audit for June to November, only for that period he can issue directions for special audit. So it is up to the assessing officer as to what aspects that are required to be required to get special audit. For those aspects, he will issue directions for audit. Are you able to understand? Timelines. Generally, time limit for completion of special audit, whatever 30 days, 40 days, 50 days, that will be determined by assessing officer. Who will determine the time limit? Time limit will be determined by assessing officer. Sir, maximum how much time limit will be? Maximum how much time limit is allowed? Maximum time limit allowed is 180 days. Are you able to understand? Now, so maximum time limit allowed is 180 days. For example, assessing officer gave time limit of 80 days. Now, can this be extended? Yes, it can be extended. Sir, who will make application for extension? Either SSC can request for extension of time limit, or chartered accountant can request for extension of time limit, or assessing officer himself will extend the time limit. Are you able to understand? But original time limit plus extended time limit maximum together cannot be more than 180 days. Next, who will appoint chartered accountant? Chartered accountant and cost accountant will be appointed by Commissioner of Income Tax or Principal Commissioner of Income Tax, Chief Commissioner of Income Tax, Principal Chief Commissioner of. Hi Monish, welcome. See, special audit is required to be done. For special audit, if chartered accountant is appointed by SSC, then SSC will influence the chartered accountant. That's why chartered accountant will not be appointed by SSC. Chartered accountant will be appointed by like commissioner bosses or top level bosses. Are you able to understand? Sir, special audit was completed. After completion of special audit, audit report will be given. Audit report will be given to both SSC as well as assessing officer. Generally, as per law, audit report will be given to SSC and SSC will give the audit report to assessing officer. But in practice, chartered accountant will give audit report both to SSC as well as assessing officer. Otherwise, like SSC can manipulate the audit report. That's why he will give audit report both to SSC as well as. Now, sir, whatever the audit report given by chartered accountant is there, whether that audit report will it be considered in assessment order? Will it be considered in assessment order passed by AO? That is up to the decision of assessing officer. Like assessing officer will read the audit report given by chartered accountant under special audit. After going through the audit report, whatever the observations in audit report are there, those observations can be considered by assessing officer in his assessment order. But if those observations are prejudicial to the SSC, opportunity of being heard will be given to the. So this is the concept of special audit. Very, very simple. During the course of assessment procedures, assessing officer is feeling tough to do the assessment. Then he will issue directions for special audit. Before that, opportunity of being heard will be given to assessment. Then, like who will appoint chartered accountant? Commissioner, bosses, top bosses. For inventory valuation, he will refer the case to cost account. Are you able to understand? So special audit will be done maximum in 180 days, original time limit plus extended time limit. Fees of chartered accountant will also be paid by central government. Even though your books of accounts are already audited under 44AB, still you are required to get special audit if recommended by, if directions are given by assessing officer. Once like special audit report is given, it will be given to assessing officer as well as SSC. Assessing officer, if he wants, he can consider statutory audit, sorry, he can consider special audit report in his assessment order, but if it is prejudicial to SSC, opportunity of being heard will be otherwise like so it is up to the decision of the assessing officer whether to consider observations of chartered accountant or not. Here one thing is there, minimum fees that is required to be paid to chartered accountant is 3,750 per hour and maximum up to 7,500 per hour. So this is the concept relating to audit. Now shall I proceed further? Next concept is section 142A, reference to valuation. Now I will ask you one question. We have studied so many provisions under Income Tax Act. Now tell me the cases where you will come across fair market value. For example, gift concept is there. If you receive gift in the form of movable property, you will consider fair market value of gift received. If it is more than 50,000, then it is taxable under income from other sources. So fair market valuation is required to be calculated when you receive movable asset for without consideration or for inadequate consideration. Tell me the cases where we are required to calculate fair market value. There are many sections under which we need to calculate fair market. Property transfer. Yeah, section 50C. In case of section 50C, there is one provision. Like if SSC feels that stamp duty value is more than actual consideration, like fair market value, like stamp duty value is more than fair market value, then SSC will have two options. First option, he can file case in court or appellate authority, or he can request income tax officer to refer the case to valuation officer for the purpose of recomputation. Next, any other section in which you need to calculate fair market value? So many sections are there, you forgot. Yes, exit tax. We have discussed in trust taxation. Exit tax, like when you are considering movable assets, you need to calculate fair market value. For quoted shares, you need to consider fair market value. Gift taxation. Okay, that's it. So many sections are there. Black Money Act. Okay. Next, when you are purchasing a capital asset, like generally when you purchase capital asset, you will pay in cash. But whenever you sell any capital asset in exchange of another capital asset, then also you are required to calculate fair market value. Similarly, 1st April 2001, if you purchase any capital asset before 1st April 2000, you need to consider actual cost or fair market value, whichever is high. Yes, in case of closely held companies for issuing premium. Closely held companies for issuing for premium, I did not understand. Can you quote the section? Yes, capital gains cost of acquisition. So, okay, slum sale, very good. I appreciate you, Ranjan. Yeah, in case of slum sale, full value of consideration is equal to lump sum consideration or fair market value of capital assets transferred, whichever is here. Section 50 CA, transfer of unlisted shares. If actual consideration is less than fair market value, then fair market value will be taken as full value of consideration. Oh, Varun, you are, I think you are specifying about 56 subsection to clause 7. In case of closely held companies, that provision was deleted in Finance Act number 2 of 2024. That provision is no more there. Okay. 56 subsection 2 clause 7, that is removed from other source. Okay, let's come into the concept. So there are various sections where you need to calculate fair market value. I got gift from my friend jewelry. I got 10 grams of gold. Let's say each gram of gold is 6,000 rupees. Total 10 grams into 6,000 rupees, 60,000 rupees. Normally, fair market valuation will be done by registered valuer, or if there is any receipt or tax invoice acknowledgement, that will be considered. So I considered fair market value as 60,000 rupees. Income tax officer doing my assessment, he is feeling fishy. He is feeling that fair market value is 90,000 rupees. In that case, during the course of any assessment, if assessing officer is fictitious or suspicious that whatever the fair market value that is calculated is there, that is not correct. In that case, assessing officer will refer case to valuation officer. Okay. So once the case is referred to valuation officer will do the valuation of that asset, and that valuation report will be submitted to assessing officer. Sir, within how much period? Okay, let's say a case was referred in current previous year. Are you able to understand? For example, what is today's date? Today's date is 28th July 2025. So end of month you need to consider. End of month is 31st July 2025. Starting from 31st July 2025, within next 6 months. That means within 6 months from end of month in which reference was given to valuation officer will do the valuation and give the valuation report to assessing officer. So 31st July, from 31st July, 6 months means 31st August, September, October, November, December, January. So on or before 31st January 2026, valuation officer will give the valuation report. Sir, valuation report was received. Is it mandatory that valuation report should be considered by assessing officer in his assessment? It is optional. It is up to the decision of the assessing officer. If assessing officer wants, he will consider the valuation report of valuation report in his assessment. Otherwise, he will ignore the valuation report. So, like, it is not mandatory. Whatever the valuation report that is given is there, it is not binding on assessing officer. If assessing officer wants to consider, he will consider. Otherwise, he will not. Section 132, in case of search and seizure, where fair market value of immovable property is valued. Yes, yes, Monish, that is also correct. So, did you understand this concept? Reference to valuation officer, section 142A. You need to remember only one thing. Valuation officer is required to give the valuation report within 6 months from end of the month in which reference was made. That's the only point you need to remember. Next. Section 143.1. I'm sorry. Initially, I told one mistake. It is not 141. It is 143.1. Intimation. Not getting AC today. Yes, 143.1 intimation. 6 months for valuation report, not 6 months. 6 months from end of the month in which application is made. Important. You should not calculate 6 months from date of reference, but from end of the month in which 143.1 intimation. See, normally when you file income tax return, like you are CA final students, you are no more CA inter students, you have practical experience of filing income tax returns. When you file ITR, automatically income tax return filed will be processed and intimation will be received via mail. I hope you know about 143.1 intimation. Okay, like in our offices, many clients will come. Okay, they will come, they will tell, sir, notice has come, please see, we need to pay any taxes, like that. Okay, we will see and we will ignore it because it is just a intimation. Like clients do not know, right, whether it is notice or intimation. So like they will panic, but we are very happy because we know it's just an intimation. So for every return that is filed, it will be processed by Central Processing Center Bangalore, and like it will process the return and it will send the intimation to us. Sir, what software will consider during the course of processing the income tax return? Basically, 5 types of errors will be rectified by software when it is processing income tax return. After rectifying these 5 types of errors, intimation will be issued by software. See, whatever 143(1) intimation is there, it will not be given by income tax officer. It is auto populated, it is auto generated intimation, and it will be processed by software. That software is located in CPC, Central Processing Center, Bangalore. Sir, what are those 5 types of errors? First, if there are any arithmetical errors. What do you mean by arithmetical error? Let's say I am filing income tax return. 10,000 plus 2,000. It is 12,000 rupees. Na? But in a flow, I entered one extra digit. 10,000 plus 2,000. I have entered 1,20,000 rupees. So there is arithmetical error. Na? So whatever the arithmetical errors are there, those arithmetical errors will be processed by uh, like will be processed by software. But nowadays, when if you have practical experience of filing income tax return, while filing income tax return only, if you enter any amount, it is auto calculated. You need not do calculation on your own. But if at all, in any worst case, if there is any arithmetical error, that arithmetical error will be corrected by software when it is processed. Are you able to understand? Next, incorrect claim. What do you mean by incorrect claim? As per section 180C, maximum deduction I can claim is 1,50,000 rupees, but I claimed 1,80,000 rupees. Whatever the extra deduction that I claim, okay, that will be reduced by software when it is processing. Similarly, under section 80D, maximum deduction allowed for normal citizen is 25,000, for senior citizen is 50,000. I paid medical insurance policy 30,000 rupees. I am normal citizen. For me, maximum deduction allowed is 25,000. But I claimed 30,000 as deduction. That will be eliminated, and only 25,000 will be allowed as deduction by software. But this type of incorrect claim is not possible, because nowadays when you are filing income tax return, validation is there at the time of filing only. So when filing IT return only, if I give 30,000 rupees, maximum deduction it will take is 25,000 rupees. So if there are any incorrect claims that I made while filing ITR, that will be rectified during the processing. Next, third one, ITR filed after due date, but I claimed business losses. I claimed business losses, capital losses, losses from owning and maintaining resources. Yesterday only we have discussed, if you want to carry forward business loss, capital loss, loss from owning and maintaining resources, mandatorily you are required to file ITR. That ITR is also required to be filed within the due date. If you file ITR after the due date, still if you carry forward business losses, then whatever the business losses that you have carried forward, those losses will be restricted and they cannot be carried forward. That restriction will be kept by software when it is processing the income tax return. Next, fourth, see this type of error we often see in our offices. In tax audit report, let's say chartered accountant disallowed 80,000 expenditure. Whenever expenditure is disallowed in calculation of total income, whatever the expenditure that is disallowed, that is required to be add back, right? But see, chartered accountant in his tax audit report under section 44AB, he disallowed 80,000 rupees, but client, when he is calculating the total income, he forgot to add back 80,000 rupees. So if there is any discrepancy between tax audit report, observations as per tax audit report, and calculation of total income, those discrepancies will be pointed out and your income will be increased by software when it is processing the return under section 143(1). Are you able to understand? I hope you know this. Practically we will see this type of thing in our offices also. Like uh, we will give tax audit report, articles will file the income tax return, whatever the observations that are there in tax audit report, for those observations effect is required to be given in total income calculation. If there is any particular thing for which effect was not given, it will be identified by software and it will give the intimation. Last one, income based deductions. You know income based deductions, right? ATIA to like ATIA, ATIB, all these sections are income based deductions. So if you want to claim a deduction for income based deductions, mandatorily you are required to file ITR within the due date. If you do not file ITR within the due date, still if you claim deduction under ATIA, ATIB, those reductions will be disallowed and your income will be increased by software when it is processing the return. So basically these are the 5 types of adjustments that will be done by the software when it is processing the return. Another important thing here is, after doing these 5 changes, it will give intimation. After receiving the intimation, you have 30 days time either to accept or reject. If you accept the intimation within 30 days, then you are required to pay tax as per intimation under section 143(1). If you do not accept the intimation as per 143(1), then you have to give your objections. Accordingly, further process will be done. Sir, is there any time limit for issuance of intimation under 143(1)? Yes, there is time limit within 9 months from end of assessment year. So generally, previous year is 24-25 na? Assessment year is 25-26. So within 9 months from end of assessment year. 9 months from end of assessment year means end of assessment year is 31st March 26. 9 months means 31st December 26. So within 9 months from end of assessment year, intimation is required to be given under 143(1). Let's say intimation was generated on like 1st April 2027. Whether that intimation is valid, that intimation is not valid. Are you able to understand? Sir, department forgot to issue intimation. There is software problem. Software did not process the return. In that case, whatever the ITR acknowledgement is there, ITR acknowledgement itself will be considered as intimation under section 143(1). Generally, whenever a department assessing officer passes assessment order, he will issue demand notice. But whenever intimation is given, intimation itself will be deemed as demand notice. Separate demand notice will not be given. So whenever return is processed and intimation is given under 143(1), intimation itself will be deemed as demand notice. Okay. Here, there is one small thing which I need to explain. Scrutiny assessment. Let's say I filed my ITR on, let's say, 15th August of assessment. Next. On 30th September of assessment year, department issued scrutiny notice to me. Okay, scrutiny notice under 143. Sir, even after scrutiny notice also, whether 143(1) intimation is issued? Yes, 143(1) intimation will be issued. Before assessment year 17-18, once the scrutiny notice is received, again intimation will not be issued. But after assessment year 17-18, they made amendment. After assessment year 17-18, even though you receive scrutiny notice under 143(2), still intimation will be generated under 143. So this is the concept of intimation under 143. Now shall I explain further? Now we will discuss assessments. How many assessments are there? There are 3 types of assessment. Regular assessment, it is also called as scrutiny assessment. Next, best judgment assessment. Next, income escaping assessment. Regular assessment 143(3), best judgment assessment 144, income escaping assessment 140. Now regular assessment under 143, this we are going to discuss. It is also called as scrutiny assessment. or regular assessment under 143. So department loves SSCs so much, that's why it will do assessment. So if department particularly loves one SSC and gives notice, and it will do assessment, so that's why the section number is also 143. Okay. Scrutiny assessment. Generally for scrutiny assessment, notice will be given under section 143 2. Assessment order will be passed under section 143. See, out of, let's say, 8 crore ITRs are filed. Sir, for every ITR, will they do scrutiny assessment? No. Like when Chidambaram was there, less than 3% of ITRs filed were subject to scrutiny. Nowadays, after Nirmalamma came, less than 1% of ITRs filed are subject to scrutiny assessment under section 143 2. So this is the confidence. So many people, many CAs, certain times they will file income tax return ad hocly. Okay. So when they file income tax return ad hocly, they, how, like, are they not scared? They are not scared, they are a bit confident, because hardly any income tax return will get selected for. Sir, how can department select any income tax return for scrutiny? Department is very intelligent. Department has internal information. So it has information from banks, financial institutions, stock exchanges, registration authorities. So like department has some risk assessment procedure within the department. That risk assessment procedure system will select returns randomly based on various criteria. Sir, what is the criteria based on which a return is selected for scrutiny assessment? That criteria only department knows, we do not know. Are you able to understand now? So department, once it selects any income tax return, it will give notice under section 143 to scrutiny. Sir, if we receive scrutiny notice, is it like we have done some fraud? No, Baba, no. Okay, if you receive a scrutiny assessment notice, it does not mean you have done fraud. Department wants to check your books of accounts. Department wants you have not overstated your expenditure. You have not overstated expenditure. You have not underrated your revenue. Because if you overstate your expenditure, your profit decreases. If you understate your revenue, then also profit decreases. So whenever department issues notice under 143.2, department will verify all your books of accounts. Department's only agenda is you should not overstate the expenditure, you should not undermine the revenue income. Okay, it will verify your books of accounts, and if it finds any overstating of expenditure, it will disallow. If it finds any understating of revenue, it will add the income. In that way, department like assessing officer will verify books of accounts and he will assess your total income. Are you able to understand? So that's how scrutiny assessment will be done. The moment you receive scrutiny assessment notice, you need not panic. If you are perfect, okay, you have not done any fraud, department will just verify and will give will do the assessment. Now, time limits. Sir, is there any time limit for issuing notice under 143.2? Yes. Within 3 months from end of assessment year, notice is required to be issued under 143.2. That means what? Let's say previous year is 24-25. What is assessment year? 25-26. When assessment year ends, 31st March 2026. From 31st March 2026, you have time limit of 3 months. 3 months means what? 30th June 2026. So on or before 30th June 2026, it needs to give notice under section 143.2. Last year, when I am filing, when I am closing one audit, not current year because audit season has not started. Last year, client has made some mistakes. I have added, I have done addition of total income. Client asked me not to point out one particular point. Okay. Then I thought of, I ignored that point. But client asked me, sir, what is the risk? I told you should pray to God till 30th June after completion of assessment year. By that time, if you do not receive any notice, you are safe. Hardly you will get income escaping assessment. That department should have information on, and based on that income escaping assessment be done. But in majority of the cases, scrutiny assessment will be done. So whenever there is some matlab in the return, like you should tell to the client, pray to the God till 30th June after completion of assessment year. Till that time, if they do not receive notice under 143.2, they are able to understand. So notice can be issued within 3 months from end of assessment year. Let's say notice was received on 10th July 2026. Then is it valid notice? That notice is invalid. See that is time barred. Time barred means what? Notice was given after the due date. Maximum time limit available for issue of scrutiny notice is up to 30th June, within 3 months from end of assessment year. Now SSE is Niranjan. Niranjan, like he forgot that he need to check whether department issued notice within the time limit or not. Niranjan cooperated to the department. Niranjan is very good guy. He is very punctual. So he gave all the information to department. Department completed the assessment. After department completed the assessment, 2 lakhs tax is required to be paid. Niranjan paid 2 lakh rupees tax. Then Niranjan met me. Okay, Niranjan asked me, sir, department has done assessment, scrutiny assessment. I paid 2 lakh rupees. I asked him to bring the proceedings. He brought me the proceedings. In those proceedings, I came to know that whatever the notice given by department is there, that notice is time barred. Sir, if notice is time barred, can we challenge it? Yes, you can challenge it only before completion of assessment. Once assessment is completed by department, then whatever the notice given by department is there, you cannot challenge. Once assessment is completed, even though it is time barred, that assessment is valid, that assessment order is valid. Okay, so whenever you get any notice, you have to first thing that you need to do is you have to check whether notice was given within the time limit or not. Notice is given within the time limit, okay. If it is time barred, then immediately you should challenge it to higher authority. Able to understand? But once assessment is completed, after completion of assessment, you do not have any power to challenge the time barred notice. Okay. Next, suppose you have received notice under 143.2. Department, will it give notice under 143.2 on standalone basis? No. Along with notice under 143.2, department will also issue notice under 142.1 clause 2. Are you able to understand? 142.1 clause 2 today only we have discussed. If department wants, it can ask information and accounts, or it can also ask personal assets and liabilities. And department also have information from other persons. Like let's say scrutiny notice was given to me, whatever my bank accounts are there, with all the banks that I do transaction, department will take information. Department will get information from outside sources also. Then considering all information, assessing officer will do the assessment. Assessing officer will complete the assessment. After completing the assessment, what assessing officer will do? He will issue assessment order. Along with assessment order, if I am required to pay any tax, demand notice will also be given. So assessment order will be given along with demand notice. Sir, what is time limit for completion of assessment? Assessment should be completed within 12 months from end of assessment year. Are you able to understand? So whatever the assessment year is there, previous year 24-25, like we have discussed here now, they have time limit to issue notice within 3 months. Next, within 12 months. Within 12 months means 31st March 2027. On or before 31st March 2027, like 12 months from end of assessment year, they are required to complete the assessment. So two time limits. Scrutiny notice can be issued within 3 months from end of assessment year. Regular assessment, scrutiny assessment is required to be completed within 12 months from end of assessment year. Those are the time limits. I will tell one point. Listen, as per ITR, my total income is 70 lakhs. As per intimation, 143.1 intimation, my total income is 80 lakhs. And as per 143.3 scrutiny assessment, my total income is 90 lakhs. Can assessing officer increase the income? Yes, he can increase the income. That is why he is doing assessment. Now, what is the objective when assessing officer is doing the assessment? His objective is to increase the income, and thereby he wants to collect the tax liability. So whether this probability is possible? Yes. Uh, as per ITR, total income is 70 lakhs. As per 143.1, intimation like total income is 80 lakhs. But as per 143.3, total income is 60 lakhs. Sir, is it possible? Students, tell me whether this case is possible or not. That means you filed ITR 70 lakh rupees and intimation is 80 lakh rupees. Scrutiny assessment, total income is 60 lakh rupees. Whether this case is possible or not. Yes, it is possible. See, as per law, during scrutiny assessment, benefit can also be given to the, but in practice, testing officer will not give benefit to the SSC. In this case, if benefit is given to the SSC, then his senior officer will scold him. Okay, so even though benefit is there, testing officer will not give the benefit. In fact, in practice, okay, in practical scenarios, whenever testing officer increases the income, then his senior officers will appreciate him. If he decreases the income, even though it is genuinely okay, like they will scold him. That's why in practice there is no concept of reducing the income as per assessment. Uh, Department does not give refund now. Who said as per scrutiny assessment refund can be issued by department? Refund can be issued. Monish, you are not correct. You can verify also. Refund will be given to the SSC as per scrutiny assessment. Refund will not be given as per ITRU. Okay. As per scrutiny assessment, if there is refund to the SSC, refund will be given to the SSC. Okay. Okay. You can check after the complete. So we have discussed the time limits also. So this is the concept relating to scrutiny assessment under section 143. Next we will discuss best judgment assessment. 44. Best judgment assessment. It is also called as ex parte assessment. No problem, you can check it. I know today, there will be differences between you and me because assessment procedures is such a chapter. How many times you read, still you have some doubts which are unclarified. Okay. Best judgment assessment, already we have discussed. In 4 cases, best judgment assessment will be done. It is also called as ex parte assessment. Sir, what do you mean by ex parte? Ex parte means what? Without party, without SSC, assessment will be done. Okay, so without SSC means what? Department itself will do the assessment. That's why it's called as best judgment assessment or ex parte assessment. Give any tips to exam focused? My dear student, please ask all these things at the end of the class. Okay, right now let me explain the concept. Last 10-15 minutes are for chit chat. Okay, whatever you wanted, you ask me, I will tell. But in the middle of the class, if you have any doubt relating to concept, ask. Else, general things we will discuss. Because if I miss the flow again, it becomes tough for me to get back into the track. Now, best judgment assessment. It will be done in 4 cases. Case 1, like you have not filed ITR and due date under section 139(1) is over. What is due date? 31st July, 31st October, or in case of transfer pricing 30th November. You did not file ITR within the due date. Then after the completion of due date, department will issue notice to file ITR. If you do not file ITR, if you do not reply, it will send 1 or 2 reminders. Still, if you do not reply, then department itself will do the assessment. That assessment we call as best judgment assessment. Are you able to understand? When SSC not complied with notice under section 142(1), then also department will issue then also department will do best judgment assessment. Today first topic is that only na. when you do not file return as per the notice given under 142(1) clause 1, when you do not submit return of information, accounts, assets and liability statement as per notice under 142(1) clause 2, then penalty of 10,000 will be levied under section 272A. Best judgment assessment will also be done. Next, if SSE do not cooperate with assessing officer or with the chartered accountant or cost accountant during the course of special audit. Today we have discussed it now 142 2A special audit. So if SSE do not cooperate during special audit, then also best judgment assessment will be done. Similarly, like scrutiny notice will be issued now under 143(2). If SSE do not respond to scrutiny notice given under section 143(2), then also best judgment assessment will be done. If SSE do not respond to notice under section 143, then also best judgment assessment will be. See, three cases: first case, third case, fourth case. In these three cases, show cause notice will be given. Why best judgment is not required to be done? So show cause notice will be given by department. So they will wait for SSE to reply to the show cause notice. If SSE do not reply to the show cause notice, then they will proceed further and do the best judgment assessment. But in second case, he did not file ITR and department gave notice under 142(1) to file ITR. That notice was also ignored by SSC. So in this case, no show cause notice will be given. Directly best judgment will be done. Are you able to understand? Sir, best judgment assessment means what? Department itself is doing the assessment. So whether department will do the best judgment assessment on a arbitrary way, on a ad hoc way, on a random way? No. Department will do the best judgment assessment in a scientific and rational manner. Sir, what do you mean by scientific and rational manner? Let's say, like, you are into hotel business. Your turnover is 1 crore rupees. Department knows your turnover is 1 crore rupees. So if same hotel is getting 20% margin, they will also apply 20% margin for your hotel. 1 crore into 20%, 20 lakhs will be determined as your total income. Are you able to understand? So in that way, in a scientific way only, they will do the assessment. I will tell another example. Let's say you are into cryptocurrencies. Like, you are the only one in India who are dealing in cryptocurrencies. There is no other business. Then what department will do? You have done transactions in last year also. They will take last year turnover as base. They will increase growth rate 15% or 20%. Thereby they will increase the turnover and they will apply the profit percentage margin. They will calculate the total income. Sir, department have no information with them. Then department will send income tax inspectors to you nearby your homes, and they will ask those people who are there in and around your home. Okay, they are the better people who will tell. Okay, so let's say Umasankar is there. No information is available to department with regard to Umasankar. Then department will send income tax inspectors to various people who are there in my neighborhood. Okay, they are the people who will tell me, yesterday I have seen one car in Umashankar's house. I feel that car belongs to Umashankar. Okay, so randomly they will get the information, they will check the authenticity, and they are going to calculate the total income, and best judgment assessment will be done. So best judgment assessment will never be done on a ad hoc basis or arbitrary basis. Always it is done on a scientific and rational basis. Able to understand? Sir, is there any time limit to complete best judgment assessment? Yes. Whatever the time limit that we discussed for scrutiny assessment, 143.3, scrutiny assessment is required to be completed within 12 months from end of assessment year. Same time limit is also applicable for best judgment assessment under section 140. Not responding for scrutiny notice, see not cooperate and not filed ITR, then best judgment. I did not understand your question. Sir, it is possible, sir. I guess I confused it with other provision. Yeah, it is possible if scrutiny notice is given under 143(2) and you do not, you know, respond to department. Department initially will wait, it will send 2 to 3 reminders. For those reminders also, if you are not, then directly instead of scrutiny assessment, they will invoke 144 provision. They will do best judgment. Am I audible? Some people are saying there is voice break in the. Monish, whether my voice is clear? Hello, are you there? Next, we will discuss 144A. So, 2 points you got doubt. One point that you got doubt is this point. If SSC do not respond to notice under 143. Another point, whether refund can be issued as per scrutiny assessment. These 2 points you can check later. Section 142A, power of JC to issue direction. See, many times assessing officer will do assessment of SSC. Assessing officer asked bribe. SSC did not give the bribe. Then what assessing officer will do? Assessing officer is very aggressive on. So there is one expenditure A. This expenditure is allowed as per Supreme Court decision. But assessing officer intentionally disallowed the expenditure. Why? Because SSC did not give the bribe to assessing officer. In that case, SSC can request the joint commissioner. So here assessing officer means additional commissioner, sorry, assistant commissioner or deputy commissioner of income tax or ITO. So if these people are doing the assessment, and like if they are disallowing certain expenditure, or if they are committing anything that is to be allowed but they are intentionally disallowing, in that case SSC can request his boss. Who is boss to assistant commissioner, next level additional commissioner or joint commissioner? In this case, SSC can request joint commissioner, sir, expenditure A is allowed as per Supreme Court decision, but assistant commissioner is disallowing that expenditure as he is like inferior to you. Please give direction that expenditure A should be allowed as deduction. So in certain cases, like assessing officer will intentionally disallow certain benefits to SSC. In that case, SSC can request joint commissioner to issue directions for allowance of such expenditure. Are you able to understand? Or in certain cases, assessing officer is very new. Like he wrote IAS exams. He did not get IAS, but he got IRS and he became assistant commissioner. He is new to the department. He does not know how assessment will be done. In that case, as, like assistant commissioner, deputy commissioner, ITO, they themselves can ask the joint commissioner. Then also joint commissioner will issue the directions. So joint commissioner can issue directions on request made by SSC, on request made by assessing officer. Sometimes joint commissioner can also issue directions on his own motion. Sir, let's say joint commissioner already knows assistant commissioner is corrupt. Okay, so when joint commissioner observes assessing officer, I mean assistant commissioner is intentionally disallowing certain benefits. In that case, joint commissioner on his motion he can give. Are you able to understand? He can give directions to the assistant commissioner, deputy commissioner, or ITO. Next question is, sir, whatever the directions given by joint commissioner, are they binding on below assessing officer? Yes, they are binding on below assessing officer because joint commissioner is of higher rank. Are you able to understand? Next, 144C dispute resolution panel. I'm sorry, 144A, but I have written 144, 42. Section 144C dispute resolution. See, generally, when AO do assessment, in case of SSC, generally after assessment, AO will give assessment order. But in two cases, AO should not give final assessment order. AO should give draft assessment order. Okay. See, normally in our audit office, when I was an article, I went for one audit. I went for BSNL audit. Okay. So we have done BSNL audit. We have found certain observations. I have prepared all the observations and I gave to my principal. Okay. Generally, what will we do in our offices? We will issue draft audit report. Okay. Client will go through the entire draft audit report. Then he will sit with our boss. He will discuss with our boss that certain points are to be removed from audit report. Okay, some negotiations will happen, some agreements will happen, some exchanges will happen. Then certain points will be removed from audit report. Are you able to understand? So, like some important points will be removed. Whatever the bakwas points are there, unimportant points, those will be included and audit report will be given. Okay, that audit report we call as final audit report. Am I correct? So similarly, whenever assessing officer is doing the assessment, generally he will give final assessment order. But in two cases, he should not give final assessment order. He should give draft assessment order. Sir, what are those two cases? Case one, whenever he is giving assessment order in case of non-resident. So, in case of non-resident or foreign company, if there is increase in income or if there is decrease in losses because of assessment, if there is any harmful to SSC, if SSC is non-resident or foreign company, because of assessment, if there is any harm to SSC, so when can we tell there is harmfulness to the SSC? Whenever income increases or losses decreases. Or case 2, whenever in case of transfer pricing. Okay, so whether in case of resident or non-resident, case transferred to transfer pricing officer, case transferred to TPO, transfer pricing. So in this case also, if there is any increase in income or decrease in losses, then what assessing officer will do? Assessing officer will not straight away give final assessment order. Assessing officer will give draft assessment order. Monish is saying 100%. Yes. See how much hard work we will keep. We will go to client place. We will sit there for 2 to 3 days. We will do investigation. We do not do audit. We will find so many observations. But at the end, if we see final audit report, it's like our entire hard work is gone. Okay. So AO has issued draft assessment order. See, once SSC, here SSC means either non-resident or foreign company or any person in whose case was transferred to transfer pricing officer. So what after receiving draft assessment order, SSC is having time limit 30 days. Within 30 days, he can give acceptance. If he accepts a draft assessment order, then final assessment order will be given by assessing officer, not a problem. But if SSC has any objections, within 30 days, he can file objections with dispute resolution. Are you able to understand? Now you will get another doubt. Sir, what if you do not respond within 30 days? If 30 days is over, but he did not accept, he did not file objections with DRP. In that case, it will be deemed as acceptance. So, like once a draft assessment order is given, he will be given 30 days. Within 30 days, either he should accept or uh, he should file objections with DRP. If you do not respond within 30 days, then whatever the draft assessment order is there, that will be made as final assessment order and issued by. Are you able to understand? So within 30 days, if he gives acceptance, then like within 1 month from end of month in which acceptance is given, final assessment order will be given by the officer. Are you able to understand? Or else, if he files objections with DRP, sir, who is called as DRP? Dispute Resolution Panel is a collegium of three commissioners of income tax, three CITs together. We call as who will appoint DRP CBDT. Okay, so CBDT will pick three commissioners. CBDT will make all three commissioners as collegium. Okay, so whoever the DRP is their dispute resolution panel, they will ask entire information. They will ask information from SSC. They will also ask information from department. They will go through entire information. Like if they want any extra information, they will also ask that information. Finally, DRP will give issue directions to assessing officer. Based on these directions, sir, whether directions given by DRP, are they binding on assessing officer? Yes, they are binding on assessing officer because DRP consists of commissioner. Commissioner is superior rank of assessing officer. That's why whatever the directions given by DRP, they are binding on assessing officer, and assessing officer should consider those directions. As per those directions, assessing officer will give final assessment order. Final assessment order will be issued by. Next, you will get another doubt. Sir, what is the time limit for issuing directions? Within 9 months from end of month. From end of month in which draft assessment order was issued. See, assessing officer will give a draft assessment order na the month in which a draft assessment order is issued. From end of such month, within next 9 months, DRP will give his directions to the assessing officer. Based on those directions, assessing officer will complete the. Now, SSE is not satisfied with direction. The question is, can he challenge directions? Students, you need to answer. If SSE is not satisfied with directions given by DRP, can he challenge those directions? If SSE is not responding, then what is the situation? In that case, it will be considered as deemed action. So my question here is, dispute resolution panel gave some directions. With those directions, SSE is not happy. SSE is not satisfied. Now, can SSE challenge those directions? Two people gave answer. Your answer is not correct. SSE cannot challenge. See, he cannot challenge the directions. Final assessment order is given na. This can be challenged. Are you able to understand? In one attempt, one question was asked. Dispute resolution panel, whatever the directions that were given by DRP are there, those directions cannot be challenged by SSE. But whatever the final assessment order is given, that final assessment order can be challenged by SSE. Are you able to understand? Can move to iterate. Okay. He cannot challenge directions. He can challenge only assessment order. Yes, Niranjan, what you said is correct. See, he can challenge assessment order na. Can he challenge at CIT or JCIT level? CIT appeals or JCIT appeals? He cannot challenge. He can challenge only at ITAT level. Sir, why sir? DRP consists of three commissioners. So commissioner of income tax appeals, both are of equal rank na. So whatever the judgment given by commissioner as a DRP, that cannot be challenged with another commissioner, that can be challenged with higher authority being ITAT. Are you able to understand? So Monish, it cannot be challenged. Okay, directions cannot be challenged, but only final assessment order can be challenged. So I think I have explained most of the concept. Yeah, another important point, DRP, he can increase or he can confirm or he can reduce the income. So DRP have all the powers. Whatever the draft assessment order is there, he can confirm the draft assessment order, or he can increase income compared with the draft assessment order, or he can decrease income compared with the draft assessment order. For that purpose only SSC made application to DRP, right? He is expecting DRP will reduce the income. So DRP have power to reduce the income that is stated in draft assessment. Voice break made. Yeah, one last point. Whenever search is conducted from 1st September 2024 onwards, if search is conducted, then 144C provisions are not applicable. Generally, if case is referred to transfer pricing officer, or in case of non-resident or foreign company, let's say in case of non-resident or foreign company, search was conducted and block assessment was done. Sir, after block assessment, will he directly give final assessment order or will he give draft assessment order? He will give final assessment order. 144C provisions are not applicable. Draft assessment order is not able to understand. Anyhow, I will explain block assessment. So this is the concept relating to DRP. Now, hero, income escaping assessment, section 147. So till here, are you clear, everybody? I know it's little bit boring, but I can't help you. Assessment procedures is. Are you able to listen my voice clearly? Sir, what do you mean by income escaping assessment? Escaping assessment means you have secreted the income. Secreted the income. Or you earned income, but that income was escaped from assessment. Let's say 40 lakh rupees cash, 40 lakh rupees cash I earned in 24-20. Entirely earned in cash na. I did not disclose in my ITR. I filed my ITR with whatever the information that is available in my bank transaction. So this 40 lakh rupees income that I earned in cash, this has escaped assessment. This 40 lakh rupees I have secreted. Okay. Department gave scrutiny notice under 143(3). Department has done scrutiny assessment. In scrutiny assessment also, how can it find 40 lakh rupees that is there in cash? Like I received 40 lakh rupees income, I also spent 40 lakh rupees income. Now department cannot know na. So in that way, department could not find that 40 lakh rupees in a scrutiny assessment. But later on, with those 40 lakh rupees, I purchased one land. Through registration office, information was known to income tax department. Then income tax department have power to do income escaping assessment. Able to understand? So I hope with this example you got clarity. Now, sir, already assessment was done under 143(3). Again, whether assessment will be done under 143(3), again, is it possible? No. See, once already assessment is done, again they will not touch that previous year. Sir, already assessment was done under 143(3). Again, can they do best judgment assessment? No, they cannot do best judgment. Sir, already 143(3) scrutiny assessment was done. Again, they wanted to do best judgment assessment. Sir, can they do best judgment assessment? Sorry. They wanted to do income escaping assessment. Whether department has power to do income escaping assessment? Yes. Sir, already first time income escaping assessment was done. Again, second time also they wanted to do income escaping assessment. Can they do? Yes. Sir, 2 times income escaping assessment was done. Third time they wanted to do income escaping assessment. Can they do? Yes. So department like 147 gives huge power to department. They can do income escaping assessment as many times as they wanted under section 147. My vlogs, one person is there. Please check your mobile. Nobody is complaining except you. Next. Sir, best judgment assessment was done. Again, will they do best judgment assessment? No. Again, will they do scrutiny assessment? No. Again, can they do income escaping assessment? Are you able to understand? ITR filed under section 139(1). Intimation was given under 143(1). Scrutiny assessment under 143(3). It was not done. They wanted to directly initiate proceedings of section 147, income escaping assessment. Can they do? Yes, they can do. Are you able to understand? No ITR filed, but they wanted to do income escaping assessment. Can they do? Yes, they can do income escaping. Again, they wanted to do second time income escaping assessment. Can they do? Yes, they can do for multiple number of. Whenever they do scrutiny assessment, in that case, first of all, sorry, whenever they do income escaping assessment, they have to follow procedure given under 148A. First of all, notice for income escaping assessment. Notice will be given under section 148. Assessment order will be given under section 147. Before issuing notice under section 148, what they will do? They need to follow procedure given under 148A. Sir, what is the procedure given under section 148A? Let's say department has information. Umasankar purchased 40 lakhs worth of land using cash. They will directly not give notice under section 148. What they will do, first of all, they will give show cause notice to me, giving opportunity of being heard. We have information with us that you purchased 40 lakhs worth of land using cash. Is it correct or not? They will give show cause notice to me. Okay, so I need to give response to that show cause notice. I gave response, yes, it is true. I purchased 40 lakhs worth of land using cash. Now they will officially give notice to me under section 148. Otherwise, what happens? Like in many cases, like rumor comes. Based on rumor, if they issue notice under section 148, then department is becoming full. So whenever they get any rumor, like they will speak with SSC. They will give show cause notice. They will follow procedure under 148A. They will ask whether it is correct or not. Okay, so they will give first notice under 148A that so and so information is available. Is it correct or not? Tell me the reason why we should not give notice under section 148. In that case, show cause notice will be given to the SSC. Now, SSC needs to give reply. I gave reply, sir, I am M. Umasankar. There is another person, A. Umasankar. This notice is for A. Umasankar, but you have given notice to me. That means notice was given to wrong person. In that case, what they will do? They will cancel. They will not issue notice under section 148. So, what is the first step that they will do? First step that they will do is they will issue notice under section 148A. Once they issue notice under section 148A, they will wait for the reply from SSC. Based on reply from the SSC, they will come to conclusion whether case is fit case or not. If case is fit case, then they will issue notice under section 148. If case is not a fit case, then they will drop the proceedings. they will not go further. But if it is a fit case, really I accepted, I have done a transaction, like I earned 40 lakhs income, with those 40 lakhs I purchased the land, then they will issue notice to under section 48. After issuing notice to me under section 148, they will ask me to file income tax return. Sir, I already filed income tax return under section 139(1). Already ITR was filed. Already ITR under section 139 was filed. Again, in response to notice, under section 148, am I required to file ITR for the second time? Yes, I am required to file ITR for the time. So even though you file ITR already, still in response to notice under section 148, you are required to file ITR. Are you able to understand? So that is the concept. Now what I will do, I will file my ITR. Now I will ask you some interesting stuff. Let's say I earn incomes A, B, C, D, E. A, B, C were disclosed in ITR. I received notice under section 148A that D income got escaped from. Now you are a chartered accountant. I am your client. I came to you. I told, sir, I disclosed A, B, C incomes in my ITR. Now I got notice from department 148A that income D got escaped from assessment. I accepted for it. They asked me to file ITR. Now anyhow, I need to disclose income D in my ITR. The real question is, am I required to disclose income E as well? As a chartered accountant, what will you suggest? Will you suggest me disclosing income E as well in response to notice under section 148, or you will suggest me not to disclose income E under section response to notice under 140? Disclose or not to disclose? See, generally it is advisable to disclose income E also, because after you file income tax return in response to notice under section 148, they will issue notice under 143 to scrutiny assessment. They will do scrutiny of entire your books of accounts. At that point of time also, they will come to know that you have earned income E. So it is ideal, it is advisable to disclose all the incomes, so that you will at least escape from levy of penalty. Otherwise, they will also levy penalty. Understand? Yeah, need to disclose, otherwise one more 147. So Niranjan is brilliant. For example, Monish said, sir, let's give a try, let's give luck. Income is, let's not disclose income E. So I followed Monish. I did not disclose income E. Already ABC were disclosed in ITR. D was disclosed in the return I filed in response to notice under section 148. But during the course of proceedings, department finally found income E. Department found income E. My question is, whenever department finds income E, whether department is required to follow procedure under 148A from the beginning, or is it sufficient department will consider income E also in the income escaping right away? Answer. See, I did not disclose income E, but during the scrutiny, department found income E. The question here is whether department is required to follow procedure from the beginning, or the point where it found income E, when they consider that income E and do the assessment. That is the question. Yes, from point where it found, it will do the assessment. They are not required to follow procedure under section 148A from the beginning. But if income, like let's say income A to D, this belongs to previous year 23-24. Income E belongs to previous year 22-23. So during the course of income escaping assessment, if they find any new income, if that new income belongs to the year for which they are doing assessment, they need not follow procedure from the beginning. From the point where they found new income, from there they can do the assessment. But if new income belongs to another previous year, they need to follow procedure given under section 148. Able to understand? Next, you filed ITR under section 148, but there is some mistake in ITR filed under section 148. Now, can you file revised return? You filed ITR under in response to notice under section 148, but there is mistake in it. You wanted to file revised return. Can you file revised return? No, revised return cannot be filed once you file ITR under. Sir, are there any time limits to complete the assessment? Yes. Here there is amendment before 1st September 2024. The treatment was different. On or after 1st September 2024, treatment was different. So, first notice under section 148A. Whatever the notice under section 148A is there now, that notice is required to be given, like that is optional before 1st September 2024. Like department can conduct inquiry, department will issue notice and opportunity of being heard. So how much period? Minimum 7 days, maximum 30 days. So order will be passed under section 148A whether case is fit case or not a fit case. So before 1st September or after 1st September, before issuing notice under section 148 for income escaping assessment, first they will cross confirm. They will follow procedure given under 148A. They will issue show cause notice. They will give opportunity of being heard. Why notice under 148 is not to be issued. Minimum 7 days, maximum 30 days will be given to the SSC to respond to it. After receiving response from SSC, they will take decision whether it is fit case or not a fit case. If it is fit case, well and good. If it is not a fit case, if it is fit case, then they will issue notice under section 148. If it is not a fit case, they will drop the proceedings. Notice under section 148. AO shall serve notice, may also give order passed under 148A. SSC is required to file ITR within 3 months from end of the month in which notice was served. So before 1st September 2024, sir, if SSC not responding properly, then whatever the information that is there with the department, based on that, testing officer will pass assessment order for income escaping section 147. Still, if you do not respond, then income tax office, tax recovery officer will be there. He will go to his house. He will attach all his property. Now, SSC is required to file ITR within 3 months from end of the month in which notice was served. After 1st September 2012 also, after 1st September 24 also, AO will issue notice. He is mandatorily required to give order under 148A. SSC is required to ITR within 3 months from end of the month in which notice was issued. AO can issue notice with a time limit of less than 3 months as specified in the notice, but overall original time limit plus extended time limit to file written in response notice under section 148 cannot be more than 3 months. See, this point is very important. Time limit for giving notices under section 148A, 148. Till here, whether you listened or not, I do not know. But here there is amendment. From 1st September 2024 onwards, amendment is there. Please listen carefully. Sir, is there any time limit for issuing notice under section 148A? Yes, there is time limit. Before 1st September 2024, for notice under section 148A, like no time limit was prescribed. No time limit was prescribed. But after 1st September 2024, you can see here notice under section 148. Before 1st September 24, if tax effect, okay, if income escaped is less than or equal to 50 lakhs, in that case, notice should be issued within 3 months from end of assessment year. If income escaped is more than 50 lakhs, department have huge time limit. They can give notice up to 10 years from end of assessment year. That means what? 2015-16 income also can be, assessment can also be done for 2015-16 also. Very simple, like 1st September 24 is criteria. Before 1st September 2024, like no time limit is prescribed for 148A, no time limit given. But time limit is given for 148. If income escaped is less than or equal to 50 lakhs, like notice under section 148 is to be issued within 3 years from end of assessment year. End of assessment. Next, if income escaped is more than 50 lakh rupees, then 148 is to be issued within 10 years from end of assessment year. That means higher time limit is available. If your income escaped is less than 50 lakhs, 3 years. If your income escaped is more than 50 lakhs, department can do assessment up to 10 years from the end of the assessment year. But on or after 1st, 1st September 2024, for 148A notice also, time limits are given. See, before 1st September 24, for 148A, no time limits are prescribed. After 1st September 24, time limits are prescribed. What are time limits? If income escaped is less than or equal to 50 lakhs within 3 years. If income escaped is more than 50 lakh rupees, then notice is required to be given within 5 years. Very, very important. That means from 1st September 24 onwards, if your income escaped is more than 50 lakhs, maximum time limit available for department to give notice to you under 148A is within 5 years from the end of the assessment year. Sir, what is time limit for notice under section 148? You need to add 3 months. Generally, for notice under section 148A, time limit is 3 years. So here if income escaped is less than or equal to 50 lakhs, notice is required to be given under section 148 within 3 years, 3 months from end of the assessment year. 3 years, 3 months from end of assessment. If income escaped is more than 50 lakh rupees, then notice is required to be given within 5 years, 3 months from end of assessment. So those are the time limit. Before 1st September 24, no time limit for 148A, but time limit is there for 148. Time limit is within 3 years from end of assessment year if income escaped is less than or equal to 50 lakhs. If income escaped is more than 50 lakhs, then time limit is within 10 years before 1st September 24. After 1st September 24, for 148A notice within 3 years, if income escaped is less than or equal to 50 lakhs, if income escaped is more than 50 lakhs, then within 5 years from end of assessment year. Time limit for notice under section 148, 5 years, 3 years, 3 months, 5 years, 3 months. Very simple. After 1st September 24, whatever the time limit for 148A is there, to that you need to add 3 months to arrive at time limit for issue of notice under section 148. Are you able to understand? Next, sir, whether prior approval is required for conducting income escaping assessment? Yes. Before 1st September 2024, you need to take, if income escaped is less than or equal to 50 lakhs, you need to take prior approval of bosses. Bosses means commissioner or principal commissioner, director or principal director. If income escaped is more than 50 lakhs, you need to take approval of top level bosses. Top level bosses means chief commissioner, principal chief commissioner, director, principal director. Okay. But from 1st September 24 onwards, to do income escaping assessment, power is given to additional commissioner or joint commissioner, additional director or joint director. That means additional commissioner or above level, the additional director or above level, joint commissioner, joint director or above level officers, they can do income escaping assessment. Able to understand? Time limit for completion of income escaping assessment. I can understand you will get some doubts. After listening to my explanation, open any other book or even ICA material, read income escaping assessment, then you will get complete clarity. Okay, because you would have listened income escaping assessment lot before. Okay, before 3-4 months you have listened, again you are listening now. Okay, clumsy confusion will be there, but once you read the material you are going to get the class. Yeah, here one small mistake is there. See, if income is greater than or equal to 50 lakhs, that means even it is 50 lakh rupees, then also 5 years time limit is available. So the thing is, here, if income escaped is less than 50 lakhs, if income escaped is greater than or equal to 50 lakhs, that means even if it is 50 lakh rupees, then also 10 years time limit is available before 1st September. After 1st September, even though income escaped is exactly equal to 50 lakhs, then also 5 years time limit is available. Please change this. I made this small mistake. If income escaped is less than, if income escaped is greater than or equal to 50 lakhs. Thank you, Monish. In a flow, I made that mistake, but please correct. Very simple. If income escaped is less than 50 lakhs, lower time limit. If income escaped is either equal to 50 lakhs or more than 50 lakhs, higher time limit is available for department to issue the next time limit for completion. Let's say today income escaping assessment notice was issued 28th July 2025. You need to take end of month. End of month is 31st July 2025. From 31st July 2025, 12 months. That means within 12 months from end of the month in which notice was issued under section 148, assessment is required to be completed. That means on or before 31st July 2026, income escaping assessment is required to be completed and assessment order is required to be passed by the assessment officer. Able to understand? So time limit for completion of assessment is within 12 months from end of the month in which notice is issued under section 48. You can see here within 1 year, okay, 1 year or 12 months from end of financial year in which notice is issued under section. So this is all about income escaping assessment. Now, shall I explain block assessment, everybody? Today also it's taking time, even though we start early. No problem. I think after today is Monday, na? After Wednesday, there is no class for CA final. On Wednesday, I will take remaining part. Today also it is assessment procedures only. On Wednesday, I will take appeals and revisions realization. Okay. Niranjan saying tomorrow, sir, block assessment. At least let us complete assessment appeals and revisions. Today for YouTube channel thumbnail, I used appeals and revisions and equalization levy thumbnail. I need to change it. Yes, it is lengthy. What can we do? We do not have any option to leave it for it. So tell me, block assessment is very, very important. If you want, I will explain now, or else we can think. One person said, okay, block assessment about other. We will do one thing. Block assessment I will explain now because we will finish assessment. Tomorrow we can start fresh. Niranjan, uh, like if you are not able to listen now, then try to listen, or else the video is again available on YouTube channel. Later on also you can watch that blog. Now block assessment, very, very, very important. See, this is recent amendment made in Finance Act number 2 of 2024. So high chances block assessment can be asked in the examination. So don't take lightly. We discussed search na yesterday. In case of search, they will seize the assets. They will seize books of accounts. They will take assets with them. They will freeze the assets, deemed seizure and all. Once they seize the assets as per search, we have discussed after completion of search, they will do assessment. That assessment is block assessment. See, 1st September 2024 is criteria. Before 1st September 2024, after search, they will issue notice under section 148. Just now we have discussed whenever any notice is required to be given for income escaping assessment under section 148, before that they are required to follow procedure under section 148. Correct? 148A. Listen very carefully. In case of search before 1st September 2024, if department is issuing notice under section 148, they are not required to follow procedure given under section 148A. So other than such cases, if they wanted to issue income escaping assessment notice, then they are required to follow procedure given under 148A. But in case of search, in search cases, then if they want to issue income escaping assessment notice, they are not required to follow procedure given under section 48A. Directly they will issue income escaping assessment notice and they will complete income escaping assessment and they will issue assessment order under section 147. But on or after 1st September 2024, if they have done search, if they have done right, then they will not issue notice under section 148A or 148. Okay, they are not required to issue notice under section, like they will not do income escaping assessment from 1st September 24 onwards. If any search is conducted, they will do block assessment under section 158 BA to 158 BI. So till here you are clear. Did you understand when block assessment will be conducted? In every case, block assessment will not be conducted. Only in such case, block assessment will be conducted. That too, if search is initiated on or after 1st September 2024. Not search completion. If search is conducted either on 1st September or after 1st September, then like after completion of search, whatever the assessment that they do, that is not income escaping assessment, that is block assessment. Okay. Now, sir, what do you mean by block assessment? Block assessment means the year in which they are doing the raid, the year in which they are doing the search. Along with that year, for last 6 years, they will also ask you to file ITR. That's called block assessment. See, block assessment concept was also there when I am studying my CA final. I am studying in Finance Act 2020. In up to Finance Act 2021, block assessment is there. Later on, Nirmalamma removed block assessment. Again, she introduced block assessment after elections, after 1st September, like through Finance Act number 2 of 2024. So this is not new concept for me, but for you it is new concept. Okay. So the thing is, let's say search initiated on 10th June 2024. After they initiate search, they will complete the search. They will prepare Panchnama, last of authorizations. Let's say search completed on 14th June 2024. Now what they will say, 10th June 2024 to 14th June 2024. Along with this, last 6 years means previous year 23-24, 22-23, 21-22, 20-21, 19-20, 18-19. Entire this period they will call as block period. Now they will give notice under section 158 and they will ask you to file income tax returns of last 6 years. They will also ask you to file income tax return of current previous year from 1st April 24 to up to date of completion of search up to 14th June 2024. So from 1st April 24 to 14th June 2024, they will ask you to file ITRs. Okay, so this is called block period. That means whenever search is conducted on or after 1st September 2024, whatever the assessment that they will do, that assessment is block assessment. What do you mean by block? In current previous year, 1st April up to date of completion of search plus last 6 years. For this entire period, for this entire block period, you are required to file ITR. They will issue notice under section 158 and they will ask you to file ITR for block period. You are required to file ITR for entire block period. Are you able to understand? Sir, you already filed ITR under section 139(1). Already filed. Again, are you required to file ITR for block period? Yes, you are required to file ITR for block period. Are you able to understand? Let's say your total income is 100 lakhs. This is disclosed in ITR. Next. You got notice under section 148. As per 148, total income is 250 lakhs. After you file return, sorry, why 148? Notice was given under 158 block assessment. In response to block assessment notice, you have filed ITR. ITR income is 250 lakhs. Now, along with this block assessment notice, after you file ITR, he will issue notice under 143(2) and he will do scrutiny assessment. As per scrutiny assessment, total income is 340 lakhs. See, You were asked to file income tax return in response to block assessment notice. At that time, you should disclose everything fairly. Then also, you have secreted some income. Whatever the income that you have secreted, hidden income is there, 90 lakh rupees. This 90 lakh rupees, they will call as undisclosed income. Are you able to understand? So, whatever the income that is not disclosed in ITR is there, that got escaped from ITR is there, that we call as undisclosed income. On this undisclosed income, straight away they will levy tax at the rate of 60% plus penalty at the rate of 30% on tax. That means what? Tax at the rate of 60% means 90 lakhs into 60%. 54 lakhs. 54 lakhs into 50%. Sorry, penalty at the rate of 50% on tax. 54 lakhs into 50% means 27 lakhs. That means you need to pay tax liability of 81 lakh rupees. Simply 90% of undisclosed income you are required to pay tax. Sir, again whether surcharge is calculated? No. Again whether health and education cess will be levied? No. Again whether interest under 234 ABC will be levied? No. Already you are paying 90% of undisclosed income as tax. Again they do not levy surcharge. They do not levy health and education cess. They do not levy interest under section 234 AB. You will understand. So this is the concept. Now, shall I proceed? Shall I explain further? You know block period, right? This is block period. See, when notice was given for block assessment for previous year 2021, assessment is pending under section 143. Now, will they continue that assessment? They will not continue that assessment. They will abate that assessment. That means they will stop that assessment and they will do assessment under only block assessment. Are you able to understand? That means what? Whatever the block period is there, in that block period, for any previous year, if any assessment is already continuing under 143.2 or 147, they will stop that assessment and they will do assessment under block assessment. Are you able to understand? Let's say for previous year 23-24, scrutiny assessment is pending. What they will do? They will abate. They will stop that assessment and they will do assessment under block assessment. For previous year 1920, ITAT already appeal was filed. ITAT order was passed. Now they will not touch. For this, whatever the matter that is already concluded in ITAT is there, for that block assessment they will not do, they will not touch, because that matter is already concluded in income tax appellate tribunal. Let's say there is one guy, Arvind Kejriwal. Against Arvind Kejriwal, search was conducted. After conducting search on Arvind Kejriwal, notice was given, block assessment notice was given. Now Arvind Kejriwal went to Supreme Court. He told elections are coming, because of political vendetta. The opposition, like the ruling party, has done raid on me. Other than that, I do not have any income in my home. I do not have any assets in my home, he said. Supreme Court said whatever the search that is conducted on Arvind Kejriwal is there, that search is not valid, that search is not correct. And Supreme Court cancelled the search operations done by Income Tax Department. Once Supreme Court cancels the search operations, then whatever the assessments that were already abated are there, again they will be started. Are you able to understand? Again they will start. Again they will start. Are you able to understand? So generally, once block assessment proceedings are initiated, regular assessments will be stopped and block assessment will only be done. However, if block assessment is considered invalid by any court, in that case, whatever the stopped proceedings are there, again they will revive. Are you able to understand? That is the next. Now, there are two persons, Monish and Varun. Both are best friends basically, Monish and Varun. So what they have done so many transactions. Whatever the transactions that they have done, only they knows, nobody knows. So they have maintained that information in such a secret way. On Monish, department has done search after 1st September 2024. I think I said one mistake previously. Monish, correct me. In case of income escaping assessment, time limit available is within 12 months from end of financial year, right? Income escaping assessment. Yeah, 12 months from end of financial year, not end of month. I have made mistake here. Please rectify. End of financial year. End of financial year is 31st March 2026. From here, 12 months means 31st March 2027. Please make this change. Time limit for completion of income escaping assessment within 1 year or within 12 months from end of financial year in which notice is issued under section 48. Please make this. What, Monish? What are you doing when I'm saying this? So again, let's come back to block assessment. On Monish, raid was conducted by Income Tax Department after 1st September 2020. Now, so when they are doing search in Monish house, there are some assets belonging to Varun found. Both are best friends, na? So assets belonging to Varun were found in Monish house. Now, Monish resides in Chennai. Varun, let's say, resides in Bangalore. Now, what happened? Whoever the assessing officer of Monish is there, assessing officer of Monish will hand over these assets. Hands over those assets to assessing officer of Varun. Then what assessing officer of Varun will do? He will issue like a notice under section 158. Block assessment notice under section 158 to Varun also. Like again, like uh, block assessment proceedings will be initiated against Varun as well. Are you able to understand? Time limit for completion of assessment. Completion of block assessment. Time limit for completion of block assessment is within 12 months from end of the month in which block assessment notice was issued. So whatever I said earlier, that is correct now. For income escaping assessment, 12 months from end of financial year. For block assessment, time limit for completion of is within 12 months from end of the month. Due to a lot of time limits, it's getting difficult, sir. No worries. I have planned to prepare one summary of time limit. I will try to do. So time limit for completion of block assessment. Let's say today, 28th July 25, block assessment notice was given. You have to take end of month. What is end of month? 31st July 25. From 31st July 25, again you need to consider 12 months. That means on or before 31st July 2020, block assessment order is required. Confusing. That's what DT is. Why many students feel tough DT is because of this. You are under stress also. See, 12 months from end of financial year, that is for income escaping assessment. 12 months from end of the month is for block assessment. Okay. I will give for you time limit for completion of assessment. For income escaping assessment, 12 months from end of financial year in which 148 notice is given. For block assessment, within 12 months from end of month in which notice under section 158 was given. I hope now you understood the difference. For income escaping assessment, end of financial year. For block assessment, end of the month. I hope now you understood the difference. This is why even in revision class also for assessment procedures, I am not rushing. If I rush, it will be like a Tamil movie. So this is the concept of block assessment. So today's topic is appeals and revision. And I will also discuss with you equalization. These two topics we are going to discuss. Yes, let's complete this lengthiest chapter. Always appeal will be first preferred by SSC only. Normally, like assessment will be done regular assessment, scrutiny assessment, or best judgment assessment, or income assessment, or block assessment. Once assessment is completed, then what assessing officer will do? Assessing officer will give assessment order. Along with the assessment order, if any tax is payable or if any interest is payable, along with assessment order, demand notice will also be. So the point here is, once you receive assessment order, within 30 days, you need to pay the tax to the department. But whatever the assessment order that you have received, with the assessment order, SSC is not satisfied. Then what SSC can do? SSC can file appeal to CIT appeals or JCIT. If he is not satisfied, then he has an option. Two options. Within 30 days, make payment, or within 30 days, he can file appeal to CIT appeals or JCIT appeals. So always remember, first the appeal will be filed by SSC only. Department will never file. Once department issues assessment order and demand notice, if SSC is not happy, if SSC is not satisfied, if he wants to dispute any matter that is concluded by department, then SSC can file appeal with CIT appeals or JCIT appeals within 30 days from date of receipt of assessment order. Now, next question is, sir, when can they file appeal to CIT appeals? When can they file appeal to JCIT appeals? If assessment order, if this is passed by joint commissioner or with approval of joint commissioner. See, who passed the assessment order? Joint commissioner. Or assessment order was passed with the approval of joint commissioner. Whenever assessment order is passed with the approval of joint commissioner, it is to be challenged with higher authority. So, whenever any assessment order is passed by JC or with the approval of JC, then it will be challenged with CIT appeal. CIT. If any assessment order is passed by income tax authority below rank of JCIT, below rank of JC. That means below joint commissioner, assessment order was passed by assistant commissioner or deputy commissioner, or assessment order was passed by income tax officer. In this case, it can be challenged with CIT appeals. Sorry, it can be challenged with JCIT. Logic is very simple. Who is passing the assessment order? The person, the income tax authority who passed the assessment order, above his authority, it will be challenged. If it is passed by JC, above JC, who is the authority? Commissioner. So it will be challenged with CIT appeals. If assessment order is passed by officer below the rank of JC, assistant deputy commissioner or ITO, it will be challenged with JCIT. I hope now you understood when appeal is to be filed with JCIT and when appeal is to be filed with CIT. Are you clear? Next. Assessment order passed. Now, SSC not satisfied. He will file appeal with CIT appeals or JCIT. Now, CIT or JCIT will give their order, right? Against this order, either SSC or department can file appeal. Are you able to understand? Always first appeal will be filed by SSC. To whom SSC will file appeal? CIT appeals or JCIT appeals. Next, once the matter is concluded by CIT appeals or JCIT appeals, CIT appeals or JCIT appeals will pass their order. Whatever the order passed by CIT appeals or JCIT appeals is there, it can be challenged either by SSC or by department. Let's say CIT appeals passed order in favor of SSC. Then what department will do? Department will challenge it at ITAT. Are you able to understand? Or CIT appeals passed order in favor of the department. Then what SSC will do? SSC will challenge the order of CIT appeals or JCIT appeals at ITAT level. Are you able to understand? So against this order, either SSC or department, they can challenge it at ITAT, Income Tax Appellate Tribunal. At ITAT, this is the ITAT is the last fact finding authority. What do you mean by this? See, there are 2 points: question of law, question of fact. Question of fact. Against question of fact, maximum you can file appeal till ITAT level. Against question of fact, you can file appeal to CIT appeals or JCIT appeals. You can file appeal to ITAT, but you cannot file appeal to High Court. You cannot file appeal to Supreme Court. So against question of fact, maximum you can file appeal up to Income Tax Appellate Tribunal. Beyond Income Tax Appellate Tribunal, you cannot file appeal with regard to question of fact. With regard to question of law, you can file appeal to CIT appeals or JCIT appeals. You can file appeal to ITAT. You can file appeal to High Court. You can also file appeal to Supreme Court. Are you able to understand? Sir, what do you mean by question of law? What do you mean by question of fact? Question of fact means something which is which requires evidence. Let's say, like, income tax officer came to office for doing assessment. Income tax officer is saying bogus expenditure. SSC is saying he incurred expenditure really. So whether expenditure was really incurred or not, we need to examine the documents, we need to find out the evidence, we need to find out the fact whether expenditure was actually incurred or not. So this is question of fact. Are you able to understand? Next, SSE is saying he did not do sales, but income tax officer is saying sales was done, but sales were not recorded in books of accounts. So now we need to do investigation whether sales were actually done or not. So that is question of fact, whether it really happened or not, whether it is really in existence or not. That we call as question of fact. Next, sir, what do you mean by question of law? Expenditure P is there. SSE is saying revenue expenditure, department is saying capital expenditure. Now it is question of law whether that expenditure is revenue expenditure or capital expenditure, that need to be determined based on law. So this type of question we call as question of law. Are you able to understand? So difference is there, question of law, question of fact. Question of fact means what? Whether that particular thing is really there or not, whether particular transaction is really happened or not, whether any transaction is in existence or not, that we call as question of fact. Question of law means what? Something like uh, we need to interpret. So if there is question of law, like that means what? Two plausible interpretations are there. Department is interpreting in one way, SSC is interpreting in another way. So with regard to this, the ITAT or like appellate level is required to give the judgment. So this we call as question of law. With regard to question of law, you can file appeal up to Supreme Court, but with regard to question of fact, maximum you can file appeal up to uh, income tax appellate tribunal. After income tax appellate tribunal, you cannot file appeal to High Court. However, you can file writ petition with regard to question of fact in High Court. Are you able to understand? How to file appeal to CIT appeals or JCIT appeals? You have to file appeal in form number 35. In form 35 along with fees. You need to make application for appeal in form number 35 along with appeal. Sir, what are required to be given in form number 35? In form number 35, we need to give four items. First, we will give assessment order. Whatever the assessment order that we are challenging, that should be given. Second, we need to give statement of facts. Statement of facts means what? For example, I incurred expenditure P. That expenditure is disallowed by income tax officer. My contention is expenditure should be allowed. It is revenue expenditure. Now, assessing officer disallowed it. Now, I am filing appeal to CIT appeals or JCIT appeals. I will write the facts. So, my company name is ABC and Co. I am doing so and so business. In this business, I incurred expenditure P, which is to be allowed as deduction. Okay, but income tax officer disallowed that expenditure. I will write what actually happened. What is the point that I actually wanted to challenge? That I will write in the form of statement of facts. And I will also write grounds of appeal. Sir, what do you mean by grounds of appeal? That means grounds of appeal means what? On which basis I am challenging the assessment order. As per so and so Supreme Court, expenditure P is allowed as deduction. So in my case also, expenditure P should be allowed as deduction. So on which basis I am saying expenditure P is revenue expenditure? On which basis I am asking department that expenditure P should be allowed as deduction? I can give reference of case laws in grounds of appeal. Along with that, I need to also submit challan. See, whenever you wanted to file appeal with CIT appeals or JCIT appeals, you need to pay some fees. Okay, only after payment of fees that appeal will be accepted. Are you able to understand? Sir, how much is the fees? If assessed income is up to 1 lakh, assessed income up to 1 lakh, fees for CIT appeals or JCIT appeals. How much is the fees? Fees is 250 rupees. If assessed income is more than 1 lakh and up to 2 lakh, then fees for filing appeal is 500 rupees. If assessed income is more than 2 lakh rupees, then fees for filing appeal is 1000 rupees. Are you able to understand? So we need to pay the challan. If we want to challenge it at CIT appeals or JCIT appeals, we also need to pay fees. Assessed income up to 1 lakh, fees is 250. More than 1 lakh up to 2 lakh, fees is 500 rupees. Above 2 lakhs, fees is 1000 rupees. We need to pay fees, and along with that, we also need to file the appeal. In which form we will file appeal to CIT appeals or JCIT appeals? In form number 35. 4 items. What are they? Assessment order that we are challenging, statement of facts, grounds of appeal, challan. Okay, all these 4 are required to be given. Harlan. I'm sorry. So where am I? Yeah, I'm speaking with regard to fees. Now, what will happen? I will file. So I will file appeal along with. I will file appeal to CIT appeals or JCIT appeals along with 4 documents. Then what CIT appeals will do? CIT appeals or JCIT appeals will pass their order. Once such order is passed, now this is the problem. I will lose the flow. Yeah, CIT appeals or JCIT appeals will pass the order. Next, sir, is there any time limit for CIT appeals or JCIT appeals to pass the judgment to give the order? Yes, there is time limit within 1 year. Within 1 year from end of the financial year in which appeal is filed with CIT appeals or JCIT. What do you mean by this? And this time limit is not mandatory time limit, it is advisory time limit. That means CIT appeals are so busy, they could not give judgment within 1 year from end of financial year in which appeal is received. Then also it is fine. General, basically, if you file appeal with CIT appeals or JCIT appeals, sometimes it becomes early, sometimes judgment will also come after 2 years or 3 years. So whatever this time limit within 1 year from end of financial year in which appeal was filed, that is only advisory time limit. Okay, that is not mandatory time limit. Next, see, CIT appeals or JCIT appeals will pass order. Na, this order can be challenged by department or SSC. Okay, now what is the time limit for filing appeal with ITAT? With regard to this, there is an amendment. From 1st October 2024, amendment was there. So, like department or SSC can file appeal with ITAT. What is the time limit? Before 1st October 2024, appeal is to be filed within 60 days. Is to be filed within 60 days from date of receipt of order. But on or after 1st October 24, there is an amendment. Like within 2 months, from end of the month in which order is. That means what? I will tell one example. Before 1st October 24, let's say CIT appeals or JCIT appeals order was received today, 29th July 2020. Now within 60 days, I need to file appeal to ITET. However, on or after 1st October 2024, I am getting 2 months time limit. That 2 months time limit is not to be calculated from date of receipt of order, but it should be calculated from, like, 2 months is to be calculated from end of the month in which order is received. Let's say 29 July 2025, end of the month means 31st July 2025. From here, 2 months. That means 31st August, 30th September 2025. Are you able to understand? So this is the variance. There is an amendment. Probably you would have taken coaching for earlier Finance Act. If you take coaching like that, please get updated. Okay. So from 1st October 2024 onwards, if you want to file appeal to ITET, what is the time limit? Within 2 months from end of the month in which order CIT appeals order is received. Before 1st October 24, within 60 days from date of receipt of CIT appeals or JCIT appeals order. You will understand. See, generally in CIT appeals or JCIT appeals, judgment will be given by one person. Judgment by, but in ITET, judgment is not given by single person. Judgment will be given by two or more persons who are called as bench. So when you see some case laws or when you read some case laws, you can observe like special bench of ITET has given decision like this. So like in CIT appeals, JCIT appeals, only one person will hear the argument. But in case of ITET, the argument will be heard by bench consisting of either two judges or more than two judges. But if assessed income, if total income is less than or equal to 50 lakhs, even in ITET also, matter will be heard by single judge. Matter heard by single member. But if total income is more than 50 lakhs, okay, total income is more than 50 lakhs, then in ITET, the matter will be uh, heard by bench. Bench means what? Group of two or more members. Matter will be heard by bench. Bench consists of minimum two members and it will be enhanced either two, three, four, five, like that members can be there. Like generally bench consists of two members. Out of two members, one is accountant member, another one is technical member. Accountant member, technical member. Okay. Generally, accountant member will be a chartered accountant in practice who is having more than 25 years of experience. A technical member can be, lawyer, advocate who is having more than 10 years of experience. He will be appointed as a technical member. He is also called as judicial member. Accountant member, judicial. Now, you will get one doubt. Sir, with regard to one matter, accountant member is saying expenditure is to be allowed. Technical member is saying expenditure is to be disallowed. That means what? Here there is tie. One member is saying allowed, another member is saying disallowed. In this case, this matter will be referred to ITAT president. Then ITAT president will include another member, one more member. Then that member is required to give his judgment based on majority. That judgment will be passed by ITAT. Are you able to understand? Next, if bench consists of three judges or like five judges or seven judges, like that odd number, then there is no problem. Obviously, there will be majority opinion. Based on that majority opinion, ITAT order will be. Are you able to understand? Next thing is memorandum of cross objection. Sir, In shortcut, I call this as MOCO, Memorandum of Cross Objection. Sir, what do you mean by Memorandum of Cross Objection? Let's say CIT appeals passed order. Now I have time now to file appeal to ITAT. So SSC filed appeal with ITAT. Within 60 days only, he filed the appeal. Now, what ITAT will do? ITAT will give notice to department. What it will tell, like ITAT will tell, so and so Umasankar SSC, he challenged the order of CIT appeals or JCIT appeals. This communication will be sent to income tax department. Now what income tax department can do? Within 30 days, income tax department can file memorandum of cross objection. So in that memorandum of cross objections, whatever the appeal that I filed, against that department can file memorandum of cross objections, or vice versa. Vice versa means what? Department challenge. CIT appeals judgment came in favor of SSC. Now department filed appeal in ITAT. Whenever department files appeals at ITAT, ITAT will give notice to the SSC that department has filed like appeal to ITAT. Then within 30 days, I can challenge the department by filing a memorandum of cross objection. Sir, what do you mean by this? I will tell one point. Listen very carefully. Let's say expenditure A is there. This is to be allowed. This is to be allowed as per Supreme Court judgment. But a assing officer disallowed it. Assing officer asked me bribe. I did not give the bribe. The assing officer disallowed it. Then what I did, I challenged this assessment order. When I challenged this assessment order, CIT appeals gave judgment in favor of me. It gave judgment in favor of SSC. Because that expenditure is to be allowed as per Supreme Court judgment. So CIT appeals gave judgment in favor of the SSC. Now, whatever the order passed by CIT appeals is there, this order is challenged by department with ITAT. Now, what ITAT will do? ITAT will give notice to me. ITAT give notice to SSC. What it will tell in the notice? Sir, like department challenged the order passed by CIT appeals or JCIT appeals with regard to expenditure A, it will tell. Now what I will do? I will file memorandum of cross objections. I will tell, sir, dear sir, who are there in ITAT, like department is wasting your prime time. Already Supreme Court judgment is there. Expenditure A is to be allowed as deduction. So that is the reason I won case in CIT appeals or JCIT appeals. Like department have some grudge on me. That's why department is again filing the appeal at ITAT level. Now I will tell entire this information to ITAT. I will file memorandum of cross objections. If you see movies relating to court, okay, memorandum of cross objections means what? If like opposition lawyer files anything, I can counter it by filing memorandum of cross objection. So here what is happening? Department is challenging expenditure A, which is allowed as deduction as per Supreme Court judgment, which is also allowed in CIT appeals order. Now it is wasting court's prime time. It is having grudge on me. That's why it filed appeal at ITAT. Now I will tell to appeal. I will file memorandum of cross objections. In that I will tell department intentionally wasting ITAT time. That expenditure is allowed as deduction as Supreme Court judgment. Then in such case, if it is valid, ITAT may dismiss the appeal filed by department. Are you able to understand? Same, vice versa. Like if I file any appeal to waste ITAT's time, then also department can file memorandum of cross objection. Are you able to understand? So I hope you understood the concept of memorandum of cross objection. Did you understand? Of course, these are theory chapters. For these theory chapters, you cannot expect so much of interesting stuff. These are like this only. Stay of demand. You will get another doubt. Sir, are we required to pay any fees for filing memorandum of cross objections? No, you are not required to pay any fees. Without paying any fees, you can file memorandum of cross objection. Is it clear? Stay of demand. What do you mean by stay of demand? Now, assessing officer passed assessment order. Along with assessment order, if I am required to pay any tax or interest, what assessing officer will do? He will also issue demand notice. Whatever the demand notice that is given, within 30 days from date of receipt of demand notice, within 30 days I have to make payment. Now, I am not happy with the assessment order. What can I do? If I am not happy with the assessment order, then what I will do? I will file appeal with CIT appeals or JCIT. Now, I can file appeal within 30 days. Now, CIT appeals or JCIT appeals, they will take 1 year or more than that to give their judgment. Now, department will run after. Department will call me continuously. 30 days is over. You need to make payment of taxes. So now what can I do? I can apply for stay of demand with CIT appeals or JCIT appeals. So I will apply to CIT appeals. Sir, actually I need to pay 30 lakh rupees tax, but I challenged the order passed by assessing officer as the matter is pending with CIT appeals or JCIT appeals. See, if you give the judgment that I need to pay 30 lakhs, on that day I will pay 30 lakhs. But at present, department is calling me continuously. Department is running after me to pay 30 lakh rupees. Kindly give stay of demand. I will request with CIT appeals or JCIT appeals. When I request like that, CIT appeals or JCIT appeals, they can give stay of demand for 30 lakh rupees. That means like actually I need to pay tax within 30 days from date of receipt of assessment order, but if I get stay of demand from CIT appeals or JCIT appeals, I can wait. Okay, so like he will tell up to what time the demand is stayed. Till that time department will not ask me to pay taxes. Are you able to understand? Generally CIT appeals or JCIT appeals also have power to grant stay, but that is not there in our syllabus. What is there in our syllabus is ITET has power to grant stay of demand. Are you able to understand? I will tell another point. CIT appeals or JCIT appeals passed order in favor of department. Now, what SSC will do? SSC challenges this order. Where he challenges this order? SSC challenges this order at ITET level. Now, judgment came in favor of department. Immediately department will start calling me. It will ask me to pay taxes as 30 days is over. Now I challenged it. Within 60 days I challenged the matter with ITET. Now I will request ITET to give stay of demand. Stay of demand means what? Whatever the taxes that I need to pay, I am not required to pay immediately. Once the court gives judgment, once the ITET gives judgment, then based on that judgment, if I am required to pay, on that day I am required to pay. So till the time matter is concluded, I will be temporarily exempted from payment of taxes. That concept we call as stay of demand. So what I will do, I will request stay of demand from ITET. Okay, so whenever I request stay of demand from income tax appellate tribunal, then income tax appellate tribunal will grant stay only if I pay minimum 20% of tax plus interest. So whatever the assessment order is there, in that assessment order, I will be required to pay tax and interest, right? If I minimum pay 20% of tax plus interest, then ITET will grant stay of demand from me. That means balance 80%, even though I do not pay now, fine. Once the judgment comes at that time, If judgment came in favor of department, then I am required to pay balance 80%. Are you able to understand? So ITET has power to grant stay of demand, but SSC should minimum pay 20% of tax plus interest, or SSC should give security for minimum 20% amount of tax plus interest. Then department can grant stay of demand. Are you able to understand? Sir, maximum how much period department can grant? Department can grant stay for 180 days. That means once, sorry, not a department, ITAT can grant stay of demand for 180 days. So once I get stay of demand from ITAT for next 180 days, department will not call me. Department will not ask me to pay tax liability. But after 180 days, like whether see, whenever there is hearing, I am going, or my chartered accountant is going, but department is not coming, or there is COVID-19, all courts were closed. So that's why the hearing was not happening. So like genuinely I am coming to the court, but department is not coming, or I wanted to come to the court, but court is closed, ITET appellate tribunal is closed. Then even after 180 days also, whatever the stay of demand is there, it will not be vacated, it will be continued. So it will be continued, but maximum stay that can be granted is 365 days. Maximum stay allowed is 365. See, whatever generally stay will be granted for given for stay of demand will be given for 180 days. But if there is no mistake on part of the SSC, it can be further extended and up to maximum 365 days. Sir, you all know about Indian judiciary system. It will take longer years for a matter to get concluded, for a judgment to come. So, like 365 days also over, but no judgment was given by ITET. Now the question is, after 365 days, whether stay of demand gets vacated. Vacated means what? Gets completed, or still it will be continued. Actually, as per income tax law, maximum grant of stay of demand that ITET can grant is 365 days. But there is one Supreme Court case law. In that Supreme Court case law, Supreme Court held that even after 365 days also, if there is no mistake on part of the SSC, then stay of demand will be continued even after 365 days. Are you able to understand? So it will be continued as per Supreme Court case law if there is no mistake apparent on record on part of SSC. Then even after 365 days also, stay of demand will be continued. Let's say like I am the SSC. Every time there is hearing, I am going to the income tax appellate tribunal, but department is not coming. Sometimes department is coming, but COVID-19 due to various issues, that day session is getting closed. Now what can I do? Like see, if judgment came in favor of department, I am ready to pay tax. But 365 days is over, but the matter is not concluded. In this case, Supreme Court held that even after 365 days also, stay will continue if there is no mistake apparent on record on part of the SSC. Able to understand the concept of stay of demand. Now we are going to discuss our another point. What is the time limit for to give judgment for CIT appeals or JCIT appeals within 1 year from end of the financial year in which appeal is filed? Am I correct? For ITET, the time limit available is 4 years. Are you able to understand? So ITET has to give judgment within 4 years from end of financial year in which appeal is filed. Sir, whatever this 4 years time limit is there, is it mandatory time limit? It is only advisory time limit. That means ITET should try to give judgment within 4 years from end of financial year in which appeal is filed. Even if it gives judgment after 4 years, still it is valid, because whatever the time limit is there, that is not mandatory time limit. It is just only advisory time limit. Is it clear? Next, we are going to discuss powers of CIT appeals and JCIT appeals and powers of ITET. CIT appeals or JCIT appeals and power of C. CIT appeals can confirm assessment order. ITET also can confirm assessment order. CIT appeals can reduce assessment order. ITET can also reduce assessment order. CIT appeals can enhance assessment order, but ITET cannot enhance. What do you mean by this? I will tell one example. As per assessment order, total income is 50 lakh rupees. CIT appeals or JCIT appeals, ITET. Sir, can CIT appeals keep the income as 50 lakh rupees? Yes, possible. Can ITET keep the income as 50 lakh rupees? Possible. Can CIT appeals reduce income to 40 lakhs? Possible. Can ITET reduce income to 40 lakhs? Possible. Can CIT appeals increase the income compared with assessment order 60 lakhs? Possible. Can ITET increase the income up to 60 lakh rupees? Not possible. Are you able to understand? That means CIT appeals or JCIT appeals, they have power to enhance the assessed income, but ITET do not have any power to enhance the are you able to understand? So CIT appeals, JCIT appeals, either they can increase the income or confirm the income or decrease the income, but ITET cannot do any harm to the SSC. Either ITET will tell income is as per assessment order, or ITET can reduce the income, but ITET do not have any power to enhance the assessed income. Are you able to understand? Second power. Sir, whether CIT appeals or JCIT appeals have power to set aside assessment order. Power to set aside assessment order. Sir, what do you mean by power to set aside assessment order? Assessing officer completed assessment, assessing officer passed assessment order. Now, CIT appeals, JCIT appeals, they wanted to tell whatever the assessment that you have done, it is wrong, and they wanted to order for fresh assessment. Can they order for fresh assessment? CIT appeals, JCIT appeals, they cannot order for fresh assessment. Are you able to understand? They cannot order for fresh assessment. So if there is any problem, CIT appeals, JCIT appeals, they have to do the assessment and they need to give the judgment. They do not have any power to set aside the assessment order, except in case of best judgment assessment. That is also amendment as per Finance Act number 2 of 2024. Are you able to understand? So generally CIT appeals, JCIT appeals, they do not have any power to set aside the assessment order. They cannot order for fresh assessment except only in case of best judgment assessment. Are you able to understand? But ITET has that power. ITET has power to set aside the assessment. Let's say assessing officer name is Monish. Monish has done the assessment, but ITET was not happy with the assessment order passed by assessment done by Monish. ITET can give the judgment, like ITET can pass the order, whatever the assessment order that is passed by Monish that is set aside, ITET can order for fresh assessment by another assessing officer, Varun. Are you able to understand? In this way, ITET has power to give the judgment, but CIT appeals, JCIT appeals, they do not have such power. Okay, except in case of best judgment assessment. That means in case of best judgment assessment, CIT appeals, JCIT appeals, they have power to set aside the best judgment assessment. They can order for fresh assessment. Is it clear? Power to condone delay. Condone delay means what? Let's say I need to file appeal to CIT appeals or JCIT appeals within 30 days. But like let's say due to medical issues, I could not file. If I tell the reason, even after 30 days also, if reason is valid, they can admit application for CIT appeals or JCIT appeals. The same is the case with ITET. You need to file appeal within 60 days, but due to medical grounds you could not file. Then it can entertain the appeal even if it is filed after 360 days, or even if it is filed after 60 days if reason is valid. Are you able to understand? Power to make inquiries. What do you mean by power to make inquiries? Let's say assessment order passed and the matter came before CIT appeals or JCIT appeals. If CIT appeals, JCIT appeals, if they want any extra information to pass the judgment, can they get that extra information? Yes, they can get that extra information. They have power to do inquiry of SSC as well as department. Same is the case with ITET. ITET also have power to do the inquiry if it is necessary before passing the judgment. Next. Power to grant stay of demand. CIT appeals can grant stay of demand. ITET also can grant stay of demand. Next, power to reject appeal. That means like it is already evident. We discussed memorandum of cross objections. So because of silly reasons, if any appeal is filed with CIT appeals or ITET to get the grudge done, if any appeal is filed, they have power to cancel the appeal also. So whatever the appeal filed, that will be rejected. They have power to reject the appeal. Next, power to admit additional evidence. Do they have power to admit additional evidence? Yes. CIT appeals have power to admit additional evidence. ITET has also power to admit additional evidence. I will tell one example. Like income tax officer, he has written the observation, sales, dummy sales were done by Mr. Umasankar. Now, like I forgot to enter that bill in my GST return. For that sake, department has written, like assessing officer has written, I have done dummy sales. Now I requested, sir, please listen. I have raised e-way bill also. Goods are transported from Vijayawada to Hyderabad. Please look at this e-way bill. That is the mistake done by my accountant. He forgot to enter that in my GST return. That does not mean I have not done sales. I have done sales. Please look at the evidence. E-way bill is also there. I wanted to show to income tax officer, but income tax officer did not listen to me, did not even hear me. He straight away wrote the point. He passed the assessment order. I have made dummy sales. Now, like he did not give me opportunity of being heard. Now I will challenge this with CIT appeals or JCIT appeals. I will request CIT appeals or JCIT appeals to give me opportunity of being heard. When they give me opportunity of being heard, at that time I will show the actual e-way bill. So they have power to admit additional evidence from the SC. Are you able to understand? So CIT appeals, ITET, they have power to admit additional evidence from the SC as well. Are you able to understand? So these are the various powers. Next. ITET passed assessment order. Sir, income tax appellate tribunal passed assessment order na. SSC, like let's say, can this be challenged? This can be challenged only if it is question of law. It can be challenged at High Court. Okay, if it is question of fact, it cannot be appealed. Cannot be appealed at High Court. See, even though it cannot be appealed at High Court, however, writ petition can be filed. With regard to question of fact, a writ petition can be filed by. Sir, against ITET order, I can file appeal against High Court, either SSC or department. Any one of them can file appeal against order passed by income tax appellate tribunal. What is time limit? The time limit to file appeal is within 120 days from date of receipt of order order of income tax appellate tribunal. Let's say today I received order of ITAT. From today onwards, within next 120 days, I have to make appeal to High Court against the order of ITAT. Are you able to understand? Power to review. Power to review. Sir, what do you mean by power to review? We are discussing with regard to expenditure A, debate is going on. SSE saying expenditure A to be allowed as deduction, department saying expenditure A is to be disallowed. CIT appeals or JCIT appeals, they also disallowed the expenditure. Next, ITAT. ITAT also disallowed the expenditure. Now, you can see in some cases, even though judgment is given by Supreme Court, you can request Supreme Court to review its judgment. Reviewing its judgment means what? Already judgment that is passed. If there is any new evidence that they came to know after judgment is passed, then Supreme Court can review its judgment. Supreme Court can pass modified judgment or it can give altered judgment. But that power is not there with CIT appeals or JCIT appeals or ITAT. See, CIT appeals passed order. Whatever the order passed by CIT appeals is there, it is final. You cannot request CIT appeals to review its judgment. Power to review their own judgment is not possible in case of CIT appeals or JCIT appeals. Power to review judgment is possible only with High Court or Supreme Court. That means what? Only High Court or Supreme Court has power to review their own judgment, but CIT appeals, JCIT appeals, ITAT appeals, if they pass any order, that order is final. They do not have any power to review their own judgment. Are you able to understand? So that is the concept. Now, what High Court will do? High Court will give its order only with regard to question of law. Whatever the order that is passed by High Court is there. With this order, SSC or department are not satisfied. Then can it be further appealed? Yes, it can be. They can file appeal to Supreme Court. Within how many days? Within 90 days, they should file appeal to Supreme Court. Are you able to understand? So that is the, and Supreme Court also have power to review its own. Is it clear? I hope till here you are clear. This is the part relating to appeals. Next, I will discuss with you revision. So, with regard to appeals part, are you clear? I think today only few viewers are there considering this entirely theoretical concept. Should we remember powers of all departments? No, you need to remember powers of only CIT appeals. Very easy. You can remember. Shall I start with the revisions part? Now, revision. There is revision under section 263 and there is also revision under section C. Now, first I will discuss revision under section C. Assessing officer. Who is assessing officer? Additional Commissioner of Income Tax or Joint Commissioner of Income, Assistant Commissioner of Income Tax, Deputy Commissioner of Income Tax, Income Tax Officer. Now, these people, they can pass, they pass assessment order. Whatever the assessment order passed by additional like assessing officer is there, this assessment order can further be reviewed by bosses or top bosses. Bosses means CIT or PCIT. Top bosses means CCIT or principal chief commissioner. Or like the assessing officer means CIT appeals, JCIT appeals, and sorry, assessing officer means additional commissioner, joint commissioner, assistant commissioner, deputy commissioner, income tax officer. Like we discussed income tax authorities concept. In income tax authorities concept, I have given you one table. In the table, we have discussed very clearly. You can see this table. Who are assessing officer? Additional commissioner, joint commissioner, assistant commissioner, deputy commissioner, income tax officer, additional director, joint director, and assistant director, deputy director can also be considered as officer. Bosses means CIT, PCIT. Top bosses means CCIT, PCCIT. Okay. Now, what happened? Like there is SSE. From SSE, AO took bribe. After taking bribe, AO like reduced total income, and AO also reduced tax liability. So AO gave benefit to SSC. AO gave benefit to SSC by taking bribe. Who is superior to AO? Superior to AO is CIT or PCIT, or uh, top boss is chief commissioner or principal chief commissioner. Now AO passed assessment order na. Whatever the assessment order that is passed by AO is there, it can be reviewed. It can be reviewed by bosses, CIT or PCIT or Chief Commissioner of Income Tax or Principal Chief Commissioner of. Now, when bosses are reviewing, they came to conclusion whatever the assessment order that is passed is erroneous. Erroneous means what? Actually, it is clearly evident. Total income of SSC is 10 lakh rupees. But assessing officer took bribe from SSC and he reduced 1 lakh rupees. He decided total income as 9 lakh rupees. Or if we speak in lakhs, it is low. Let's speak in crores. Actually, total income of SSC is 10 crore rupees. But AO, while doing assessment, he reduced income. He reduced income to only 7 crore rupees. 3 crores income is reduced. So on 3 crore rupees, taxes were not paid to income tax department. So like whatever the assessment order passed is there, it can be reviewed by bosses or top bosses. When they are reviewing, bosses or top bosses, they came to conclusion whatever the assessment order that is passed is there, that is erroneous. Erroneous means what? Like it was given in favor of the SSC, which should not be given. Okay, so whenever assessing officer has passed the assessment order, then bosses have power to order for fresh assessment. Bosses have power to order for fresh assessment. Now, whenever they order for fresh assessment, it is harmful to SSC. Na? As it is harmful to SSC, opportunity of being heard will be given to the SSC. So, before they order for fresh assessment, they will give opportunity of being heard to the. So, they will give opportunity if SSC wants to tell something, he can tell that to the department before they do fresh assessment. Able to understand? Sir, is there any time limit to pass revision order under section 263? Now, department like bosses can pass revision order under section 263. What do you mean by this? Then bosses will do the assessment. Bosses will increase the assessment. Bosses will tell total income is 10 crores and bosses will increase the tax liability. Whatever the increased tax liability is there, that is to be payable by the SSC. But before passing revisionary order under section 263, opportunity of being heard will be given to the SSC. Are you able to understand? Sir, is there any time limit? Yes. Bosses can do revision within 2 years from end of assessment year in which order is passed. What do you mean by this? Let's say assessment order passed on today. Let's say assessment order passed on 29th July 2025. What is end of assessment year? End of assessment year is 31st March 2026. From 31st March 2026, 2 years. That means up to 31st March 2028, bosses have power to pass the revisionary order under section 263. That's why normally in our offices, if assessment is completed, we will do party. Hammaya, happy, assessment got completed. Okay, client will also do celebration. But we should tell client, don't celebrate. Whatever the order passed by assessing officer is there, that is not final. It can be revised by bosses or top level bosses within 2 years from the end of the year in which assessment order was passed. So once assessment order is passed, most 95% of the times it is safe. Balance 5%, bosses have power. They can review the file. Okay, they can review the file and they have power to revise the assessment order within 2 years from the end of the assessment year. And before revising the assessment order, they will give opportunity of being heard to the. Are you able to understand? So till here, did you understand? Next, I will explain you doctrine of partial merger and total merger. No parties till 2 years gets passed. Not 2 years, 2 years from the end of the year in which assessment order is passed. I can understand the topic is very boring to you. I can help, kindly bear with me. That's all I can tell. I can't skip explaining the topic. Now, I will explain you doctrine of partial merger. Sir, what do you mean by doctrine of partial merger? Doctrine of partial, let's say assessment order was passed with regard to matter A, matter B, matter C, and matter D. Now, with regard to matter A and B, already appeal filed and it is pending at ITET. With regard to appeal C and D, there is no appeal was filed. Now, bosses, they wants to do revision. Wanted to do pass revision order under section 263. Now, can they pass revision order against matter A and B? They cannot pass. They cannot pass because they are already pending with CIT appeals or JCIT appeals. They wanted to pass revisionary order against matter C and D. Can they pass? Yes, they can pass. Are you able to understand? So, why they can pass revisionary order? Revisionary order can be, but they cannot pass revision order against matter that is already pending with income tax appellate tribunal or CIT appeals. Are you able to understand? So this concept we call as doctrine of partial merger. That means with regard to any assessment order that is passed, whatever the matters which are pending with CIT appeals or ITET or High Court or Supreme Court are there, those matters will merge with higher authority. With regard to those matters, like CIT, like with regard to those matters, bosses have no power to pass revised assessment order. Bosses have power to pass revised assessment order only against those matters which are not challenged at any appellate level. Are you able to understand this concept, doctrine of partial merger? Sir, what partial merger? Whatever the matters that are pending with appellate authority is there, those matters will merge with appellate authority against balance matters, as like bosses can pass revisionary order. Are you able to understand this concept? We call as doctrine of partial merger. Is it clear? Shall I explain section 264? Revision of other order. Generally, section 263 is in favor of department. Section 264 is in favor of S. Sir, what section 264 says? See, many times AO will pass the assessment order without listening to SSC. In that case, once assessment order is passed, AO, like SSC can file, SSC can request bosses, sir, AO passed the assessment order without listening to me. Please give some benefit to me. Please review this and please pass the revisionary assessment order. That income, like now, let's say section. Give me 1 second. What can I do? There is lot of disturbance. Like assessing officer passed assessment order. He disallowed expenditure B. Actually, expenditure B is allowed as per High Court. But so, what is the option that is available with me? I can file appeal to CIT appeals or JCIT appeals within 30 days. But I have so many things. I have classes, I have practice to handle. So many things are there. I forgot to file appeal with department with CIT appeals or JCIT appeals within 30 days. Now, after 30 days, can I file appeal to CIT appeals or JCIT appeals? Not possible now. I cannot file appeal with CIT appeals or JCIT appeals. Then what I will do, I will request bosses or top bosses to review assessment order passed by assessing officer, because expenditure B is allowed as per Supreme Court decision, but assessing officer disallowed it and he passed the assessment order. Now I do not have time to challenge the same at CIT appeals or JCIT appeals. Then last option that is available to me is I can request bosses to review the assessment order passed by assessing officer. Now bosses, it's up to their decision. If bosses wants to review the assessment order, they will review the assessment order, or they may ignore my application also. So it is not mandatory on part of bosses to review the assessment. Next. So if bosses review the assessment order, they cannot harm SSC. They cannot harm SSC means what? Like as per assessment order, total income is 80 lakhs. But whenever they review, they will pass revision order under section 264, right? As per revision order under section 264, total income is 90 lakhs. Can they increase total income when they pass revision order under section 264? They cannot increase the total income. Are you able to understand? Either they will keep total income as 80 lakhs or they can reduce the total income. Like they can reduce the total income to 60 lakhs or 65 lakhs. They can reduce. That means as per revision order under section 264, bosses, they cannot do any harm to the SSC. Either they will keep the income as it is or they will reduce the income. They do not have any power to enhance the income as per revision order under section 264. Practically 264 revision order hardly it will be passed, okay, because why income tax officer will show interest in giving favor to the SSC? He will not show. So but that provision was written in the act. What can we do? We need to learn that power is available with bosses or top bosses. Are you able to understand? So generally, after assessment order is passed, within 30 days, I have power. I can make appeal with CIT appeals or JCIT appeals. For example, if I do not file appeal within 30 days, afterwards, last remedy available to me is I can request income tax like commissioners, bosses or top bosses to review the judgment passed by, to review the order passed by assessing officer. In that case, if they show interest, they will review. Otherwise, they will not review. Now they will pass revision order. Now whatever the revision order that is passed under section 264, sir, can it be challenged? It cannot be challenged. Whatever this order passed is there, that cannot be. Are you able to understand? Let's say assessment order was passed for 4 matters: matter 1, matter 2, matter 3, matter 4. Sir, with regard to matter 1 and 2, I filed appeal with ITET. I filed appeal with ITET. With regard to matter 3 and 4, I wanted to make application for revision order under section 264. Can I do? I cannot do. Are you able to understand? This concept we call as doctrine of total merger. That means with regard to any assessment order on any one matter, if I file any appeal with ITET or CIT appeals or High Court or Supreme Court on that entire assessment order, I will lose the power to make application for revision order under section 264. That means with regard to any one matter, I file appeal with ITET, High Court or Supreme Court, all matters will get merged with higher authority. I cannot make revision application under 264. This concept we call as doctrine of total merger. Are you able to understand? So this is revision under section 260. Now, one practical doubt many students ask, sir, judgment came in favor of the SSC. Then department will file appeal with ITET, High Court or Supreme Court, right? For every judgment that came against department, will it file appeal with ITET, High Court or Supreme Court? No. Generally, if tax effect is more than 50 lakh rupees, then department will file appeal with ITET. If tax effect is more than 1 crore rupees, then department will file appeal with High Court. If tax effect is more than 2 CR, then department will file appeal with Supreme Court. See, judgment came in favor of SSC and against department. Whenever judgment comes against department, then department will file the application, like department will file the appeal, right? So normally in every case, department will not file the appeal based on monetary limits. If tax dispute is up to 50 lakh rupees, okay, it will not file any appeal. If tax dispute is more than 50 lakh rupees, then department will file appeal with ITET. If tax dispute is more than 1 crore rupees, then department will file appeal with High Court. If tax dispute is more than 2 crore rupees, then department will file appeal to Supreme Court. There is one amendment, there is one circular with effect from 17th September 2024. This is also recent amendment which was made in Finance Act, not in Finance Act. It was issued by way of circular, but relevant to your attempt. Before your attempt, this amendment was not there. Okay, so with effect from 17th September 24, if tax effect is more than 60 lakhs, then department will file appeal with ITET. If tax effect is more than 2 crore rupees, department will file appeal to High Court. If tax effect is more than 5 crore rupees, then department will file appeal to Supreme Court. Are you able to understand? This is the now. This is the concept relating to appeals and revisions. Now, shall we start discussing about equalization levy? Everybody, are you clear till here? Equalization. See, you know one concept we discussed in DTAA, double taxation avoidance agreement. Only in case of foreign company, is it required to pay tax in India? Yes, it is required to pay. కొంచెం మంచి ఫన్నీ ఎగ్జాంపుల్స్తో చెప్పండి. దిస్ ఈజ్ నాట్ రెగ్యులర్ క్లాస్, దిస్ ఈజ్ రివిజన్ క్లాస్. ఓకే, సో ఇన్ రెగ్యులర్ క్లాస్ వీ కెన్ హ్యావ్ ఫన్, బట్ ప్లీజ్ డోంట్ ఎక్స్పెక్ట్ ఇన్ రివిజన్. I have less time to revise all concepts. In this less time, you are expected to do comment. Equalization levy. See, foreign company is required to pay tax in India only if it has permanent establishment in India. So, when foreign company is required to pay tax in India only if foreign company is having permanent establishment in India. See, if you remember in DTAA, we discussed one concept. Business with foreign country, business in foreign country. If I make exports to USA, I am not required to pay any tax in USA because I am doing transaction with USA. Second point, like second case, I started a branch in USA. I am exporting goods to my branch. My branch is selling goods in USA. So whenever I open any branch in USA, I am having permanent establishment in USA. Whenever I have permanent establishment in USA, I will become taxable in USA. Are you able to understand? So only if foreign company is having permanent establishment in India, they are required to pay tax in India. Many times what happening, there are big giants na, let's say Google, Microsoft, Meta, all these companies, they are making money in India, but they are not paying taxes in India. Let's say there is my brand Phoenix by Uma. Now subscribers are very low initial stage. I wanted to give advertisement in YouTube, or I wanted to give advertisement in Instagram. So what I did, I gave advertisement. I gave advertisement in Google, Microsoft, or Meta platform. Whenever I give advertisement, I need to make payment. Now, let's say I made payment 3 lakh rupees. Please don't think I made 3 lakh rupees. Definitely, I will not make payment because that will be very huge. For example, I made payment of 3 lakh rupees. This 3 lakh rupees, like Google, Microsoft, Meta, they are earning from Mr. Umasankar, who is located in India. That means these platforms are making money from India, but like Google, Microsoft, Meta, they do not have any offices in India. Okay, they have offices in Hyderabad, but whatever the offices that are there in India, they are just preparatory offices. They do not provide any services in India. Let's say with regard to my YouTube channel, I got any problem. I need to mail this problem to YouTube located in USA, YouTube office located in USA. That means which office is helping me? YouTube office located outside India. It is helping me to resolve my YouTube problems or Gmail problems. Are you able to understand? So these problems are not addressed. Service is not provided by Google Office or Meta Office situated in India. Whatever the Google Office, Microsoft Office that is there in India, it is only providing auxiliary service. It is not providing any services in India. So all these big companies, what they are doing, like they are not having permanent establishment in India. What they are providing all the services from outside India, but they are making money from India. Now what I will do, I will prepare my P&L account. In my P&L account, I will claim advertisement expenditure 3 lakh rupees. But in P&L account of Microsoft, Meta and Google, whether 3 lakhs will be there, 3 lakhs will not be there because they do not have any permanent establishment in India. So what's happening? See, they are making money out of India, and the person who is making payment to these platforms, they are claiming expenditure, but they are not taxable in India because of double taxation avoidance agreement, there is no permanent establishment in India. We have discussed as per DTAA, only if there is permanent establishment in India, then only like outsider, foreigner is required to pay tax in India, otherwise he is not required to pay tax in India. Are you able to understand? So it has become a loophole. Everybody who is doing, like all these big platforms, they are making money out of India. Loophole is they do not have any permanent establishment in India. They are not paying any taxes in India. It has become a loophole. So there is OECD, Organization for Economic Cooperation and Development. So OECD observed that this loophole is there. Using this loophole, big giant companies, they are making huge margins in various countries. So what they are doing, base erosion and profit shifting. They are not keeping permanent establishment in India. They kept permanent establishment in USA. So they eroded the base and they are shifting profits to outside India, and they are not paying taxes in India. So to counter base erosion and profit shifting, they come up with action plan. Okay. So OECD countries, they come up with action plan. One of the action plan is levying of equalization levy. Are you able to understand? So India is one of the countries to introduce the concept of equalization levy. Okay. So India is one of the countries to introduce the concept of equalization. Sir, what do you mean by equalization levy? Non-resident who is not having PE in India, not having PE in, if he provides any online advertisement service, if he provides any online advertisement service to any person in India, or to any non-resident having PE in India, then this non-resident or any person in India, they will make payment to NR having P, NR not having PE in India, right? From this payment, equalization levy is required to be deducted at the rate of 6%. It is just like TDS. See, whenever you are making payment to non-resident, you will deduct TDS at the rate of 6%, right? Same way, whenever any person who is in India or any foreign company who is having PE in India, whenever they are making any payment to non-resident who is not having PE in India, from that payment, why payment was made? For receiving online advertisement services. If they make any payment, from such payment, equalization levy is required to be deducted at the rate of percent. Are you able to understand? Now, for example, like I received online advertisement services, I made payment of 3 lakh rupees. I should not pay 3 lakh rupees. From 3 lakh rupees, I am required to deduct equalization levy at the rate of percent. 3 lakh into 6%, 18,000, right? 18,000 I will deduct. Balance 2,82,000 rupees. This I will pay to Instagram. This I will pay to YouTube, Instagram, or Google, or Microsoft. Are you able to understand? This is the concept. But in practical, what happens? Like Google, Microsoft, they are located in USA. They do not know about equalization levy. They will provide me online advertisement services only if I pay 3 lakh rupees. They will say, boss, I do not know about equalization levy. Pay 3 lakh rupees. We will provide you online advertisement. Otherwise, they will not provide you online advertisement. In this case, what I will do, I will pay 3 lakh rupees. I will assume like actually if I want to pay 100 rupees, I need to deduct 6 rupees equalization levy. I need to pay only 94 rupees. Na? So I will assume 3 lakh rupees at 94. 100% means how much? 3 lakh divided by 94 into 100. Are you able to understand how much? 3 lakh divided by 94 into 100. 3 lakh 19,148 rupees. So 6% means 19,148. From my pocket itself, I will pay 19,148 as equalization. Able to understand? Sir, what if I do not deduct equalization levy? If I fail to deduct equalization levy, entire equalization levy amount I need to pay as penalty. For suppose, in this case, I did not deduct equalization levy, then I need to pay 18,000 equalization levy. In addition to that, I need to pay penalty of another 18,000 rupees. So equal amount will be levied as P. Is it clear? And this provision of equalization levy is applicable only if payment in a financial year is more than 1 lakh rupees. Then only equalization levy concept is applicable. Otherwise, the equalization levy concept is not applicable. Is it clear? Are you able to understand? Uh, hmm. Now, there is Varun. Varun is very interested in marriage. Am I correct, Monish? Varun is there? So Varun is very interested in marriage. Varun has some specific desires. He wants his wife to be in a particular way. He wants his wife to be a chartered accountant. He wants his wife to be fair. He wants his wife to be of certain size, certain height. Okay. He wants his wife to be from south. Okay. He has some, some special desires that he wanted in his wife. So Varun is so rich guy. So what Varun did? So Varun gave advertisement in Instagram. Okay, in Instagram he said requirements of wife. He has written chartered accountant. She should be from south. Okay, she should be having some special height. She should look fair. So all these qualities he has written, and he gave advertisement, and he made payment 5 lakh rupees. Okay, so Varun wants to find one nice girl to get married. So he gave one Instagram post with 5 lakh rupees advertisement. So whatever this advertisement is given, it is completely personal in nature, na. Fantasies and dreams of Varun. Yes. So it is entirely personal in nature, na. So whenever this is personal in nature, even the payment made is more than 1 lakh rupees, still no equalization levy is required to be deducted. Are you able to understand? I did not see Varun. I wanted to see Varun. Manish, send the pic of Varun once. Okay. So the ultimate concept is, if any payment is made for online advertisement, and if the amount of payment made is more than 1 lakh rupees, still if payment is made for online advertisement and such online advertisement is completely personal in nature, then no equalization levy is required to be paid. Is it clear? So this is the concept relating to equalization. So as part of revision series, today I am going to start with DTAA. So I am thinking to discuss four topics: DTAA relief, second one foreign tax credit, FTC, foreign tax credit. Third one, exchange rate for conversion of foreign income into Indian income. Fourth topic, exchange rate for conversion of tax paid in foreign country into Indian currency, INR. Okay, these four topics I am going to discuss with you. After we finish discussing these topics, we are going to solve two problems as well for your better understanding. DTAA very important for your examination. Like easily you can expect more than 10 marks from DTAA. That much important this chapter is. So please listen carefully till the end of this revision class. Okay. Now let's get into the concept. Give me 1 second. Now, sir, what do you mean by DTAA when there exists the concept of double taxation avoidance agreement? See, if one income is taxable in two different countries in the hands of same SSC, then we can say there is double taxation. For example, like Virat Kohli went to Australia, he played in Australia, he earned income in Australia. On that income, Australia will levy tax, India will also levy tax. See, SSC is only one, Virat Kohli. Income earned is also only one. Okay, like man of the match, $10,000. On this $10,000, Australia levied tax, India also levied tax. That means on a single income in the hands of same SSC, if two countries levy tax, then we call that concept as double taxation. See, double taxation is harmful. Why double taxation is harmful? On one income, if two countries levy tax, nobody will show interest in doing cross-border transactions. Nobody will show interest in doing international transactions. So, like double taxation is not at all good. So, countries came forward to provide relief to double taxation. That relief we call as double taxation avoidance agreement. So, like countries, any country will levy tax on two bases, source basis and resident basis. Sir, what do you mean by this? Source basis means the country in which income is earned, that country will levy tax. Resident basis means if a person is resident in India, then that particular country will levy tax on global income of that person. I am Umasankar. I am resident in India. So whatever the income that I earn, Indian income, foreign income, on entire income, I am required to pay tax in India as per which rule? As per resident rule. Are you able to understand? Justin Bieber came to India. Whether Justin Bieber is resident in India? No. Justin Bieber is non-resident. So Justin Bieber earned income in India. So when Justin Bieber earns income in India, he is required to pay tax in India based on source rule. Are you able to understand? So that is resident basis and source basis. Give me 1 second. Next. But there is one exception. What I said, provisions of DTAA or provisions of Income Tax Act, whichever is more beneficial to the SSC are applicable. One exception is tax rate of foreign company. In case of foreign company, what is the tax rate applicable? Tax rate applicable as per Income Tax Act 1961 is 35%. This is recent amendment na. Previously tax rate applicable is 40%, but nowadays tax rate applicable is only 35%. So as per Income Tax Act 1961, tax rate applicable is 35%. Or for example, yeah, as per Income Tax Act 1961, tax rate applicable for foreign companies 35%. As per DTAA, if say tax rate is 25%, in that case 25% not, 35% tax rate is only applicable. What I said? In general, provisions of Income Tax Act or DTAA, whichever is beneficial to the SSC, okay, that is applicable. However, in case of foreign company, just because tax rate is higher in India when compared with the domestic company, you cannot consider it as less favorable charge, and 35% tax rate is only applicable for foreign company. Very simple, students. Like DTAA, income tax, whichever is beneficial, that is applicable. But when it comes to foreign company, even the foreign company tax rate is higher, still DTAA provisions are not applicable. Income Tax Act only applicable. 35% tax rate is applicable. Now you will get one doubt. Sir, in case of foreign company, for every provision, do we need to consider only Income Tax Act? We should not consider DTAA? No, not like that. Only for tax rate. Are you able to understand? In case of foreign company, only for tax rate, Income Tax Act is applicable. For all other provisions of foreign company, either DTAA or Income Tax Act, whichever is beneficial to the SSC are applicable. Are you able to understand? Next, I will tell one example. Let's say a foreign company is there. Example 1. As per Income Tax Act 1961, income 1, 2, 3, 4 are taxable. As per DTAA, income 1, income 3 are taxable. Now, whichever is more beneficial means DTAA. Only 2 incomes are taxable as per DTAA. This is applicable. That means in case of foreign company also, other than tax rate, for remaining all provisions, DTAA or Income Tax Act, whichever is beneficial is applicable. However, in case of tax rate as per Income Tax Act is 35%. Tax rate as per DTAA is 20%. Now, in this case, 35% is only applicable. That means that is the only exception. Next, tax residency certificate, TRC. Sir, what do you mean by tax residency certificate? See, if a person is earning income outside India, who is resident in India, we are giving tax credit to him, right? So, how can we believe that Virat Kohli paid tax in Australia? So, what Virat Kohli will do? He will produce tax residency certificate. Or let's say Justin Bieber came to India. Justin Bieber earned income in India by performing in Ambani marriage. On that income, Justin Bieber is required to pay tax in India. Justin Bieber may also required to pay tax in USA. Now, India is levying tax. USA is also levying tax. It leads to double taxation. Now, before we give tax credit to Justin Bieber, we will ask Justin Bieber to produce tax residency certificate. Tax residency certificate consists of PAN number of his country. Okay, what is the PAN number or what is the tax identification number of his country and his address details, what is his name, his address, contact number, all basic information is available in tax residency certificate. Only if non-resident produces tax residency certificate in India, then only tax credit will be given to him. Otherwise, tax credit will not be given to him. Are you able to understand? So that's all about TRC, tax residency certificate. See, till here we discussed various concepts, but from these concepts, the chances of question is probability is very low. But whatever the concept that I am going to discuss right now, this is very much important for examination. From this topic only, he is asking all the questions in the examination. So I request everyone to listen very clearly this topic. Next topic is section 91. Till now, we discussed bilateral relief. That means one country levies tax, another country will not levy tax, or one country levies tax, another country also levies tax, but tax paid in country 1 is given as credit in country 2. Okay, that is foreign tax credit. But section 91 is applicable if there is no DTAA, between India and other countries. Between India and other countries. If there is no double taxation avoidance agreement between India and other countries, then section 91 is applicable. What section 91 says? There are 4 conditions. If these 4 conditions are satisfied, then only section 91 is applicable. Otherwise, section 91 is not applicable. What are they? Condition 1, like person should be resident in India. Person should be, and for every question that you solve relating to section 91, write these 4 conditions also. If you write the provision, like you will get effective marks, 100% of the marks. The person should be resident in India. Condition 2, he is having foreign income. He is having, or you can say he is having income from foreign country. Income from foreign country. Condition 3, he paid tax in foreign country. He paid tax in foreign country. Condition 4, India is not having DTAA with such foreign country. DTAA with such foreign country. If these 4 conditions are satisfied, then DTAA relief will be calculated differently. Are you able to understand? So, if there is no DTAA, then India itself will give the relief. The type of relief we call as unilateral relief. So, generally what? Both countries will enter into DTAA. If DTAA is there, tax exemption method or tax credit method. If there is no DTAA, then India itself will give relief. That type of relief we call as unilateral relief. To get that relief, 4 conditions are required to be satisfied. Person should be resident in India. He should have income from foreign country. He should pay tax in foreign country. See, payment of tax can be direct payment or deduction of TDS in foreign country, both. Okay. 4th condition, India is not having DTAA with such foreign country with whom SSE has earned foreign income. Okay. If these 4 conditions are satisfied, then section 91 is applicable. If section 91 is applicable, then how are we going to provide relief? Step 1, we will calculate tax on total income. Calculation of tax on total income. Total income means both Indian income as well as foreign income. We will calculate tax on total income, and we do not deduct TDS, TCS, advance tax, MAT credit or AMT credit. So basically what happens, we will calculate tax, we will add surcharge, we will add HEC, but we do not reduce like TDS credit, advance tax, TCS credit, those should not be reduced. So here tax means what? Tax means gross tax. Gross tax means tax plus surcharge plus HEC. Okay. Don't reduce advance tax. Don't reduce TDS. Don't reduce TCS. Don't reduce AMT or MAT credit before reducing all these. So you will calculate gross tax on total income. On Indian income and foreign income, you will calculate tax. You will add surcharge. You will add HEC. So step 1, you will calculate tax on total income before reducing all these credits. Next, step 2, relief under section 91. Relief under section 91 is equal to average tax rate, doubly taxed income, or we can write like this. Step 2 is average tax rate in India or average tax rate in foreign country. Average tax rate in foreign country, whichever is lower. So you calculate average tax rate in India or average tax rate in foreign country, whichever is lower you take. Step 3, relief under section 91 is equal to doubly taxed income into tax rate as per step 2. Tax rate as per step 2. See, you know tax rate as per step 2, right? Average tax rate in India or average tax rate in foreign country. So out of these two, whichever is lower you need to consider. Whatever the tax rate as per step 2 is there, apply it on doubly taxed income. Thereby you are going to calculate relief under section 91. Are you able to understand? Next, step 4, final tax liability is equal to step 1 minus step 3. In this way we are going to calculate the tax liability. Now, shall we do an example for our better understanding, so that it will be very clear for you as well. Many problems are there. Let's do some 2-3 problems so that you are going to get better clarity. Okay. So there is an individual with the name Rahul. He is resident in India. Rahul is basically resident in India. Now, Rahul total income. So he has Indian income 9 lakhs, foreign income 5 lakhs. So how much is total income? Total income is 14 lakhs. And Rahul is resident in India. He has earned income from country Y with which there is no DTAA in between India and country Y. In this case, obviously section 91 is applicable. As there is no DTAA, India will only provide relief. The type of relief we call as unilateral relief. Am I correct? So how are we going to calculate? First, let's say Rahul is paying taxes under section 115 BAC. So shall we quickly calculate the tax liability? 1 second, I'll get my calculator. I hope students you are following me. Am I correct? So if you have any doubts, you can ask in live chat as well. I will reply. So let's calculate tax liability. He is paying taxes under section 115 BAC. So under 115 BAC up to 3 lakhs there is no tax. So what is step 1? There is no DTAA na. If there is no DTAA, unilateral relief will be given and tax liability is calculated in these 4 steps. Step 1, tax on total income. So how much is total income? 14 lakhs. How much is tax? Up to 3 lakh, tax amount is nil. Greater than 3 lakh, up to 7 lakh, tax rate is 5%, tax amount is 20,000. Greater than 7 lakh, up to 10 lakh, tax rate is 10%, tax amount is 30,000. Greater than 10 lakh, up to 12 lakh, tax rate is 5%, 15%, tax amount is 30,000. Greater than 12 lakh, up to 14 lakh, tax rate is 20%. That means 2 lakh into 20%, 40,000, right? How much is tax? 40 plus 30 plus 30 plus 20, 1,20,000 rupees. To this, we are going to add HEC at the rate of 4%. Surcharge is not applicable because total income is less than 50 lakhs. Surcharge is not applicable. HEC at the rate of 4%, 4,800. So how much is tax liability? 1,24,800. This is step 1. Now, what we need to do? Step 2, we need to calculate average tax rate in India. Average tax rate in India. How much is average tax rate? 1,24,800 divided by 14 lakhs into 100. 124,800 divided by 14 lakhs into 100. 8.9142%. See, he earned 5 lakhs income outside India, right? On this 5 lakhs income, he paid tax 80,000 rupees. How much tax he paid? 80,000 rupees. So, how much is average tax rate in foreign country? Average tax rate in foreign country is equal to how much? 80,000 divided by how much is total income? Sorry, foreign income 5 lakh into 100. What is the percentage? 80,000 divided by 5 lakh into 100, 16%. Out of these two, whichever is lower means 8.9142%. Now, step 3, relief under section 91. What is doubly taxed income? Doubly taxed income is 5 lakhs. Do you agree with me? On 5 lakhs, he paid tax in country Y. He is also required to pay tax in India. So 5 lakhs is doubly taxed income. So 5 lakhs into tax rate as per step 2. What is tax rate as per step 2? 8.9142%. 5 lakh into 8.9142%, 44,571 is tax credit. That is relief under section 91. How much is balance tax liability? That is step 4. Balance tax liability is 1,24,800 minus 44,571, 80,220. So this is how relief will be provided under section 91. I hope you understood very clearly. Very simple, very simple. If there is no DTAA, India itself will provide relief, but 4 conditions are required to be satisfied. Individual should be resident in India, he should have income from foreign country, he should pay tax in foreign country, then like India should not have DTAA with that foreign country. If these 4 conditions are satisfied, relief will be given under section 91. How relief will be calculated? First, calculate tax on total income. Second step, average tax rate in India or average tax rate in foreign country, whichever is lower. Step 3, relief is equal to doubly taxed income into tax rate as per step 2. Step 4, final tax liability is equal to step 1 minus step 3. I hope you understood. Now I am moving forward. Now I will take another example. Let's say same Rahul is there. In case of Rahul, Indian income is 10 lakhs. Foreign income 7 lakhs. Out of 7 lakhs, 4 lakhs is from USA, 3 lakhs is from UK. Sir, in this case, he is having doubly taxed income from multiple countries and tax rate applicable in USA is 25%, tax rate applicable in UK is 22%. Sir, if income from multiple countries is there, then how to provide relief under section 91? That is the question. In that case, for each country separately, we are going to calculate relief under section 91. Are you able to understand? So in this case, how do we handle relief under section 91? First, we will take USA income. What we will do? Average tax rate in India or average tax rate in USA. Whichever is lower, we will consider. For example, let's say average tax rate in India is 30%. So 30% or average tax rate in USA 25%. Whichever is lower means 25%. So doubly taxed income into 25%, you will get relief under section 91 for USA income. Are you able to understand? Similarly, you will do the same thing for UK income also. So second, you will take UK income. Average tax rate in India or average tax rate in UK. Average tax rate in UK. Whichever is lower. Okay. In India, 30%. In UK, 22%. Whichever is lower means you will consider 22%. Now, doubly taxed income of UK into 22%, you are going to arrive at relief under section 91 for UK income. Are you able to understand? This is how we are going to give the relief. So if foreign income is there from 2 or more countries, for each country doubly taxed income, you have to provide relief under section 91 separately in this way. Okay, for USA you have calculated relief separately. For UK also you have calculated relief separately. Are you able to understand? Shall I ask you another question? I hope you are following. Uh, there is again Monish. There is one student who is giving me replies in live chat. Monish. So I will take his example. So there is Monish. He has Indian income 10 lakhs. He has royalty income from outside India. Royalty income outside India, which is 7 lakh rupees. However, on this royalty income, he is eligible for deduction under section 80 QQB up to 3 lakhs. 80 QQB up to 3 lakhs. Now, when you calculate his gross total income, how will you do the calculation? If you do gross total income, Indian income is 10 lakhs, royalty income from other sources 7 lakhs. So gross total income is 17 lakhs. From that, you will claim deduction under section 80 QQB. How much is deduction? 3 lakhs. Now, how much is taxable income? Taxable income is 14 lakhs. My dear students, observe very clearly. How much is my foreign income? My foreign income is 7 lakh rupees. But am I required to pay tax on 7 lakhs in India? No. I am required to pay tax on 7 lakh minus 3 lakhs. I am required to pay tax only on 4 lakhs. Am I correct or not? Now, here doubly taxed income is 4 lakh rupees. Are you able to understand? See, in foreign, you paid tax on 7 lakhs. Do you agree with me? You paid tax on 7 lakhs. In India, you paid tax on 4 lakhs. Now, how much is doubly taxed income? Whether total 7 lakhs is getting doubly taxed? No, doubly taxed income is only 4 lakhs. So, while providing relief under section 91, you will not consider 7 lakhs, you will consider only 4 lakhs. So, relief under section 91 is equal to relief under section 91 is equal to doubly taxed income. How much is doubly taxed income? 4 lakhs into average tax rate in India or average tax rate in foreign country, whichever is lower. This is how you are going to calculate relief under section 91. Very simple, students. You need to provide relief not on total income on which like total foreign income. You need to provide relief only on doubly taxed income. Here foreign income is 7 lakhs, but you will not provide relief on 7 lakhs. You will provide relief only on 4 lakhs. Are you able to understand? Shall I give you another example? There is another person with the name Varun Chaudhary who is replying me. Now, there is Varun Chaudhary. His Indian income is 15 lakhs. He has one building in Australia. From building in Australia, he is getting rental income. Varun Chaudhary is resident in India. He is getting income from Australia. Let us assume there is no DTAA between India and Australia. So, his rental income from house property in Australia is 9 lakh rupees. Now, how much is taxable? As per Indian provisions, rental income is not taxable. Standard deduction is available under house property. So, when you are calculating his gross total income, how will you calculate? Like Indian income 15 lakhs, gross annual value 9 lakhs. From this, you will claim 30% standard deduction, right? 9 lakh into 30%, 2.7 lakhs. 9 lakh minus 2.7 lakhs, 6.3 lakhs is taxable. So his gross total income will be 15 plus 6.3, 21.3 lakhs. Now, please understand here foreign income is 9 lakh rupees. I am not objecting. But whether 9 lakhs is getting taxed in India? No. only 6.3 lakhs is getting taxed in India. So here doubly taxed income is 6,30,000. So when you are calculating relief under section 91, what is doubly taxed income? Doubly taxed income is 9 lakhs. No, doubly taxed income is only 6.3 lakhs. On 6.3 lakhs, you will apply average tax rate in India or average tax rate in foreign country, whichever is lower. Are you able to understand? So my intention of explaining all these examples is to tell you that relief is available only on doubly taxed income. Relief is not available on total foreign income. Are you able to understand? Now, shall we discuss further? Now, we will do one problem for better understanding. My dear students, I am going to share this PDF in our Telegram channel so that you can also participate effectively. Give me 1 second. I am going to share with you. So if we do some 2-3 problems, that will be a great revision for us. So let's do. First, I will discuss question number 2. So there is Mr. Rohit, an individual who is resident in India, aged 52 years, earned royalty income of 15 lakhs from XYINC of Canada for writing articles in journals and newspapers for the year ended 31st March 2025. So, Rohit is basically resident in India. He is getting income from Canada. How much is the income? 15 lakh rupees. And the nature of income is royalty. See, if you remember 80 QQB, for arts, science and literacy, with regard to these three, if you write any books and earn royalty income, then only deduction is available under section 80 QQB. Here, why royalty income was earned? Royalty income was earned for writing journals in newspapers. For writing journals in newspapers, if you earn royalty income, that is not eligible for deduction under section 80 QQB. So, for solving these DTAA problems, you are expected to have knowledge of those chapter 6A deductions also. Okay. Now, however, he received only 12.5 lakhs during previous year 24-25 and the balance is outstanding as on 31st March 25. He maintains cash system of accounting. He also earned rental income of 2.4 lakhs from a house situated in Canada. See what he said, rental income. Rental income is not income from house property. Many times student will mistake. Okay, they will consider rental income as income from house property. Entire problem will go wrong. Rental income means it is gross annual value. From that you should claim standard deduction under section 24A at the rate of 30% of net annual value. So this 2,40,000 is gross annual value. From that you should claim standard deduction. Balance is income from house property and this house property is located in Canada. So income from foreign house property. So here doubly taxed income is not 2,40,000. From 2,40,000 you will reduce standard deduction. Na? After reducing standard deduction, whatever the balance income is there, only that is doubly taxed income. Are you able to understand? Next. Municipal taxes paid 10,000 rupees, which is not allowed as deduction in Canada. Even though it is not allowed as deduction in Canada, while calculating income from foreign house property, it is allowed as deduction in India. Okay. DTAA between India and Canada provides for tax at the rate of 15% in Canada without prejudice to taxation of same income in India. So what is tax rate applicable in Canada? 15%. He further received 3,50,000 during the year as dividend from X Limited, an Indian company. Dividend is taxable under income from other sources. On 1st April 2024, he took an education loan from bank for his son. Education loan, how to remember? E represents education. So, deduction is available for interest on education loan under section 80E. Are you able to understand? Annual repayment of loan and interest. Whether loan amount is eligible for deduction under 80E? No. Interest amount is eligible for deduction under section 80E. So, we need to compute total income and tax liability. So here answer was given. If you want me to solve, I will also solve, not a problem. Now, tell me total incomes. He is having three incomes now. Indian income is dividend income, foreign income is royalty income, as well as another one, income from foreign house property. These two are foreign incomes. So rental income 2,40,000, you can see rental income is only gross annual value. From that you will claim municipal taxes as deduction. Thereby you will arrive at net annual value. From net annual value, standard deduction is allowed at the rate of 30%. So 2,30,000 into 30%, 69,000 is standard deduction. Income from foreign house property. Income from foreign house property, how much? 1,61,000. Next, royalty from Canada for writing articles in journals. I already said you need to be very careful. Literacy, arts, science. These three related books are written on royalty income. Then deduction is available under section 80 QQB. Otherwise, deduction is not available under section 80 QQB. Are you able to understand? So here it is for writing journals. So no deduction. Only amount which is received during the previous year is includable since he follows cash basis. That's what, right? In PGBP we have liberty. What is charging section? Section 28. It says that SSC can follow either cash basis or accrual basis as may be followed by him. Okay. So method of accounting for PGBP is cash or accrual basis. Here he is following cash basis. So we taxed only 12,50,000 rupees. Next, income from other sources. Do you know section 194? As per section 194, TDS will be deducted on dividend income. Okay. So you know, right? 100 rupees, 10 TDS at the rate of 10%, and 90 will be paid. Am I correct? 90 will be paid. Here, how much dividend is paid to him? Dividend paid to him is 3,50,000 rupees. So we will assume 3,50,000 is at 90% level. We need to do gross up. If we do gross up, how much are we going to get? 3,50,000 divided by 90 into 100. 3,88,000. 888. Are you able to understand? So we need to do gross up also. So then how much is total income? Total income is 17,99,889. From this, we will claim interest on education loan. Interest like deduction under 80 QQB not available. So how much is total income? 17,75,889 rounded off to 17,75,890. So can we calculate average tax rate in India? How much is average tax rate, Monish? Average tax rate in India is equal to 17,75,890 divided by how much is total income? Sorry, we did not calculate tax liability, right? So first we need to calculate tax liability. Calculation of tax liability on total income. Total income means both Indian income and foreign income. So total income we already calculated now, 17,75,890. Whether SSC is following, he does not opt 115 BAC. That means he is paying taxes under optional tax rates. Under optional tax rates, he is 52 years old, less than 60 years. The basic exemption limit available is 2.5 lakh. Up to 2.5 lakh, tax amount is nil. Greater than 2.5 lakh, up to 5 lakh, tax rate is 5%, 12,500. Greater than 5 lakh, up to 10 lakh, tax rate is 20%. Tax amount is 1 lakh. About 10 lakh, tax rate applicable is 30%. Correct? So 7,75,890 into 30%, 232,767 total 345,267. So this is tax liability. Now how much is average tax rate in India? Average tax rate is 3,45,267 divided by the taxable income in India 17,75,890 into 100. How much? 19.44%. Did I do any mistake? Okay, I forgot to add HEC. 345,267 plus 4%. I'm sorry. Plus HEC. 3,59,078. 3,59,078 divided by 17,75,890. 20.219%. Good. Now, how much is tax paid in foreign country? Tax paid in foreign country is 15%. 20.219% or 15%, whichever is lower means 15%. How much is doubly taxed income? Doubly taxed income 1,61,000 and 12,50,000. Doubly taxed income 12,50,000 plus 1,61,000. Doubly taxed income 14,11,000. 14,11,000 into 15%. Relief under section 91. 2,11,000. So that is relief under section 91. I hope you understood. See, I did one mistake. That's fine. I already cleared in my life again. Never, I am not required to write CA examination. Glad. Okay. But you should not commit that mistake. After becoming CA, it's okay. Software will take care of. Even though you commit any mistake, you are not required to do any clerical calculation. Correct? Now, shall I explain further? Next concept is permanent establishment. If you are doing business with outside India, then foreign country will not levy tax. But if you are doing business in foreign country, then foreign country is going to levy tax. That concept we call as permanent establishment. For example, let's say I am sitting in India, I am providing my professional services to a client located in USA. Now, I am not doing business in USA, I am sitting in Hyderabad, I am providing services to client located in USA. Now, do I have any branch or fixed place of business in USA? I do not have any branch or fixed place of business in USA. So, I am not having any permanent establishment in USA. However, case 2, I went to USA, I opened one office there. From there, I am providing services. When I provide services from office in USA, I am opening separate branch in USA. There, if I earn any foreign income, if I earn any income in USA, on that income, I am also required to pay in USA. So the concept is when you have permanent establishment in India, when you have permanent establishment outside India, then whatever the foreign income that you earn through that permanent establishment, on that foreign income, you are required to pay tax in foreign country. Otherwise, you are not required to pay tax in foreign country. See, I am doing practice from India only. From India only, I am giving suggestions to client located in USA. I did not open any branch. Now, I will get fees. On that fees, I am required to pay tax in India, but I am not required to pay tax in USA. So, when you do business with foreign country, you are not required to pay tax in foreign country. But when you do business in foreign country means what? You are doing some setup in outside India and through that you are earning income. Then you are required to pay tax in foreign country. The permanent establishment means what? Any branch, fixed place of business or sales outlet, manufacturing unit like this. If you open any office outside India, then we call it as permanent establishment. When you have PE outside India, whatever the foreign income that you earn through that PE, on that foreign income you are required to pay tax in foreign country. Vice versa, non-resident opened PE in India. So through that PE in India, if he earns any income, he is required to pay tax in India. Are you able to understand? One simple thing here, small thing, license office. Opening of license office to comply with regulations of RBI cannot be considered as permanent establishment. So if you open license office, it will not be treated as PE. Are you able to understand? Taxation of business process outsourcing units. See, there are two companies. One is Trump Inc. and Modi Inc. Modi Limited. Modi Limited is Indian company. Trump Inc. is US company. Now, what Trump Inc. is doing? Trump Inc. is like giving work to Modi Limited. On this work, Modi Limited will pay tax in India, right? Modi Limited will pay tax in India. As Modi Limited is paying tax in India, through this work, if any income is earned by Trump Inc., Trump Inc. is not required to pay tax in India. Not required to pay tax in India. Both are principal to principal. Trump Inc., Modi Limited, both are acting independently. Both are in between them. The relation is principal to principal relation. Whenever the relation is principal to principal relation, in that case, Trump Inc. is doing business with India. When Trump Inc. is doing business with India, there is no concept of PE. Trump Inc. is not required to pay tax in India. Are you able to understand? Now, I will take example 2. Trump Inc. has one branch in India. That branch name is Trump Limited. Trump India Limited. Now, Trump Inc. is giving work to Trump India Limited, and Trump India Limited, and he is making money out of it. Whenever he is having branch in India, whenever he is having permanent establishment in India, then Trump India Limited is required to pay tax in India. Are you able to understand? So Trump India Limited, it is subsidiary of Trump Inc. It is having permanent establishment in India. Now Trump India Limited is required to pay tax in India. In both cases, tax is required to be paid, but when business is done, foreign company will not pay tax in India. Whoever the agent in India acting on principal basis is there, he will pay tax in India. In second case, if you are having PE, then PE will pay tax in India. Are you able to understand? Next, I will discuss with you my dear students, that concept now I am going to discuss, it will be very interesting. I am going to simplify and give it to you. Now I will explain to you how to convert foreign currency to Indian currency, how to convert tax paid in foreign country into Indian currency. First, conversion of, exchange rate for conversion of foreign income into Indian income. Exchange rate for conversion of foreign income into Indian income. First, nature of income. If nature of income is salary income, dividend income, interest on securities, capital gains, and TGBP income of non-resident shipping business, NR shipping business. So all these incomes, foreign incomes, if you want to convert into Indian currency, what is the exchange rate that you need to take? You need to consider exchange rate as on last day of month, last day of the month, as on last day of the month, immediately preceding the month, immediately preceding the month in which salary is due, salary is due or received, or in which dividend income is declared or paid or distributed. Interest on securities, in which interest income is due, in which capital asset is transferred, in which such shipping income is deemed to accrue or arise in India, deemed to accrue or arise in. Very simple, students. You are getting salary income from outside India. The month in which you got the salary, ignore that month. Take immediately preceding month. In immediately preceding month, take the last day. On last day, whatever the TTBR of SBI is there, okay, that will be the exchange rate. What do you mean by this? Let's say in May, you got $12,000 salary. On May 10th, you got $12,000 salary. Ignore May. Don't consider May. What is immediately preceding month? Immediately preceding month is April. In April, what is last day? Last day is 30th April. Am I correct or not? Last day, 30th April. On 30th April, whatever TTBR of SBI is there, TTBR of SBI, that will be the exchange rate. Are you able to understand? So, dividend income, salary income, interest income, capital gain, PGBP income of NR shipping business. You know section 44B, right? Non-resident shipping business. 7.5% of income is taxable in India. So in case of that non-resident shipping business, 7.5% of turnover will be considered as deemed income. Okay. So the deemed income or interest income, dividend income, salary income, capital gains. All these 5 incomes, in which month you are getting these incomes? Ignore that month. Take immediately preceding month. In immediately preceding month, whatever the last day is there, on that last day, TTBR of SBI will be considered as exchange rate. Are you able to understand? Fantastic. Simple, right? Very simple. All 5 incomes you need to remember: salary, dividend, interest, capital gains, PGBP income of NR shipping business. For these 5 incomes, this month, the month in which you got them, ignore immediately preceding month, last day, TTBR of SBI is considered as exchange rate. Are you able to understand? Now, I hope you are following. Next. Sir, what about other incomes? You have income from house property. You have PGBP income. Sir, PGBP income is covered here. Other than this PGBP income, PGBP other than covered above. Other than covered above. Next, income from other sources other than dividend, interest on securities. Other than dividend and interest on securities. So, for these 3 incomes, you will consider exchange rate as on last day of previous year. Exchange rate as on last day of previous year. What is exchange rate as on last day of previous year? Exchange rate as on last day of previous year means exchange rate. That means TTBR of SBI as on 31st March of previous year. As on 31st March of previous year. Did you understand? Next. Sir, what is the exchange rate for tax paid in foreign country. Let's say you earned $1 lakh. On $1 lakh, you paid tax $15,000. For this income, we have discussed if it is salary, interest, dividend, capital gains and all, you will consider exchange rate immediately preceding the month, last day exchange rate you will consider. Okay, so then whatever exchange rate for tax paid in foreign country. So for this you will consider TTBR of SBI as on last day of month immediately preceding the month in which tax is paid in foreign country, What do you mean by this? For previous year 24-25, on June 21st, 2025, you paid tax $15,000. How much tax you paid? $15,000. Ignore June. Don't consider June. Immediately preceding month, May. What is last day of May? 31st May. On 31st May, whatever TTBR of SBI is there, that will be considered as exchange rate for conversion of foreign tax paid. Are you able to understand? So these are conversion rates. Now, shall we do one problem for better understanding? I hope students you understood exchange rates for conversion of foreign income and foreign tax. Am I correct? Now, shall we do one problem on this? Like, if foreign income is given in Indian rupees, it will be very easy. You can solve very easily. But if foreign income is given in foreign currency, dollars, euros, pounds, like that, then you need to apply these exchange rates. You need to convert foreign income to Indian rupees, and you also need to convert tax paid in foreign country to Indian rupees. Are you able to understand? Now, shall we do one problem, everybody? Open question number 1. Raghu, aged 50 years, is CEO of Silver India Limited since 1st April 2020. His income in India consists of salary before standard deduction 23,25,000. Check. Salary before standard deduction. How much standard deduction is available? Under optional tax rates 50,000, under default tax rates 75,000. Am I correct? So, compute total income and tax liability. Assume he pays tax under 115 BAC. If he is paying tax under 115 BAC, then what is the standard deduction available? Standard deduction available is 75,000 rupees. Interest in respect of self-occupied property of rupees 1,80,000. See, this is eligible for deduction under section 24B. But he is choosing 115 BAC na. If he is choosing 115 BAC, under 115 BAC, interest on self-occupied property is not allowed as deduction. Are you able to understand? That is not allowed as deduction. Interest on bank fixed deposit, this is taxable under income from other sources. He has following income for the year ended 31st March in country A. Income from business in country A. Income from business, what is the exchange rate that you need to consider? Income from business. If it is business income of non-resident shipping business, then you will consider exchange rate as on last day of immediately preceding month. But this is normal business income. For normal business income, you will consider exchange rate as on 31st March of previous year. You can see PGBP income other than covered above. You will consider exchange rate as on last day of previous year. So how much is exchange rate as on 31st March? As on 31st March, exchange rate is 71 rupees. So you will convert $25,000 by applying 71 rupees. How much? 25,000 into 71, 17 lakh 75,000 rupees. Next, rental income from house property in country A. Income from house property. This will also be considered at exchange rate as on 31st March of previous year. So as on 31st March, exchange rate is 71. So 4,500 into 71. How much? 3,19,500. Municipal taxes in respect of above house not allowed as deduction. Even though it is not allowed as deduction in country A, it will be allowed as deduction in India as per Indian tax laws. As per Indian tax law, whatever the taxes, municipal taxes paid in foreign country are there, they are allowed as deduction from gross annual value. You can claim as deduction. Even 450 also converted at exchange rate of 71 rupees. Next, dividend from shares in country A where dividend was declared in March 25. Careful. Dividend income. So for dividend income, what will be you consider? In which month dividend came? Dividend came in March 2025. Don't consider March 2025. Consider immediately preceding month. What is immediately preceding month? February 2025. What is last day? 28 or 29, because February leap year. Some years it is 28, some years it is 29. So how much is exchange rate as on 29th February? Exchange rate as on 29th February is 70 rupees. So $10,000 into 70 rupees. Are you understanding how we are converting foreign income in foreign currency to Indian currency? Crucial. If this type of problem comes, you should be able to handle it. So 10,000 into 70, how much? 70,000, 7 lakhs. Next, short-term capital gain of 5,000 US dollars. Short-term capital gain. Capital gain, what will you consider? Ignore that month. Take immediately last month, preceding month. On the immediately preceding month, consider last day. On last day, whatever TTBR of SBI is there, that is exchange rate. So it is also received on 28th March. Immediately preceding month means February. In February, last day means 29. Exchange rate is 70. Okay. So 5,000 into 70. So in this way, you will convert foreign income. Here foreign income is in US dollars. But to calculate tax in India, you should convert foreign income to Indian income. So we have discussed the exchange rates. I hope you are following. Now let us read further. India has DTAA with country A and tax paid in country A is eligible for tax credit in India. Fiscal year for income tax is same both in India and country A. Rate of tax is 20% in country A in respect of all incomes. Income tax was paid by Mahesh on 25th May 2025. So when income tax was paid, this is exchange rate for tax paid in foreign country. Tax paid in foreign country. So how much is when tax was paid? Tax paid in 25th May na, tax paid in 25th May 2025. So you need to ignore May. Immediately preceding month means April. I am sorry for the interruption. Let us resume. Okay, I will start now. See, today, first I will discuss about taxation of business trust. Then I will discuss about investment fund, taxation of investment fund. Then I will discuss about taxation of securitization trust. Then I will discuss advance tax. Then I will discuss interest under section 234A, 234B, 234. So these are the topics that are going to be revised in today's class. First, let us start with taxation of business trust. Hi Varun, good evening. Taxation of business. See, have you ever dreamt of owning a mall? See, we can buy flat, we can buy one house, but have you ever dreamt of purchasing one big mall? Have you ever thought if I am the owner of this big mall, I would be receiving rental income like that? So generally we can maximum purchase house or we can maximum purchase flat like that. But like we middle class people, we do not have that much of money to purchase one big mall or one big real estate property. That's not possible. So that's where comes the concept of business trust. Business trust is like a mutual fund. Let's say I wanted to invest in MRF shares, Reliance Limited shares, Tata Limited shares, Wipro Limited shares with just 200 rupees. How can I invest with 200 rupees in these four big company shares? That is not possible. So what I will do, I will deposit 200 rupees. I will purchase units of mutual fund with 200 rupees. Mutual fund will invest in these four company shares. So a person can own portfolio of multiple company shares. That is possible because of intermediary mutual fund. In the same way, if you want to own a very big real estate property or a very big mall, that is also possible through buying units of business trust. Are you able to understand? So business trust concept is also like a mutual fund only. Are you able to understand? Let's say unit holder is there. What unit holder will do, and there is business trust, and there will be real estate property. Now, unit holder, what he will do? He will invest. Invest means what? He will purchase units of business trust. What business trust will do? Business trust will invest that money in real estate property. Okay, real estate property or one big mall. Now, from that big mall, rental income will be received by business trust. Na? Whatever the rental income that is received by business trust is there, such rental income will be passed on to unit holder. This is the concept of business trust. Are you able to understand? So if I purchase, let's say there is one very big property. DLF is a very big real estate company. DLF is constructing one mall, DLF mall. In that DLF mall, I wanted to invest. Can I purchase any floor in DLF mall? That is not possible. It is very costly. Now what DLF mall will do? It will create a business trust, DLF business trust. I will purchase units of DLF business trust. So my money will go to business trust. Business trust will invest in that mall, real estate property. So from that property, like business trust will receive the rental income. Whatever the rental income received by business trust is that will be passed on to the unit holder. This is the concept of business trust. Are you able to understand? Next, shall we discuss taxation of business trust? I hope you understood what business trust means and how that concept works. If you understand, please respond. Then I will discuss taxation of business. taxation of business trust. Let's say there is one SPV, special purpose vehicle. Special purpose vehicle means it is a company in which business trust holds greater than or equal to 50% shareholding. Let's say there is business trust. This business trust is holding greater than or equal to 50% shareholding. Not greater than or equal to 50%. I think it is 50% or more. So not equal to greater than 50%. If business trust invests more than 50% shareholding in SPV, then we call that Indian company. SPV means it's nothing but an Indian company in which business trust holds greater than 50% shareholding. Then we call that Indian company as business trust, and then there will be unit holder. Now the point is SPV is nothing but Indian company, right? For example, Indian company is paying taxes at normal rates. What are the taxes applicable to Indian company? Taxes applicable to Indian company is domestic. Indian company means nothing but domestic company. So we need to check turnover of previous year 20 to 23. If it is less than or equal to 400 crores, then tax rate applicable is 25%. Otherwise, tax rate applicable is 30%. So Indian company is paying taxes at the rate of 25% or 30%. Now, what Indian company will do? Indian company will give dividend to business trust. Such dividend is exempt in the hands of business trust. Whatever the dividend in the hands of business trust is there, such dividend will be passed on to unit holder. Such dividend is also not taxable. Such dividend is also exempt in the hands of unit holder. Both these exemptions are per under section 1023 FT. So very simple. SPV, Indian company in which business trust holds 50% or more than 50% shareholding. Then in that, if that SPV gives any, that SPV is paying taxes at 25% or 30%, that SPV is paying dividend to business trust, the same business dividend is passed on to unit holder. Total dividend is exempt in the hands of unit holder. It is not at all taxable. Now, case 2. Indian company is paying taxes under section 115 BAA. You know concessional tax rates, right? 115 BAA, base tax rate 20%, 22% plus default 10% surcharge plus 4% HEC, 25.168%. Do you remember? So paying taxes under section 115 BAA. So if SPV is paying taxes at concessional rate, then whatever the dividend given is there, whatever the dividend given by SPV to business trust is there, such dividend is exempt in hands of business trust. But whatever the dividend distributed by business trust to unit holder is there, such dividend is not exempt. Such dividend is taxable. Are you able to understand? Sir, what is the tax rate? If the SSE is non-resident or foreign company, tax rate applicable is 10%. If SSE is resident, then tax rate applicable are normal tax rate. Next, sir, whether here it is taxable na, as it is taxable, TDS is required to be deducted. In case 1, domestic company is paying taxes at normal tax rates 25% or 30%. That's why dividend is not taxable in the hands of business trust. It is also not taxable in the hands of unit holder. But in second case, SPV is paying taxes at concessional rates. That's why whatever the dividend received, it is exempt in the hands of business trust, but it is not exempt in the hands of unit holder. It is taxable in the hands of unit holder. Are you able to understand? So what is the tax rate for non-resident or foreign company? Tax rate is 10%. For resident, tax rate applicable are normal tax rate. Now, here TDS is also required to be deducted. What is the rate of TDS? TDS under section 194 LBA, rate of TDS in case of non-resident, rate of TDS is 10%, non-resident or foreign company. In case of resident, rate of TDS is, are you able to understand? So very simple. We are speaking only about dividend income. We are not speaking about other incomes. So if SPV pays tax at normal tax rates, dividend is exempt both in hands of trust as well as unit holder. SPV paying taxes at concessional tax rates. Dividend exempt in the hands of business trust but taxable in the hands of unit holder. Tax rate in case of NR or foreign company 10%, in case of resident normal tax rate. As it is taxable, business trust is required to deduct TDS under section 194 LBA at the rate of, in case of non-resident or foreign company, 10%. In case of resident also, TDS rate is 10%. Are you able to understand? Yeah, 50% or more. I think greater than or equal to 50% only. Initially, I wrote correct, but bit of confusion. So, did you understand dividend income? Shall I explain about other incomes? Now, same concept, unit holder, business trust, SPV. This time, SPV is paying interest income to business trust. Whatever the interest income paid to business trust is there, such interest income is exempt in hands of business trust under section, exempt in hands of business trust, and no TDS is required to be deducted. As that income is not taxable, that income is exempt, no TDS is required to be deducted. And the same interest will be passed on to unit holder. Whatever the interest passed on to unit holder is there, this interest is taxable in the hands of unit holder. That is taxable in the hands of unit holder. Sir, what is the tax rate? In case of non-resident or foreign company, tax rate is 5%. In case of resident, tax rate is normal tax rate. Now, it is taxable in the hands of unit holder. So, business trust, for this interest, business trust is required to deduct TDS. Is required to deduct TDS at the rate TDS under section 194 LBA. In case of non-resident or foreign company, TDS rate is 5%. In case of resident, tax rate is 10%. Are you able to understand? So for interest income, see, dividend income, interest income, rental income, all three are exempt in the hands of business trust always, but they are taxable in the hands of unit holder. Like interest income is taxable in the hands of unit holder. If unit holder is non-resident or foreign company, for interest tax rate is 5%, for dividend tax rate is 10%. For resident, tax rate applicable is normal tax rates. As it is taxable in the hands of unit holder, business trust is required to deduct TDS under section 194 LBA. For non-resident, TDS rate is 5%. For resident, TDS rate is 10%. So did you understand about interest income? Now shall I explain further? Same. Now we will discuss about rental income. Unit holder is there, business trust is there. This time, business trust did not invest in special purpose vehicle. Business trust purchased real estate property. Let's say 1 lakh people, 1 lakh units are sold, 10 crores are 10 crores were taken. Using this 10 crore, one mall was directly purchased, real estate property. Now, from this real estate property, rental income will be received by business trust. This rental income is exempt for business trust. That rental income is not taxable in the hands of business trust. As rental income is exempt, no TDS is required to be deducted by the payer of rent, real estate property. But the same rental income will be passed on to unit holder. That rental income is taxable in the hands of unit holder. This is taxable in the hands of unit holder. Sir, what is the tax rate? In case of non-resident or foreign company, tax rate applicable is rates in force. In case of resident, tax rate applicable is normal tax rate. See, this rental income is taxable in the hands of business trust in the hands of unit holder So business trust, before passing on rental income to unit holder, business trust is required to deduct TDS. TDS under section 194 LBA. What is the rate of TDS? In case of non-resident or foreign company, TDS rate is rates in force. In case of resident, TDS rate is 10%. Are you able to understand? So this is the TDS rate applicable for rental income. So if rental income is distributed by real estate property to the business trust, it is not taxable in the hands of business trust. When it is passed on to unit holder, it is taxable in the hands of unit holder. Tax rates applicable are for both resident and non-resident. Tax rates applicable are normal tax rates, whatever the rates in force. But business trust, before paying rental income to unit holder, it is required to deduct TDS. For non-resident, TDS will be deducted at rates in force. For resident, TDS will be deducted at the rate of 10%. So till here, are you clear? Everybody? Next. We need to discuss about other income. See, till now we discussed about rental income, interest income, dividend income. All these three incomes are taxable in the hands of unit holder. They are not taxable in the hands of business trust. But if there is any other income means other than rental income, interest income and dividend income. If there is any other income, capital gain or any other income from other sources, other income, this other income is exempt in hands of unit holder. Exempt in hands of unit holder. Give me 1 second. I am getting an important call. Hello. Am I audible? I am sorry, it's very important, urgent call. So that other income exempt in hands of unit holder, but it is taxable in hands of business trust. So very simple. What business trust is doing? Business trust is basically an mediator. Amount received from SPV or real estate property that is passed on to unit holder. So interest, dividend, rental income, these three are exempt in hands of business trust and taxable in the hands of unit holder. Whatever the other income is there, other income is exempt in hands of unit holder and taxable in the hands of business trust. Are you able to understand? That is the concept. Now, what are the tax rates? For long-term capital gain under section 112, tax rate applicable is before 23rd July, tax rate is 20%. On or after 23rd July, tax rate is 12.5%. Short-term capital gain under section 111A, 15% before 23rd July. On or after 23rd July, tax rate is 20%. Other income is taxable at MMR, maximum marginal rate. What MMR? See, business trust is nothing but it can be AOP or BOI. So if it is paying taxes under default tax rates, then MMR is 39%. If it is paying taxes under optional tax rates, MMR is 42.744%. Are you able to understand? Sir, section 112A, actually section 112A was not given in the section. No clarity was given with regard to section 112A. If you take rigid interpretation, even long-term capital gain under section 112A is also taxable at maximum marginal rate. That's why as long-term capital gain under section 112A was not discussed in taxation of business trust, in Finance Act 2025, amendment was made. Long-term capital gain under section 112A was also included. For long-term capital gain under section 112A, it is taxable in the hands of business trust at the rate of 12.5%. Are you able to understand? That is as per Finance Act 2025. For you, Finance Act 2024 is applicable. For Finance Act 2024, no clarity was given with regard to long-term capital gain under section 112A. So if you take very rigid interpretation, in the hands of business trust, long-term capital gain under section 112A is also taxable at MMR. I hope you understood, Niranjan. But this whatever this gap is there, this gap was amended through Finance Act 2020. Next, for example, I will tell one simple example that is applicable for business trust, investment fund and securitization trust. Listen very carefully. Business trust is there, unit holder is there, and SPV or real estate property is there. Now, business trust received income 80 crores. Out of 80 crores, 20 crores is capital gains, 60 crores is business income, or 60 crores is rental income. Now, from business trust, unit holder received 8 lakh rupees. 8 lakh rupees. Out of 8 lakh rupees, same proportion. Whatever the proportion in which income is received by business trust, in which proportion income was received, let's say here income was received in the proportion of 2:6. Capital gain to rental income 6. Let's say unit holder received 16 lakhs. Even the 16 lakhs is also to be apportioned in the ratio of 2:6. 2:6 means what? 2 by 8, 6 by 8. 2 by 8 means 16 into 2 by 8, it will be 4 lakhs. 4 lakhs is capital gains and balance 12 lakhs will be considered as rental income. So the point here is whatever the proportion in which income is received by business trust, in the same proportion income is also taxable in the hands of unit holder. Are you able to understand? I hope you are clear till here. See, 115 BAB still exempt. Okay, one student is asking, sir, if SPV opted 115 BAB, 115 BAB is applicable only for manufacturing. If property is already constructed, then 115 BAB is not applicable. 115 BAA is only applicable. What business trust will do? It will invest in SPV, already constructed property. Okay. Another small concept is there. If we finish this concept, business trust is over. Listen to me. Amma fan ikkada. Sir, if business trust holds 30% shares in SPV, see, that concept is not possible. If minimum 50% or more is invested, then only the concept of business trust is established. I'm going to tell one example now. Listen, you will understand. Let's say there is Umasankar. Uma. Uma is owning 80% shares in Lulu Limited. Shares in, there is one company, Lulu Limited. Just give me 1 second. So, let's say I am 80% shareholder in Lulu Limited, but I wanted to create one business trust with the name Lulu Business Trust. Now, what I will do, Uma is there, Lulu Limited is there, and I will create one new trust called Lulu Business Trust. What I will do, I am holding 80% shareholding now. I will transfer 60% shareholding of Lulu Limited to Lulu Business Trust. In return, what I will receive? In return, I will receive units of Lulu Business Trust. Am I correct? So here what is happening? Actually, I am having one company, but I don't want to own that company completely. I wanted to create business trust. So I created business trust. So after creation of business trust, what I am doing? I am transferring my shares to Lulu Limited, and from Lulu Limited, sorry, I am transferring my Lulu Limited shares to Lulu Business Trust. From Lulu Business Trust, I am taking units. So here I hold more than 50%. So we can what like more than 50% of shareholding is transferred to Lulu Business Trust. Now Lulu Business Trust is holding 60% in Lulu Limited, which is more than 50%. So we can tell Lulu Limited as SPV. Are you able to understand? Special purpose vehicle. In this case, whatever here there is exchange, na? Exchange of what I am doing? Exchange of units of Lulu Limited to receive units of Lulu Business Trust. This exchange is not treated as transfer and no capital gains are required to be calculated. Section 47 is not applicable. Are you able to understand? So this is the concept. I hope you understood, Niranjan. So if anyone wants to create a business trust, in that case, what they will do, whatever the more than 50% shareholding that they are holding, they will transfer to business trust. From business trust, they will receive the units. Thereby, business trust holds more than 50% shareholding in Indian company, which is also called as SPV. Now, here there is exchange of Lulu Limited shares to receive units of Lulu Business Trust. This exchange is not treated as transfer and no capital gains are required to be calculated. Are you able to understand? Next, shall I explain investment fund? Are you clear with business trust? See, Niranjan, prima facie, any business trust is formed to invest in special purpose vehicle to make investment of 50% or more. Still, after creating business trust, let's say here Lulu Business Trust invested 10% in Reliance Limited. From Reliance Limited, it receives dividend. The dividend is taxable at maximum marginal rate. Are you able to understand? That is the concept. If investment is 50% or more, SPV is formed. From SPV, dividend income exempt in hands of business trust and taxable in hands of unit holder. If it is not a SPV, other than from SPV, if dividend income is received, it is taxable at MMR. I hope with this explanation, you got further clarification. Next, investment fund. Niranjan is there or not? Now, investment fund. See, generally, to make investment in startups or to make investment in venture capital entities, the concept of investment fund works. So, if you want to set up any investment fund, your investment should be more than 1 crore rupees. Normal people, we cannot set up investment fund. It's not like business trust. If you have 2000 rupees, 3000 rupees, you can purchase units of business trust. But if you want to set up any investment fund, your investment should be more than 1 crore rupees. So, bada people will do the concept of investment fund. Are you able to understand? Now, I will explain to you. Very simple. Unit holder will make investment in investment fund. What investment fund will do? It will invest in shares, it will invest in securities, or it will invest in startups. From all these, income will be generated na. Whatever the total income is there, that will be passed on to unit holder. Passed on to unit holder. So total income other than PGBP income. Other than PGBP income. PGB, let's say investment fund earned PGBP income. That PGBP income is taxable in hands of investment fund only. Are you able to understand? So very simple. Yeah, like I set up a investment fund, but minimum investment should be more than 1 crore rupees. In investment fund, I invested 6 crore rupees. What investment fund will do using this 6 crore rupees? It will make diverse investment portfolio, shares, securities, gold, startups. It will make investment and it is going to get income. Whatever the income received by investment fund is there, it is not taxable in the hands of investment fund. It is passed on to unit holder. It is taxable in the hands of unit holder except PGBP income. PGBP income received by investment fund is not tax. It is taxable in the hands of investment fund only and not taxable in the hands of unit holder. Are you able to understand? Yeah, these chapters takes less time to prepare and you will get around 5 to 7 marks. Definitely, business trust, investment fund, securitization trust, easily you will get 5 to 7 marks. And whatever the revision that I am doing, it is more than sufficient. I am doing revision in a very slow way. Okay, this is more or less like a regular class only. Now, so very simple, unit holder is there, investment fund is there. In hands of investment fund, total income is exempt, PGBP income is taxable. Vice versa, in the hands of unit holder, all income is taxable, PGBP income is exempt. Sir, why PGBP income is exempt? Because already investment fund is paying tax on PGBP income, na? So that's why it is exempt in the hands of unit holder. Are you able to understand? Now, see this total income is taxable to unit holders, right? So before distributing this total income, TDS is required to be deducted by investment fund under section 194 LBB. Rate of TDS. In case of non-resident or foreign company, TDS rate is rates in force. In case of resident, TDS rate is 10%. If you remember, in TDS TCS chapter, I have told you 194 LBA, 194 LBB, LBC, I will discuss with business trust, investment fund and securitization trust. Now time has come. Here I explained you TDS under section 194 LBB. Okay. Next. Sir, PGBP income is taxable in hands of investment fund, right? What is the tax rate? If investment fund is partnership firm or LLP or company, then tax rate is 25% or 30%. if investment fund is AOP or BOI or any other person, then tax rate applicable is MMR, maximum marginal. So are you able to understand? In hands of investment fund, total income is exempt other than PGBP income. In hands of unit holder, total income is taxable other than PGBP income. In hands of investment fund, PGBP income is taxable. Now, what is the tax rate? If investment fund is partnership firm, LLP company, tax rate applicable is 25% or 30%. If it is AOP, BY or any other person, tax rate applicable is MMR, maximum marginal rate. So till here, are you clear? Now, here one important point is there. Sir, can you explain how investment fund receive PGBP income? So, investment fund can also do business now. Let's say investment fund itself started a startup and investment, let's say I am having 8 crore rupees with me. I started venture capital firm or I started investment firm. Okay, through that investment fund only I started one startup. So it can get, yeah, MMR new scheme 39%, old scheme 42.744%. So investment fund itself can generate PGBP income. Now, see, listen very carefully. In the hands of unit holder, all incomes are taxable other than PGBP. In hands of investment fund, all income is exempt. PGBP income is taxable. So, if there is any PGBP loss will be carried forward by investment fund only. Other head losses will be carried forward by unit holder. Are you able to understand? So let's say other head losses are there. Those losses will also be passed on to unit holder. Just like how incomes are passed on, similarly losses are passed on to unit holder. Unit holder can do set off and unit holder can do carry forward. But if there is any PGBP loss, PGBP loss can be set off only by investment fund only. Here important point is there. Whatever the other head losses are there, they can be carried forward by unit holder only if period of holding is more than 12 months. Are you able to understand? So only if period of holding is more than 12 months, that carry forward is possible. Otherwise losses cannot be carried forwarded. Those losses are dead losses. Those losses will lapse. Those losses investment fund cannot set off, unit holder also cannot set off. So unit holder should hold units for more than 12 months. Then only whatever the losses of investment fund are there, those losses will be passed on to unit holder. Are you able to understand? This is the concept relating to investment fund. I hope you understood this concept of investment fund. Did you understand? Everybody? Are you clear? Shall I explain securitization trust? Next, securitization trust. Yeah, only see unit holder is holding units in investment fund. Whatever the units held by unit holder are there, those units are to be held by unit holder for more than or equal to 12 months. For more than 12 months, then it is long term capital asset. Everybody, whoever are there on live, did you understand this point or do you want me to explain once more? Everyone should respond. Did you understand this point? This point. Next, I will start discussing securitization. Do you know ARC, Asset Reconstruction Company? You would have studied in your AFM, Advanced Financial Management. Do you know ARC? Securitization. I will explain very practically with one small example. You will clearly understand. Okay. So there is a one bank, HDFC Bank, and there is reconstruction company, and there is investor. Now investor invested 1,000 crores in asset reconstruction company. This is investment. See, whatever the loans are there, loans are sold by HDFC to asset reconstruction company. Let's say HDFC gave loans of 500 crores. Now, when HDFC will get back these 500 crores after 15 years, 20 years. Now, it takes lot of time because repayment will be 10 years, 15 years, 20 years like that. But HDFC right now wants liquidity. It wants cash so that it can issue fresh loans. So what HDFC did? HDFC sold all these loans for rupees 550 crores. That means what? HDFC got instant profit 50 crores. Instant profit 50 crores. Are you able to understand? Now, asset reconstruction company sold loans for 550 crores. Now, asset reconstruction company realized 650 crores. How much asset realized company realized? 650 crores. What is cost to it? Cost is only 550 crores. So how much is income of asset reconstruction company? 100 crores. This 100 crores is not taxable in hands of ARC. This 100 crores is taxable in hands of investor. Are you able to understand? So very simple. Securitization Trust or Asset Reconstruction Company, what it will do, it will purchase bad loans from bank, it will realize all the bad loans and it will make money. Whatever the income made by Securitization Trust is there, it is not taxable in the hands of Securitization Trust, it is taxable in the hands of investor. Total income, okay, total income including PGBP income. This total income is exempt in hands of Securitization Trust. But this is taxable in hands of business trust. Sorry, taxable in hands of. Very simple. Simple example, what asset reconstruction company will do? It will purchase bad loans or NPAs or it will purchase good loans also and it will pay lump sum amount. Whatever the loans purchased, these loans will be realized by asset reconstruction company. Whatever the realization is done, from that income or loss will be calculated. Whatever the income by securitization trust is there, total income is taxable in hands of investor only and it is completely exempt in the hands of securitization trust including PGBP income. Sir, here we got income. What if there is losses? Even losses are also passed on to investor. Here, period of holding greater than 12 months, that concept is not applicable. That concept is applicable in investment fund. That concept is not applicable in case of securitization trust. Is it clear? Very simple. Income made by securitization trust exempt in hands of securitization trust, taxable in the hands of investor. If there are losses to securitization trust, all losses will be passed on to investor irrespective of period of holding. 12 months period of holding concept is not applicable in case of securitization trust. It is applicable only in case of investment fund. So did you understand? This is the concept relating to securitization. Now shall we discuss advance tax and interest? Once repeat losses point, sir. Asset reconstruction company is there. Next, bank is there. And investor is there. From bank, loans, 500 crores are taken. Paid 500 crores. Example. But realized amount is 420 crores. What is cost to ARC? Cost to ARC is 500 crores. Now, is there income or loss? Loss of 80 crores. Whatever loss of 80 crores is there, this is passed on to, and this loss cannot be set off by, asset reconstruction. Is it clear? I hope you understood, Madhavi. Losses for investment fund, please repeat, sir. Okay, I will explain to you. Investment fund is there. Unit holder is there. Investment fund got PGBP loss 80 crores. This will be set off by investment fund only. Investment fund got capital loss. Capital loss is 10 crore rupees. Let's say I purchased unit on 10th June 2024. Now, whatever capital loss of 10 crore rupees is there, this will be passed on to unit holder. But I purchased on 10th June 2024. At the end of the year, my period of holding is less than 12 months. So, whatever loss of 10 crores is there, it will not be passed. Generally, other losses other than PGBP, remaining losses of investment fund, they will be passed on to unit holder. But unit holder should hold units for more than 12 months. Then only unit holder can get losses from investment fund. Otherwise, unit holder will lose that losses. Are you able to understand? Those losses will be dead losses. I hope you understood this concept, Niranjan. Niranjan, are you there? Good. Now, so we are done with business trust, investment fund and securitization trust. Now I will explain advance tax. See, generally, as per normal rules, income tax is paid on a yearly basis. If income tax is received every year, but in between months, see, if everyone pays income tax in the month of July and October, for remaining months, government will not get revenue. Na? So the government introduced the concept of advance tax. So every quarter, every person is required to assess his total income based on his assessed total income. He is required to calculate tax liability. If tax liability is 10,000 or more, then every person is required to pay advance tax quarterly. Are you able to understand? So if you see one movie, there is one movie called Ready movie. In that Ready movie, Brahmanandam is the auditor. He will ask. So he will ask for how many times tax will be paid every year. They will tell like hero Ram will tell advance tax like tax will be paid 4 times a year. So when Ram said 4 times a year, it means he is saying advance tax. Okay, advance tax will be paid 4 times a year. Okay, now so whatever this concept of advance tax is there, advance tax is payable on quarterly basis, but some exceptions are there. In case of resident individual, if he is having PGBP income and if PGBP income is not there, then advance tax provisions are not applicable. But in case of resident individual who is a senior citizen, I'm sorry, who is a senior citizen. Senior citizen means what? Greater than or equal to 60 years. So in case of resident individual who is a senior citizen, if he is not having PGBP income, he is not required to pay advance tax. But if he is having PGBP income, then he is required to pay advance tax. Are you able to understand? Advance tax provisions are applicable. How to calculate advance tax? Next concept. Very simple. Like first what you will do, you will estimate total income of SSC. If you don't mind, in CMA final class, I have discussed advanced tax concept. Whatever that running notes is there, I will display that running notes and I will explain to you. It will be easy for you also. Okay. Uh, who said iPad will not struck? I am using this iPad from morning continuously. So this got struck. So how to calculate advance tax? This running notes, if you want, I will share with you. Not a problem. Today, CA Inter, CMA Inter batches got started. In next 20 days, CMA final, CA final regular batches will start for May 2026. Hectic schedule from August 25 onwards. CA Inter, CMA Inter, CA final, CMA final at the same time YouTube videos. Note taking app name. Nowadays I am using Notability. Previously I used it to use Kolla Note. So how do we calculate advance tax? First, we estimate total income of SSC. So as on 1st April of the previous year, we should estimate what will be the total income. On estimated income, we should calculate the estimated tax liability. If estimated tax liability is less than 10,000 rupees, then advance tax provisions are not applicable. Only if estimated tax liability is either 10,000 rupees or more than 10,000 rupees, then only advance tax provisions are applicable. Are you able to understand? Now, then we will estimate TDS credit, TCS credit, relief under section 89 or 91. After estimating it, we are going to calculate balance tax liability. If balance tax liability is greater than or equal to 10,000, then only advance tax provisions are applicable. Otherwise, advance tax provisions are not applicable. Are you able to understand? Now, I took one example. Kartikeya is there. His age is 21 years. He is resident in India and paying taxes under DTR. DTR means default tax regime. Salary 1,50,000 per month. Rental income 40,000. Now, how much is his total income? Salary 1,50,000 into 12 months, 18 lakhs. Amma, from rental income, we will claim standard deduction 75,000. After claiming standard deduction, income from salary is 17,25,000 rupees. And we will calculate rental income. Rental income is nothing but net like rental income is not income from house property. If you remember income from house property provisions, rental income will be considered as gross annual value. Then on such gross annual value, we will claim standard deduction. Thereby, I arrived income from house property 3,36,000. So, how much is my total income? 20,61,000. So, on 20,61,000, estimated tax liability is 3,20,630 rupees. So, from this 3,20,630 rupees, second step is calculation of tax liability. Third step, what I will do? I will also estimate TDS. On salary, TDS will be deducted. Na? Here salary is 17,25,000. On salary, employer will deduct TDS. Na? So here employer estimated TDS. Salary is 17,25,000. On 17,25,000, TDS is 2,15,800. Are you able to understand? So very simple. My total income is 20,61,000, but TDS was deducted on 17,25,000. My tax liability is 3,20,630. My estimated TDS is 2,15,800. What is the additional tax liability that I have to pay? Additional tax liability is 1,04,830, which is greater than 10,000 rupees. So what? See, whatever the balance tax liability is there, it is more than 10,000 na. So advance tax provisions are applicable. Advance tax is required to be paid in 4 installments. So for every quarter, advance tax is paid. What is the due date? For first quarter, April to June, due date is 15th June. For second quarter, July to September, due date is 15th September. For third quarter, October to December, due date is 15th December. For fourth quarter, January to March, due date is 15th March. Very simple to remember. Every quarter, last month 15th is due date for payment of advance tax. So here you can see on or before 15th June. That means first installment, minimum 15% advance tax is required to be paid. For second installment, minimum 45% advance tax is required to be paid. For third installment, minimum 75% advance tax is required to be paid. By fourth installment, that means before 15th March, 100% of advance tax is required to be paid. Are you able to understand? So these are the due dates: 15th June, 15th September, 15th December, and 15th March. So till here, did you understand, everybody? Comment. Now, do you remember 44 AD presumptive income? So those who are paying taxes under 44 AD, 44 ADA, for them 4 installments are not there. For them, like that means They are not required to pay advance tax in 4 installments. It is sufficient if they pay advance tax in a single installment. For them, there is only one installment due date, that is on or before 15th March. So on or before 15th March, they are required to pay advance tax in a single installment. Because for them presumptive provisions are applicable. Presumptive income is calculated on turnover or gross receipts. How do we know turnover or gross receipts at the beginning of the year? Not possible na. So for advance tax installments concept is not applicable. Those who are paying taxes under 44 AD ADA, they are required to pay entire advance tax in a single installment on or before 15th March. Is it clear? Next, returned income, assessed income, returned tax, assessed tax. See, I filed my income tax return. As per my income tax return, my total income is 15 lakh rupees. So whatever the income that I disclose in my ITR is there, that income is called as returned income. On returned income, whatever the tax liability is there, that tax liability we call as returned tax. Are you able to understand? Next. After I file my income tax return, we have discussed assessment procedures in last lecture. You know, like intimation will be generated by system, or assessing officer will do scrutiny. He will do scrutiny assessment 143.3, or income escaping assessment will be done. So whatever the income assessed by assessing officer is there, that income we call as assessed income. On assessed income, whatever tax liability is there, that tax liability we call as assessed tax. Very simple. I disclosed 15 lakhs. Income tax officer has done assessment. He disclosed income as 18 lakh rupees. So whatever 15 lakhs I disclosed in my ITR is there, 15 lakhs is returned income. Tax on 15 lakhs is returned tax. Thereafter, addition was done by income tax officer, like 3 lakhs addition. Income determined by assessing officer 18 lakhs. Whatever the income determined by assessing officer is there, that we call as assessed income. On that 18 lakhs, whatever the tax is there, that tax we call as assessed tax. Are you able to understand? That is the difference between returned income, returned tax, assessed income, assessed tax. You need to know the difference, because interest under section 234C is calculated on returned tax. Interest under section 234B is calculated on assessed tax. Are you able to understand? So that's why you need to know the difference between returned tax and assessed tax. Now, we will discuss interest under section 234B. Shall I discuss 234B? Everybody? Let's say previous year 24-25 is there. Corresponding assessment year is assessment year 25-26. Now, in previous year 24-25, there are 4 due dates na, for payment of advance tax: 15 June, 15 September, 15 December, 15th March. Within these 4 due dates, if I do not pay advance tax, then I need to pay interest under section 234C. Very simple. If you do not pay advance tax on time, interest under section 234C will get attracted. Are you able to understand? Interest under section 234B. It will be levied from 1st April of assessment year. From 1st April of assessment year up to date of completion of assessment. Interest will be levied under section 234B. Once previous year is over, no concept of interest under section 234C. After completion of previous year, starting from 1st April of assessment year, interest under section 234B gets attracted. Are you able to understand? Good. Next. See, you like ITR due date is there 31st July or 31st October. You did not file ITR within the due date. For not filing ITR within the due date, whatever the interest that is levied, that interest we call as interest under section 234A. So for late filing of ITR, whatever the interest that is levied, that interest will be levied under section 234A. So very simple, interest under section 234C, it is calculated on returned tax. Interest under section 234A, 234B, these will be calculated on assessed tax. So this is summary to understand. Next, shall I explain further? We will discuss interest under section 234B. Interest under section 234B gets attracted in two cases. Either if you do not pay advance tax, interest under section 234B is attracted. You had paid advance tax, but advance tax paid is less than or equal to 90% of assessed tax. In this case also, interest under section 234B gets attracted. Now, sir, how to calculate on which amount interest under section 234B is applicable? Interest under section 234B is applicable on shortfall amount. So what you will consider, if advance tax was not paid, you will take assessed tax. From assessed tax, you will take credit, TDS, TCS credit. You will take relief under section 89 or 91. You will calculate shortfall. Whatever the shortfall is there, on shortfall, interest will be calculated under section 234B. That means on total tax liability, interest is not levied. From total tax liability, TDS, TCS credit, relief will be reduced. On balance income only, interest under section 234B gets attracted. If we have paid advance tax, whatever the advance tax paid is there, that is also allowed as relief, and only whatever the balance shortfall is there, only on balance shortfall, interest gets attracted under section 234B. Is it clear? Sir, what is the duration? Interest under section 234B will be calculated from 1st April of assessment year till date of completion of assessment. Rate of interest is 1% per month or part of the. Is it clear? This is about interest under section 234B. I already told you, within current previous year, 4 advance tax due dates are there: 15 June, 15 September, 15 December, 15th March. Within these due dates, if advance tax was not paid, then interest under section 234C gets attracted. Are you able to understand? But interest under section 234C is not calculated on assessed tax, it is calculated on returned tax. Returned tax means tax on returned income. So you will take tax on returned income. From that, you will take TDS or TCS credit. You will claim relief under section 89 or 91. You will get balance tax liability. Whatever balance tax liability is there, if it is greater than or equal to 10,000, then interest under section 234C gets attracted. So what is the amount? On or before first quarter, on or before 15th June, minimum 15% advance tax is required to be paid. So 15% will be compared with actual advance tax paid. Whatever the difference is there, shortfall. On such shortfall, interest will be levied at the rate of 1% per month for 3 months. Are you able to understand? Next. Second due date is 15th September. Minimum 45% is required to be paid. That will be compared with actual advance tax paid. Difference is shortfall. On the shortfall, interest will be levied at the rate of 1% per month for 3 months. Is it clear? Next. Q3, 15th December is due date. Minimum 75% advance tax is to be paid. That will be compared with actual advance tax paid. Difference is shortfall. On the shortfall, interest will be calculated at the rate of 1% for 3 months. Last due date, last quarter due date is 15th March. Before 15th March, 100% advance tax is payable. That will be compared with actual advance tax paid. Difference is shortfall. On such shortfall, interest is applicable. Rate of interest 1% per month for 1 month. Because see, after completion of previous year, 234B comes. So 234C is up to March only. Due date is 15th March. If you do not pay before 15th March, for next 15 days, rounded off as 1 month, 1 month interest will be calculated. Are you able to understand? Interest under section 234A. I have already told you, Why interest under section 234A gets attracted? Interest under section 234A gets attracted for late filing of ITR. If you file your ITR lately, then you are required to pay interest under section 234A. So two cases. If you file ITR lately, then interest will be calculated from first day after the due date. First day after due date till date of actual ITR filing. But you have not filed ITR at all. You did not file ITR at all. In that case, interest under section 234A will be calculated from first day after the due date up to the date of completion of assessment. Okay. What, like, interest is again not calculated on total tax liability. Interest is calculated on shortfall. Assessed tax, from assessed tax you will take credit of TDS, TCS, relief, advance tax paid. If you have paid any self-assessment tax, that also you will take as credit. Whatever the balance shortfall amount is there, on such shortfall you are required to pay interest under section 234A will be calculated. Is it clear? So this is the concept. Next, there are four incomes: dividend income, capital gain income, winnings, winning from lottery, betting, gambling, horse races, 115BB income, 115BBJ, winning from online games, first year PGBP income. These four incomes are not predictable. Na? How can you, let's say I am having 1 lakh shares in Wipro Limited for 25-26, how much dividend Wipro Limited pays? How can I expect? That is not possible. Na? That is the decision of board of directors. So whatever these four incomes are there, dividend income, capital gain income, first year PGBP income, 115BB, BBJ income. These four incomes are unpredictable. So for these four incomes, even though you do not pay advance tax, that is fine. But the quarter in which you get these incomes, from that quarter onwards, you are required to pay advance tax. Let's say I received a dividend in the month of November. November falls under Q3, October to December. So if I receive dividend income in the month of November, on such dividend income, I am required to pay advance tax in third quarter. 75% advance tax I have to pay. That is the concept. Are you able to understand? So this is all about business trust, investment fund, securitization trust, and advance tax and interest. Hope clear revision was done. Okay, now let us start with our session. Nobody is here eternally. One fine day, our day will also come. Then also we need to live apart. As long as we are there in this world, let's maintain decorum. Let's contribute to our country. And okay. Yes, we will start with TDS and TCS chapter. My dear students, there are certain sections relating to TDS which I will discuss in NR taxation. For example, there are sections 194E, TDS in case of non-resident sports association or non-resident entertainer or non-resident sports person. Section 195, TDS in case of non-resident. And 194 LB, 194 LC, 194 LD. These sections I will cover with you in NR taxation because I can do interlinking. I can tell the provision in NR taxation. Simultaneously, I can also discuss with you TDS provision. If I tell only TDS provision now, it will be half-half. Okay, it will be raw, uncooked, half-cooked. Okay, you may not understand. Next, I will also explain 196A, 196B, 196C, 196D, these sections in NR taxation. Next, there are some sections 194 LBA, 194 LBB, 194 LBC. These three sections I will explain in tomorrow's class. Tomorrow we will discuss about taxation of business trust, taxation of investment fund, and taxation of securitization trust. With regard to those sections, these TDS provisions are applicable: 194 LBA, 194 LBB, 194 LBC. On a standalone basis, if I discuss only TDS provision with you, you will not understand. So I will discuss taxation of business trust, taxation of investment fund, taxation of securitization trust. Simultaneously, I will also discuss 194 LBA, LBB, LBC. So when I explain along with that concept, you will understand the TDS provision better. So in today's class, other than these TDS sections, remaining all TDS sections I am going to cover. Are you able to understand? So shall we start now quickly? Everybody. So first we will discuss about section 192. When TDS is required to be deducted under section 192, whenever the amount paid, the transaction, whenever the transaction is relating to salary, then TDS is required to be deducted under section 192. Generally, who will deduct TDS? Payer will deduct TDS before making payment to payee. So in this case, employer, before making salary payment to employee, employer is required to deduct TDS under section 192. Sir, at what rate TDS will be deducted? Generally, TDS will be deducted at average rate. You know average rate, right? Average rate means tax divided by total income into 100. That we call as average tax rate. Am I correct? Average tax rate. See, what we will do, what employer will do, employer will calculate total income of employee. Whatever the tax liability of employee is there, the tax liability he will deduct as TDS in 12 months. Are you able to understand? So before completion of previous year, entire tax liability is required to be deducted by employer in the form of TDS to employee. I will tell one example. Total income of employee is 20 lakhs. Let's say tax liability is 4 lakh rupees. What employer will do? 4 lakh divided by 12 months. How much it will be? 33,333. So every month 33,333 will be deducted as TDS before paying salary to the employee. Are you able to understand? So using slab rates, employer will calculate tax liability of employee. Whatever the tax liability is there, tax liability divided by total income into 100. You are going to get average rate. As per that average rate, employer will deduct TDS from employee. Now you will get many questions. Sir, whether at the time of calculation of income of employee, whether employer can adjust losses? Yes. If employee is having losses, employer can adjust those losses on net total income. Employer can calculate the tax liability, but only loss from house property can be considered by employer. If employee gives business loss is to be ignored. If employee gives capital loss, it needs to be ignored. If employee gives any loss, all the losses are to be ignored by employer. Only loss from house property will be considered by employer while calculating the average tax rate of employee. Are you able to understand? Next, only in case of salary, TDS is required to be deducted at the time of payment. Generally, TDS is required to be deducted on accrual basis or cash basis, whichever is earlier, but only in case of salary, TDS will be deducted only at the time of payment. In current previous year, no salary was paid to me. Employer will not deduct TDS. Employer will deduct TDS only if salary is actually paid. Only at the time of payment, TDS will be deducted. Next, let's say there is one coordinator, batch in charge. His salary is 20,000 rupees per month. How much will be his total income? He is having no income, no other incomes. So 20,000 into 12, 2,40,000. His salary is less than basic exemption limit. In that case, employer will not deduct TDS. So if total income of employee is less than basic exemption limit, TDS will not be deducted. Are you able to understand? Next, what employee will do? Employee will shift from one organization to another organization. If he shifts at the end of the year, not a problem. Or if he shifts at the beginning of the year, not a problem. But if he shifts from one company to another company in the middle of the previous year, in that case, whatever the salary details of older employer are there, if those details are submitted to new employer will also consider salary details of older employer in calculation of total income and calculation of TDS rate. Are you able to understand? So generally employer, sir, there are two tax regimes, na? Default tax regime, optional tax regime. Generally, employer will deduct TDS under default tax rates. But if employee requests employer to deduct to calculate tax liability as per optional tax rates, then employer will calculate tax liability as per optional tax rates. But under optional tax rates, Chapter 6 deductions, HRA, leave travel concession, many benefits employee can avail under optional tax rates. So whenever optional tax rates are there, in case of optional tax rates, employer, before giving exemption to employee, 4137 అని చెప్పు 37. So what I'm saying, yeah, under optional tax rates, before giving exemption, HRA exemption, or before giving Chapter 6 deductions, ATC, ATD, employer should collect all the particulars from employee, keeping them as evidence. Then only employer is required to deduct TDS. Are you able to understand? Another important point. See, when employer is giving HRA exemption to employee, if the amount of rent paid by employee is more than 1 lakh rupees per annum, owner PAN number is also required to be taken. Are you able to understand? After taking owner PAN only, HRA exemption will be allowed by employer to the employee under optional tax rates, because in MCQs that can be asked. Okay, more than 1 lakh rupees rent paid by employee, in that case, PAN number of the owner will also be taken by employer and it will be disclosed while filing TDS return. So this is the concept relating to TDS under section 192. I hope you are clear with section 192. If you have any doubt, you can ask me. Clear? Good. You can see for allowing HRA allowance, if rent exceeds 1 lakh rupees, PAN of the landlord is required to be taken. For all other allowances, evidence of expenditure is to be taken. For allowing interest under income from house property, name, address and PAN of the lender is required to be taken. For Chapter 6 deductions, evidence of expenditure is required to be. Section 192A. You know employee provident fund, right? From employee provident fund, if any amount is withdrawn by employee, at the time TDS will be deducted by PF authorities. The point here is, you would have studied in your CA inter salaries. In final, no faculty will discuss salaries, but I will give brief about it so that you will get an idea. If you have 5 years of continuous service, after 5 years of continuous service, if you withdraw amount from provident fund account, then TDS will not be deducted. But if you withdraw, why TDS will not be deducted? After 5 years, if you withdraw money from recognized provident fund, it is not taxable to the employee. As it is not taxable to the employee, TDS is not required to be deducted. Are you able to understand? But before 5 years of continuous service, if employee withdraws money from recognized provident fund, then it is taxable to the employee. As it is taxable to the employee, provident fund authorities are required to deduct TDS under section 192A whenever there is premature withdrawal. Premature withdrawal means withdrawing PF amount before 5 years of continuous service. In that case, provident fund authorities will deduct TDS under section 192A. Are you able to understand? Now, sir, even like there is urgency, I do not have any money, I withdraw only nominal amount 10,000 rupees, 15,000 rupees. For that also TDS will be deducted? No. If you withdraw up to 49,999, no TDS will be deducted. But if you withdraw from recognized provident fund before 5 years, either 50,000 rupees or more than 50,000 rupees, TDS will be deducted. Sir, what is the rate of TDS? Rate of TDS is 10%. Are you able to understand? Even under section 192A also, TDS will be deducted only at the time of payment. Are you able to understand? Here, another important point is there. I worked in Infosys for 3 years. Afterwards, I shifted to TCS. In TCS, I worked for another 4 years. Now, independently in Infosys, I worked for 3 years. In in TCS, I worked for 4 years. Total 7 years I worked, but 3 years with organization 1, 4 years with organization 2. In this case, whenever I shift from one organization to another organization, if I also shift my PF account from Infosys to TCS, if I shift the account, recognized provident fund account, then I will be deemed as in continuous service for 5 years or more than 5 years. Are you able to understand? So very simple. Whenever employee is shifting from one organization to another organization, if employee shifts his provident fund account, then it will be deemed as employee is in continuous service only. Are you able to understand? Now, if I shift my account from Infosys to TDS, my total continuous service is 7 years, which is more than 5 years. So no TDS is required to be deducted. Are you able to understand? Otherwise, if I do not transfer my PF account, then the service is getting braked. I worked in TCS for 4 years, which is less than 5 years. TDS will be deducted by PF authorities. Are you able to understand? There is some exceptions. Let's say I withdraw amount from recognized provident fund before 5 years of continuous service. The reason is because of ill health. See, I wanted to work in an organization, but my health is not supporting. So that's why I stopped my employment before 5 years of continuous service. Under that, so because of health reasons, if I stop employment, then TDS will not be deducted by PF authorities. Second reason, I am working in one organization from 4 years. In current year, that organization was closed. What can I do if employer closed the business? That's not my mistake, right? In that case also, if I withdraw money before 5 years of service, no TDS will be deducted. Are you able to understand? Section 193, interest on securities. So are you clear with 192A? Everybody? So today, very hectic session. Morning, I took class for capital gains, CA Inter. Lengthy. Now again TDS and TCS. So shall I explain 193? Interest on securities. See, other than on government securities, if any interest is paid, on such interest, TDS is required to be deducted under section 193. For example, like company issued debentures, listed company issued bonds. Okay, before paying interest, TDS is required to be deducted. Who will deduct TDS? Any person who is paying interest will deduct TDS. Next, when only if interest is paid to resident, then only TDS is required to be deducted under section 193. If interest is paid to non-resident, then section 195 gets attracted. That's why only if interest payment is made to resident, then only TDS is required to be deducted under section 193. Sir, what is the rate of TDS? 10%. When TDS will be deducted, accrual or cash basis? The date on which interest entry is passed in books of accounts, or the date on which interest is actually paid, whichever is earlier. On that earlier date, TDS will be deducted. So very simple, date of entry in books of accounts or date of actual payment, whichever is earlier date is there, on that earlier date, TDS will be deducted. Are you able to understand? Let us see the note points. Under section 193, TDS is not required to be deducted in certain cases. What are those cases? No TDS if interest is paid to an individual or HUF on debentures issued by public company where interest does not exceed 5,000 and paid by account payee check. See, this is a lengthy sentence, complex. Let us simplify this. 4 conditions. TDS is not required to be deducted on payment of interest if 4 conditions are satisfied. Condition 1. Interest is paid to individual or HUF. Are you able to understand? Next. Second condition. On which securities interest is paid? Interest is paid on debentures issued by public company. Are you able to understand? Next. Third condition. Amount of interest should be less than 5,000. Such interest should be paid by way of bank transaction. If these 4 conditions are satisfied, no TDS is required to be deducted under section 193. Are you able to understand? So quickly, 4 conditions. What are the 4 conditions? Interest should be paid to individual or HUF. On which interest is to be paid? Interest is to be paid on debentures issued by public company. Amount of interest less than 5,000, interest paid by way of bank transaction. If all these 4 conditions are satisfied, no TDS is required to be deducted under section 193. Is it clear? To LIC, GIC or any other insurers. See, we will pay LIC premium na, or we will pay medical insurance premium. We will pay lot of amount to life insurance companies. What life insurance companies will do? Whatever the amount collected from various insured people are there, all this money they will invest in shares or debentures of listed companies. They will invest entire this money in capital market. Now, whenever this entire money is invested in capital market, so let's say life insurance corporation, it collected money from all insurance holders and it deposited money in, it purchased debentures of Reliance Industries Limited. Now Reliance Industries Limited will pay interest on debentures, right? On such interest, Reliance Industries Limited is not required to deduct TDS. So very simple thing, payee. Payee means what? The person to whom interest is paid. So if any interest is paid to LIC, GIC or any other insurance company, no TDS is required to be deducted under section 193 irrespective of threshold limit. Okay, whatever the amount, interest amount that is paid to LIC, GIC or any other insurance company is there, no TDS is required to be deducted. Is it clear? On 7-year national savings certificates. So like you would have studied national savings certificates. If you purchase NSC certificates, whatever the amount that you invested in NSC certificates, it is eligible for deduction under section 80C. Okay, do you remember? But that the deduction is available only under optional tax rates. But the point here is, whenever you purchase national savings certificates, on that interest will be paid. On such interest, no TDS will be deducted under section 193. Next, on national development bonds, on bonds issued by Power Finance Corporation Limited, Indian Railway Finance Corporation Limited. Do you remember exemption under 54 EC? In morning class only I have explained. Do you remember 54 EC? What is the combination under 54 EC? Can anyone tell? Sir, bhul gaya, we forgot. Combination under 54 EC. Nobody remembers 54 EC. Not even one person. So unfortunate. Yeah, investing in bonds by selling immovable property to claim exemption. Perfect. See, whenever immovable property is transferred, on transfer of immovable property, capital gains will come now. If those capital gains are reinvested in NHAA bonds or RECL bonds, recent amendment, Power Finance Corporation Limited bonds or Indian Railway Finance Corporation Limited bonds. In these 4 bonds, if you make reinvestment, you can claim exemption under 54 EC, but maximum exemption allowed is 50 lakh rupees. Now, see, whenever you purchase Power Finance Corporation bonds or Indian Railway Finance Corporation bonds, on those bonds, you will be paid interest now. On such interest, no TDS will be deducted under section 193. Is it clear? On government securities, generally On government securities, if any interest is paid, no TDS will be deducted. Treasury bonds, treasury bills, whatever the government securities that are issued, on government securities, if any interest is paid, no TDS will be deducted except in these cases. That means in these cases, even though they are government securities, still TDS will be deducted under section 193. What are those securities? Interest on 8% savings taxable bonds, 2003. I don't think they are in existence till now. 2003 means 20 years ago. Okay, but in Income Tax Act it was not removed. It is very old act. That's why Nirmalamma, she is attempting to bring Income Tax Act 2026 as soon as possible, ASAP. 7.75% savings taxable bonds. So remember one thing, savings taxable bonds. If any interest is paid on savings taxable bonds, then TDS is required to be deducted. Next, floating rate savings bonds 2020 with effect from 1st October 2024. This is also amendment made in Finance Act 2024. So in these three cases, whatever these three cases now, in these three cases, if amount of interest is less than or equal to 10,000, no TDS is required to be deducted. If amount of interest is more than 10,000 on above three securities, then TDS is required to be deducted. What I said? Let's come back. On government securities, no TDS is required to be deducted under section 193 except in three cases. Savings taxable bonds 2003, savings taxable bonds 2018, floating rate savings bonds 2020. This is from with effect from 1st October 24. On these three government securities, if amount of interest is less than or equal to 10,000, no TDS. If amount of interest is more than 10,000, TDS is required to be deducted under section 193. Is it clear? So everybody clear with section 193? Tell. Actually, there is some time gap. I think more than 20 seconds time gap is there in between you and me. Next, we will discuss section 194, dividend. See, if any dividend is paid, generally on dividend, TDS will be deducted under section 194. But there is some threshold limit. You know threshold limit now. If there is threshold limit, up to threshold limit, no TDS will be deducted. If payment is more than threshold limit, then TDS will be deducted. Are you able to understand? So if amount of dividend paid is up to 5,000 rupees, in case dividend paid to individual by any mode other than cash in a previous year, that means what? Dividend is paid to individual, amount of dividend is less than 5,000 rupees or equal to 5,000 rupees, and the dividend is paid by way of bank transaction, then no TDS will be deducted. However, if amount of dividend is more than 5,000 rupees, even in case of individual or HUF, TDS will be deducted under section 194. Who will deduct TDS? The company which is paying dividend, it will deduct TDS. Only if dividend is paid to resident shareholder, then only 194 gets attracted. If dividend is paid to non-resident shareholder, then section 195 or other sections which will get attracted, section 194 will not get attracted. Rate of TDS 10%. When TDS will be deducted? At the time of payment. But if any dividend is paid to LIC, GIC or any other insurance company, no TDS will be deducted. So you can remember one thing, whenever interest or dividend is paid to LIC, GIC or any other insurance company, no TDS will be deducted under section 193 or section 194. Very simple. Payee, the person who is receiving the amount. If payee is LIC, GIC or any other insurance company, no TDS will be deducted under section 193 or 194. Next, section 194A. This is also a bit important, lengthy one but important. To the extent possible, I will try to finish TDS, but I don't want to compromise. Concept thoroughly I will revise. Section 194A, interest other than interest on securities. See, those who joined lately, if you want this PDF is available in my Telegram channel. You can download the PDF. So this will work as a navigation for the concepts that I am explaining. Okay. See, on securities, if any interest is paid, TDS is required to be deducted under section 193. Other than securities, on securities, if any interest is paid, TDS will be deducted under section 194A. Sir, other than on securities means, let's say you have done fixed deposit in SBI 20 lakh rupees. On 20 lakh rupees fixed deposit, interest will be paid to you. Now, before paying that interest, TDS will be deducted under section 194A. So other than on securities, intercorporate loans are there. One company took loan from another company. Now the borrower will pay interest to another company, right? Before paying such interest, TDS will be deducted under section 194A. So other than on securities, if any other interest is paid on whatever the loans or borrowings is there, on such interest, TDS is required to be deducted under section 194A. Are you able to understand? But threshold limit is there. For normal citizens means what? Those individuals whose age is less than or equal to 60 years, they are called as normal citizens. For normal citizens, if amount of interest paid by bank is up to 40,000 rupees, in case of one or more fixed deposits, then no TDS will be deducted by bank. In case of senior citizens, up to 50,000 rupees. Senior citizen means what? When we call an individual as senior citizen, only if he is resident individual above greater than or equal to 60 years, we call as senior citizen. So that benefit, 50,000 benefit is available only for residents. Remember, see, non-resident aged more than 60 years, still threshold limit is 40,000 only. Are you able to understand? So senior citizen, very senior citizen. Like senior citizen means, or very senior citizen means resident whose age is greater than or equal to 60 years or greater than or equal to 80 years. So whenever bank pays interest on fixed deposit or recurring deposit, whatever the interest that bank pays, okay, overall interest paid for all FDs, RDs together in a financial year, if it is more than 40,000 rupees in case of normal citizen, TDS will be deducted. If it is less than or equal to 40,000, no TDS will be deducted. In case of senior citizen or very senior citizen, if amount of interest paid is more than 50,000, then only TDS will be deducted. Otherwise, no TDS will be deducted. Is it clear? Next, sir, 40,000 limit or 50,000 limit, is it per bank or is it per branch? If bank is having core banking solutions, then per bank. For all branches together, if amount of interest paid is more than 40,000, TDS will be deducted under section 194A. Are you able to understand? For example, let's say I went to one bank, Bandhan Bank. Okay, so it wants to create Bandhan with more customers, but customers are not there. Okay, so the name of the bank is Bandhan Bank. So in Bandhan Bank, I wanted to do fixed deposit. In Bandhan Bank, there is no core banking solution. It is a loophole to me. So I will invest in one Vijayawada branch of Bandhan Bank. I will also invest in Guntur branch of Bandhan Bank. I will invest in Hyderabad branch of Bandhan Bank. I will ensure in each branch amount of interest is less than 40,000 rupees, so no TDS will be deducted. So if core banking solution is not there, then per branch limit applicable is 40,000 or 50,000. If core banking solution is there, then per bank for all branches together limit applicable is 40,000 or 50,000. Is it clear? If interest is paid by any person other than bank, post office or cooperative bank, bank, post office, cooperative bank, they are paying interest. Threshold limit is 40,000 or 50,000. Other than bank, if any other person pays interest, threshold limit is 5,000 rupees. If interest paid is up to 5,000, no TDS. If interest paid is more than 5,000, TDS will be deducted under section 194A. Are you able to understand? So only if interest is paid to resident, then only TDS will be deducted under section 194A. If interest is paid to non-resident, other section will get attracted. Sir, what is the rate of TDS? Rate of TDS is 10%. When TDS will be deducted, accrual basis or cash basis? So at the time of entry in books of accounts or at the time of payment, whichever is earlier, TDS will be deducted. Next, sir, whether let's say I am an individual, I am not having any money, I am not doing any business, I am not doing any profession, I am just having salary income. Am I also required to deduct TDS before paying interest to any borrower? That depends. Okay, so all payers are not required to deduct TDS. Only if payer is eligible payer under section 194A, then only TDS is required to be deducted. Otherwise, TDS is not required to be deducted. So for you, I simplified the provision. There are 5 sections: 194A, 194A, 194C, 194R, 194I, 194H. So in all these cases, if payer is, what are those cases? 194A, 194C, 194R, 194I, 194H. In all these cases, if payer is individual or HUF, if payer is other person, if payer is other persons, they are mandatorily required to deduct TDS. Mandatorily required to deduct TDS if payment is more than threshold limit. That's what na. If payment is less than threshold limit, no TDS is required to be deducted. Only if payment is more than threshold limit, then only TDS is required to be deducted by other persons. But if payment is made by individual or HUF, then there is classification. In case of that individual or HUF, in preceding financial year, if business turnover is less than or equal to 1 crore, or in profession, if gross receipts are less than or equal to 50 lakhs, then no TDS is required to be deducted. In preceding financial year, in business, if turnover is more than 1 crore, in profession, if gross receipts are more than 50 lakhs, then TDS is required to be deducted. TDS required to be deducted only if payment is more than 50 lakhs. Only if payment is more than 50 lakh rupees. Are you able to understand? Sir, how to remember these many sections? I have one logic for you. C H A I R. So 194 chair. Okay. Acronym is 194 chair. Easy. So in case of 194 chair, 194 CHAIR, in these cases, if payer is other than individual or HUF, mandatorily required to deduct TDS. If payer is individual or HUF, then we have to check in preceding financial year if business turnover is less than or equal to 1 crore. In profession, gross receipts are less than or equal to 50 lakhs, no TDS. Otherwise, TDS is required to be deducted if payment crosses threshold. Is it clear? So this is 194A is not over. Exceptions are there. I need to discuss exceptions. See, the section is very vast. Despite how much we discuss, still something is left. Okay. See, income tax department is saying any person who pays interest is required to deduct TDS under section 194A. Whenever there is refund na, income tax department will also pay interest kada. Interest on income tax refund. Whenever income tax department is paying interest on refund, it is not required to deduct TDS. It has written provision for its favor. So lawmakers have written provision in their favor. Whenever income tax department pays interest on income tax refund, no TDS is required to be deducted by department. Is it clear? Next, bank savings account. Let's say I deposited 1 crore in bank savings account. I forgot. Please don't think I am arrogant. It is just an example. I deposited 1 crore in savings account. I forgot. On 1 crore rupees, 4% interest, 4 lakh rupees is credited. 4 lakh is more than 40,000 or 50,000. Na, still no TDS will be deducted. Whatever the interest that is paid on savings bank account is there, on such interest, no TDS will be deducted. Next, interest paid to any bank, cooperative bank, LIC, UTI, any insurer, National Skill Development Fund, Housing and Urban Development Corporation. See, for these persons, if any interest is paid to LIC, GIC, any insurance company, National Skill Development Corporation, Housing and Urban Development Corporation, HUDCO, okay, Housing and Urban Development Corporation. For these 5 persons, if any interest is paid, no TDS is required to be deducted under section 194A. See, in one question, I think in PGBP question, interest was paid to non-banking financial company. Whenever interest is paid to NBFC, TDS is required to be deducted under section 194A. Normally, what student thinks NBFC is also bank na, so he will assume TDS is not required to be deducted. That's the exact point where you fall to the trap of ICAI. Whenever interest is paid to NBFC, my dear students, please remember TDS is required to be deducted under section 194A. Is it clear? TDS is collected from 1 crore income. I did not understand your question, Gopal. Okay, whatever the doubts that you have, please ask at the end of the session, because I'm in flow. I need to complete as much as possible to TDS today. Okay, fine. Next, zero coupon bonds. You know zero coupon bonds, right? They are always issued at discount and are redeemed at par, redeemed at face value. So whenever interest is paid on zero coupon bonds, no TDS is required to be deducted. Sorry, interest is not paid on zero coupon bonds. Like difference between face value and purchase price, that amount is the gain made by purchaser of zero coupon bonds. On that gain also, no TDS will be deducted. Next, interest paid by cooperative society other than cooperative bank to its members or any other cooperative society. What do you mean by this? Very simple. Cooperative society is there. It paid interest to another cooperative society, or it paid interest to its members, its own members. On this interest, no TDS is required to be deducted by cooperative society. Okay, payer is not required to deduct any. Interest paid or credited by partnership firm to its partners. See, whenever partnership firm pays any interest to its partners, on such interest, no TDS is required to be deducted. This is as per Finance Act 2024. As per Finance Act 2025, amendment is there. Partnership firm also, before it pays interest to partner, partnership firm is required to deduct TDS. Okay. So, you are like, I wish you should clear in September 25 or January 26. So you will not study this amendment. But in worst case, if you are studying for May 2026, then I will explain the amendment. Whenever interest is paid by partnership firm to partner, on such interest, TDS is required as per Finance Act 2025. TDS is not required as per Finance Act 2024. Game over. What are you commenting? I am not understanding. Interest credited on compensation amount awarded by Motor Accidents Claim Tribunal. Credited means what? Accrual basis. What we discussed as per section 194A, TDS is required to be deducted on accrual basis or cash basis, whichever is earlier. Na? So, like Motor Accidents Claim Tribunal, it has declared the compensation more than 50,000 rupees. Then TDS is then TDS is, one second, Motor Accidents Claim Tribunal. On accrual basis, no TDS is required to be deducted. On payment basis, if payment is more than 50,000, then TDS is required to be deducted under section 194A. If payment is less than or equal to 50,000, then no TDS under section 194A. Are you able to understand? So, compensation paid by Motor Accidents Claim Tribunal on accrual basis. Whenever it declares compensation, no TDS is required to be deducted. Whenever it actually pays interest, if amount of interest is less than or equal to 50,000, no TDS. If amount of interest is more than 50,000, TDS is required to be deducted under section 194A. Is it clear? Next, 194A do not apply to fixed deposit made in the name of Registrar General of Court. See, if there is any disputed amount, that disputed amount will be deposited in the name of court till the judgment comes. After judgment comes, the disputed amount will be given to the SSC. Now, whatever the disputed amount that is deposited in the name of court is there, on that amount interest will be paid by bank na. On such interest, no TDS is required to be deducted. So whenever interest is paid to court in the name of court, no TDS is required to be deducted. Next, in case of minor, generally in case of minor, like income will be clubbed in the hands of parents. So whenever TDS is required to be deducted in the hands of minor, generally PAN number of parents will be taken. In the name of PAN number of parents only, TDS will be deducted. If such PAN number is not given, for minor PAN number will be applied, and in the name of minor only, TDS will be deducted. Next, capital gains account scheme, you know, right, under section 54. Sir, can you tell the amendment once again? Which amendment? Which amendment, Raghavan? With regard to 194A, we did not discuss any amendment. No? Okay, you can ask me the amendment at the end of the class. Now, capital gains account scheme. See, like to claim exemption under 54, 54B, 54D, 54EC, before ITR due date only, I will invest some money in capital gains account scheme. Thereafter, I will use that money for purchase of house property or construction of house property. Whatever the amount deposited in capital gains account scheme, on that interest will be paid. Such interest, TDS will be deducted. But like if there is death of depositor, up to the date of death, whatever the interest paid, on such interest, TDS will be deducted in the name of depositor who has died. On or after death, whoever his legal heir is there, in the name of legal heir, interest will be paid. On such interest, TDS will also be deducted in the name of legal heir. Is it clear? Next, section 194B. No, you are preparing for September 26. Okay, September 26, Jan 27. For you, Finance Act 2025 is applicable, which is right now used in the market. New Income Tax Act is not applicable. Finance Act 2025 is applicable. Okay. 194B, you know 194B na? Winning from lottery, betting, gambling, okay, crossword puzzles. Whenever section 115BB income is there, whenever 115BB income is paid, before paying such amount, TDS will be deducted under section 194B. However, if lottery income, betting income, gambling income is less than or equal to 10,000 in a financial year, no TDS will be deducted under section 194B. Payer, the person who is paying amount, he can be any person. Payee also any person, resident or non-resident. TDS rate of TDS is 30%. When TDS will be deducted at the time of payment. So till now we have come across three sections where TDS will be deducted at the time of payment. One is section 192, another one is section 192A, another one is section 194B. Are you able to understand? Next. See, winning is in cash. Happy. Whatever the amount is there, 30% will be deducted, 70% will be paid. However, if winning is not in the form of cash, winning is in the form of kind, then let's say there is a lottery. In lottery, I won one car, XUV 700, 25 lakh rupees. Before they hand over 25 lakh rupees car to me, they will ask me to deposit 30% to income tax department. So what I should do, 25 lakhs into 30%, 7 lakh 50,000 rupees I should pay to income tax. I should bring the challan and I should submit this challan to lottery organizer. After I submit this challan, then only he will give gift of XUV 700 worth 25 lakh rupees. So whenever winnings are in the form of kind, then whoever the winner is there, he is required to deposit 30% value of the gift to as a tax to the government, and he should produce challan to the organizer. Then only gift in kind will be released. Otherwise, gift in kind will not be released. Now, I said if you want, give XUV 700. Otherwise, I don't want XUV 700. Who will pay 7,50,000 rupees? Then organizer decided he only will pay TDS. So when organizer himself pays TDS, then we need to do gross up. On grossed up amount, TDS will be deducted. So generally 100 rupees, 30% is TDS, 70% is amount paid. Am I correct? So, but organizer himself wants to pay TDS. In that case, whatever 25 lakhs worth of car is there, it is assumed at 70% level and we need to do gross up. Whatever the gross up amount is there, on that gross up amount, TDS will be deducted. 25 lakhs divided by 70 into 100, 35 lakh 71,428 minus 25 lakh, 10 lakh 71,428. So whenever organizer himself wants to pay TDS, he is required to pay 10 lakh 71,428 as TDS. Are you able to understand? This is the concept. If prize money is paid in installments, see, you are earning lottery income, but total lottery income is not paid at one go. Lottery income was paid in installments. Then for each installment, separately 30% TDS will be deducted. Is it clear? 194 BA, winnings from online games. Before I explain 194 BA, I will explain 194 BB because 194 B, 194 BB both are same. 194 B is winning from lottery, betting, gambling, crossword puzzles, all any games of any sort, or whatever that is there under section 115 BB. Whatever income that is taxable under section 115 BB, all those incomes TDS will be deducted under section 194B except winnings from horse races. So if there is any winning from horse races, on such winning, TDS will be deducted under section 194 BB. Sir, what is the rate of TDS? Same provision. If amount of winning is up to 10,000, no TDS. If amount of winning is more than 10,000, TDS will be deducted under section 194 BB. Rate of TDS 30%. Are you able to understand? When TDS will be deducted? TDS will be deducted at the time of payment. Sir, then lump sum amount. If lump sum amount is paid, on total lump sum amount TDS will be deducted. What's there in it? Only if it is paid in installments, then question arises whether TDS will be deducted on total amount or installment amount. In that case, TDS will be deducted only on installment amount. Is it clear? 194 BA, winnings from online games. Now, see, under section 194B, under section 194BB, threshold limit of 10,000 rupees is there. After COVID, many people are playing online games and they are making money. So Nirmalamma thought, why can't we levy tax on it? Why can't we deduct TDS in that case? So Nirmalamma came up with section, when whatever the winning from online gaming is there, on such winning also TDS will be deducted under section 194BA. Actually, 194BA is large section. To explain 194BA, I need one example. Only through example I can explain 194BA. So that example I did not prepare, but in 2024, last year, for chartered accountant members, I spoke in one CPE seminar. I am the speaker there. I explained winning from online games, TDS on winning from online games and winning from online games. This section was introduced in Finance Act 2023. So I have that PPT with me. Using that PPT, I will explain you taxation of online gaming. Okay, so this is the PPT which I have prepared for seminar of members. See, generally seminar, if I give seminar for students, I will tell from scratch. I will tell from base. For members also, if I start from alphabets, okay, they will not show any interest. For members, we need to tell bullet points. Sir, okay, I will share this PDF with you also. If you want, you can see. Give me 1 second. I have shared the PDF in my Telegram group. You can download. So did you receive? Now, taxation of online gaming. Actually, it is PPT, but I converted PPT into PDF. Now I have to search for one unique color. I wanted white. Let's say TDS on winning from online games. Who will deduct TDS? Online gaming intermediary will deduct TDS. That means whoever the like Rummy, Dream 11, whoever the online gaming intermediary is there, he will deduct TDS under section 194BA. Are you able to understand? So when TDS will be deducted, TDS, see, I played one game. I made 40,000 rupees or I made 60,000 rupees. Whenever I win money, he will not deduct TDS. But whenever I withdraw money, then only he will deduct TDS under section 194BA. Now, sir, I do not withdraw money during the previous year. Then he will never deduct TDS? No, it is not like that. During previous year, whenever I withdraw money, TDS will be deducted under section 194BA. If I do not withdraw money during the previous year, then at the end of the financial year, whatever the winnings that are there in my wallet are there, online gaming wallet are there, on that winnings, TDS will be deducted. So at the time of withdrawal, if you do not withdraw at the end of the financial year, TDS will be deducted under section 194BA. Are you able to understand? So when you are withdrawing for the first time, TDS will be deducted. So when you are withdrawing for the first time, TDS will be deducted on net winnings. How to calculate net winnings? A minus B plus C. Okay, I know you will not understand anything. Sir, what are you talking? What A minus B plus C? Hold on, I will explain to you. So, are you able to see this slide, first year of joining the game. So I request everyone to open this slide, first year of joining the game. Have you opened? Everybody, have you opened? Now, just let us go through this slide. I wanted to play Dream 11. Okay, so in Dream 11, joining bonus is 20,000 rupees. To encourage me to play Dream 11, he added 20,000 rupees to my wallet. But can I withdraw that 20,000 rupees? No, no, no. I cannot withdraw the 20,000 rupees. That 20,000 rupees is motivation to me. Okay, so using that 20,000 rupees, first I will play 2 games. Okay, then I will get tempted to it. Then I need to invest my own money and I should start playing Dream 11. Are you able to understand? So he initially gave me 20,000 rupees. But that 20,000 rupees is not withdraw, like you cannot withdraw 20,000 rupees. Next, I deposited 10,000 rupees on June 1. Next, I played the game. I won 40,000 rupees. So initially I deposited 10,000. I won 40,000 rupees. So how much is the balance in my wallet? Balance in my wallet is 10,000 plus 40,000. 50,000 is the balance in my wallet. Now on September 1, I have withdrawn 20,000 rupees. How much I have withdrawn? 20,000 rupees. Now, sir, I am withdrawing 20,000 rupees, right? On 20,000 rupees, whether TDS will be deducted? Yes, TDS will be deducted. I will tell you one small logic. How much I deposited? 10,000 rupees. How much I won? 40,000 rupees. So, total 50,000 is my balance. Correct? How much I withdrawn? I have withdrawn 20,000 rupees. On 20,000 rupees, already this 10,000 was there na. 10,000 rupees. This 10,000 rupees was there na. So, I earned money, I paid taxes. After payment of taxes, whatever the left out money is there, I deposited left out money in my gaming wallet, 10,000 rupees. On this, I already paid tax na. Already tax was paid. So, whatever balance 10,000 is there, on balance 10,000 rupees, TDS will be deducted. Are you able to understand? On balance 10,000 rupees, TDS will be deducted at the rate of 30%. Are you able to understand? So, what he tells, A minus B plus C. What A means? Amount withdrawn from user account. How much amount I have withdrawn? 20,000 rupees. What B means? Aggregate amount of non-taxable deposit made till the time of such withdrawal. C means opening balance of user account at the beginning. See, this is the first year I am starting to play the game. So in first year, there will be no income, right? There will be no opening balance. Whatever I deposit, using that only I will do. But in second year, closing balance will be carried forwarded as opening balance. So opening balance is 0. But how much is the deposit that I have made? I made 10,000 rupees deposit na. So 10,000 rupees. Now formula is A minus B plus C. That means 20,000 minus 10,000 plus 0, which is 10,000 rupees. On 10,000 rupees, TDS is required to be deducted under section 194 BA. Are you able to understand? So did you understand the concept? Whenever you are withdrawing money from online gaming wallet, for the first time if you are withdrawing, then TDS is required to be deducted on what amount? A minus B plus C. A means whatever the amount that you have withdrawn. B means whatever the amount that you have initially deposited. C means opening balance. So A minus B plus C, whatever the amount is there, on such amount TDS is required to be deducted under section 194 BA. This is the example which I explained to chartered accountants in Vijayawada chamber. The same example I am also explaining to you, final students. Okay. Now, shall I explain further? So till here you understood na? His balance is 50,000 rupees. Out of 50,000, how much he withdrawn? He has withdrawn 20,000 rupees. How much is balance left? 30,000 rupees. So his balance is 30,000. See, all these are, gambling. Initially you will get money. You will get tempted. You will play further. Then you will lose the money. Okay. So here he got 40,000 rupees. He withdrawn 20,000 rupees. Balance 30,000 is there. He played second game. In second game, he lost total 30,000 was loss. Total 30,000 is in the air. It's gone. Okay. So, but he tempted. He wanted to play the game another time and he wanted to get back 30,000 rupees. So to play game, he should have money. He is not having any money in the wallet. So he again introduced 40,000 rupees in the wallet. So initially he deposited 10,000 rupees. Then he deposited 40,000 rupees. So total amount he deposited is 50,000 rupees. Are you able to understand? I hope you are able to see this now. So he deposited 40,000. He played third game. In third game, how much is loss? 36,000 is loss. So after 36,000 loss, how much is left? 40,000 is 4,000 is left. Okay. Now in fourth game, how much he won? 6,000 rupees. Thereby balance increased to 10,000 rupees. On January 1, see, he earned 6,000 rupees. Now, from that 6,000 rupees, he has withdrawn 4,000 rupees. Are you able to understand? Now, what is the formula? On subsequent withdrawal, formula is A minus B plus C plus E. A means amount withdrawn. B means whatever the amount that he has deposited. C means opening balance. E means whatever the amount on which TDS was already deducted. Okay, let's plot this, you will understand. So on second withdrawal, TDS will be deducted on second withdrawal, TDS will be deducted on A minus B plus C plus E. A means what? Withdrawal amount. How much he has withdrawn? 6,000 rupees. Minus B means what? Amount he deposited. How much he deposited? Initially, he deposited 10,000 first. Then he deposited 40,000. So total deposit is 50,000. C means opening balance. Opening balance is 0. What E means? E means the amount on which TDS was already deducted. TDS was already deducted on 10,000 na. On this 10,000 already TDS was deducted. So 50,000 plus 10,000. So how much is balance? Wait. How much amount he has withdrawn? Initially he has withdrawn 20,000 na. He has withdrawn 20,000. So total amount withdrawn is 26,000. 26,000. That means from second withdrawal onwards, you have to do calculation cumulatively. 26,000 minus 60,000. How much is balance? 34,000 loss is there. Am I correct? Hold on. I am sorry. Here amount withdrawn is 4,000, not 6,000. How much he has withdrawn? 4,000. 24,000 he has withdrawn. So how much is lost? 36,000. So as like A minus B plus C is negative. If it is negative, it will be considered as 0. No TDS will be deducted. Are you able to understand? Minus 34,000. No TDS will be deducted. Next. At the end of financial year, net winnings at the end of financial year. I know this is revision class, but why I am explaining very clearly is this is recent amendment. Chances are there he can ask a question in final exam. From TDS TCS, 8 marks will come in the examination. We cannot expect if question is asked from 194 BA, definitely from this calculation only, he will ask question. He will not ask a theory question. Okay. small mistake I made previously. Initially, he has withdrawn 20,000. Then second withdrawal, subsequent withdrawal is 4,000. So total withdrawal is 24,000. It is not 26,000. Closing balance is 6,000 rupees. At the end of the financial year also, whatever the closing balance is there, on that closing balance, TDS will be deducted. But what is the formula on net winnings at the end of the financial year? TDS will be deducted on A plus D minus B plus C plus E. What do you mean by D? D means closing balance. C means opening balance. D means closing balance. Okay, now shall we plot? At the end of financial year, what is the rule? A plus D minus B plus C plus E. A means what? Total withdrawal. How much he has withdrawn? 20,000 he has withdrawn first time, 4,000 he has withdrawn second time. So total withdrawal is 24,000. D means closing balance. How much is closing balance? 6,000 minus B means amount deposited. How much he has deposited? Initially he has deposited 10,000. Later on he lost total money. Then he deposited 40,000. So total deposit made is 50,000 plus C. C means opening balance. This is the first year na. Opening balance is 0. E means amount on which TDS was already deducted earlier. Already on how much amount TDS was deducted? Earlier TDS was deducted on 10,000 rupees. Already on 10,000 rupees TDS was deducted na. So 10,000 rupees. ₹10,000. So how much is the calculation? 30,000 minus 60,000. 30,000 loss is there. As 30,000 loss is there, no TDS is required to be deducted at the end of the year. Are you able to understand? Crystal clear, sir. Yes. To prepare this PPT, I have done 3 night outs. Whenever amendment has come, he did not give any example. It was horrible. To frame the example only, it took so much of time. He just gave this A minus B plus C plus E. All these were given without example. So for framing the example, it took a lot of time for me. And whenever you are delivering lecture to chartered accountants, you need to be highly careful. Students, okay, they will listen, but if I say any mistake, sometimes students may ignore or they may accept. But chartered accountants, they are already in the field, they have knowledge. Whenever I am delivering to chartered accountants, it is very tough job. So to prepare this, it took a lot of time. So did you understand TDS on net winnings? So this is the concept, TDS on net winnings. That's why I am scared. Whenever any new act comes, whenever any amendment comes, first I have to study. It will take me a lot of time to digest, internalize, then I have to explain to you. Next, we will see 194C. Today it was so heavy. After the class, I should have minimum sleep of 6 to 7 hours. Now, 194C. This is also super section. Important section again. Whenever 194C is applicable in case of works contract. Sir, what do you mean by works contract? I will explain little later. But remember, when 194C gets attracted, 194C gets attracted whenever any payment is made for works contract. On such payment, TDS is required to be deducted under section 194C. So generally, who will make payment? The person who is receiving the services will make payment. To whom payment is made? Payment is made to contractor or subcontractor. Okay. So before making payment to contractor for works contract, TDS is required to be deducted under section 194C. Sir, is there any threshold limit? Yes. If individual payment to contractor is less than or equal to 30,000, no TDS is required to be deducted. If individual payment is more than 30,000 rupees, then TDS is required to be deducted under section 194C. Individual payment is less than 30,000 rupees. Then we will consider aggregate payments. If aggregate payments are less than or equal to 1 lakh, no TDS. If aggregate payments are more than 1 lakh, then TDS is required to be deducted under section 194C. Are you able to understand? Next. If contractor is resident in India, then only TDS is required to be deducted under section 194C. If contractor is non-resident, 195 gets attracted, 194C will not get attracted. 194C is applicable only in case of payment made to resident contractor. Is it clear? Next. Payer, you know na, we have discussed cherry definition. The person who is making contract payment, if he is other than individual or HUF, mandatorily required to deduct TDS if payment crosses threshold limit. Are you able to understand? Next, if person who is making payment, if he is individual or HUF, then we have to check. In case of individual or HUF, in preceding financial year, if business turnover is less than or equal to 1 crore, in profession, if gross receipts are less than or equal to 50 lakhs, no TDS. Otherwise, TDS is required to be deducted. That too only if payment crosses threshold limit. Is it clear? Sir, what is rate of TDS? If contractor is individual or HUF, rate of TDS is 1%. If contractor is other person, rate of TDS is 2%. When TDS will be deducted? At the time of entry in books of accounts or at the time of payment, whichever is higher. Do you know 44 AE? Flying, hiring or leasing of goods carriages. Those who are engaged in the business of flying, hiring or leasing of goods carriages, and if they are having up to 10 transport vehicles, they can choose 44 AE. So those who are engaged in 44 AE, if they give their PAN number to us, then we are not required to deduct TDS under section 194C. Next, if any amount is paid exclusively for personal purposes of individual or HUF, then also no TDS is required to be deducted. See, in last financial year, in my profession, gross receipts are more than 50 lakhs. In current year, I am making contract payment for my personal purpose. I am constructing one building. That building I am going to use for my residence. So whatever the building that I am constructing, it is purely for my personal purpose. So whenever I make works contract payment exclusively for personal purpose, then no TDS is required to be deducted in case of individual or HUF. Now we need to see what works contract means. Oh, today whatever the sections that we are discussing, all those sections are qualitative sections. Okay. Works contract. I don't think so. Today we can finish TDS and TCS. So shall we plan another day also for TDS and TCS? Now, works contract. I will explain to you. See, what do you mean by works contract? I went to tailor shop. I purchased one white cloth. I took that white cloth. I told him I wanted white shirt. I wanted half hands. I wanted apple cut. I wanted two pockets. I gave my own specifications. As per the specifications given by me, tailor stitched the white shirt and gave the white shirt to me. Now, this is perfect example for works contract. If any raw material is taken from customer, using that raw material, work is done, finished good is produced, and finished good is given back to customer. This concept we call as works contract. Are you able to understand? Whenever works contract is done, TDS is required to be deducted under section 194C. I will tell second example. I went to one showroom. Tailor is also there. Tailor already he purchased cloth from third party. He stitched 100 white shirts. I reviewed each white shirt. Out of those 100 white shirts, I liked one white shirt. I purchased that one white shirt. Whenever I purchase white shirt, is it a works contract? It is not works contract. Are you able to understand? So whenever you purchase white shirt, it is not a works contract. No TDS is required to be deducted under section 194C. So I hope with this example, you got complete clarity about what works contract means and what sales contract means. In case of works contract, some raw material will be taken, work will be done, finished good will be given back to the customer. This is works contract. On works contract, TDS is required to be deducted under section 194C. On sale contract, no TDS is required to be deducted under section 194C. Do you know Mallamala Productions? Jabardast is there. Mallamala Productions. Now, what ETV will do? ETV, what it will do? ETV will give contract to Mallamala Productions. Dasara is coming. For Dasara, I wanted to conduct one event. I wanted these film stars. I wanted Vijay Devarkonda. I wanted Rashmika. Okay, he will tell whoever the actors, those who want, those are required to participate in Dasara event. Now what Mallamala Productions will do, it will bring all the actors, all the dance choreographers, it will shoot one content, whatever the content that is shot, that will be given to ETV. ETV will telecast that shoot. Now everything is prepared as per the customizations of ETV, right? This is also considered as works contract. Are you able to understand? Case 2. Mallamala Productions already have some serials. So ETV came, it came through, like it went through 3-4 serials, it selected one serial, it purchased one serial from Mallamala Productions. Now this is a sale contract. On sale contract, no TDS is required to be deducted under section 194C. Next. Advertisement. You know Manmadudu movie, right? In Manmadudu movie, what is their profession? Like it is advertising company. Okay, so they will go to Paris for Revlon ad, you know. So like what many companies will do, they will get the advertisement shooting done. So they will endorse advertisement to one advertising agency. Advertising agency will prepare the concept, it will prepare ad shoot, and ad shoot will be telecasted in channels. So even for advertising also, if for any agency, if any contract is given, that contract will be called as works contract. Are you able to understand? Next. Carriage of goods or passengers by any mode of transport other than by railways. Once Deloitte is there, you know Deloitte, right? So once what Deloitte did, it wanted to take all its staff on a vacation to Goa. Now what Deloitte did, it did not book individual flight tickets. It has booked entire flight for Deloitte employees. Now whenever it book entire flight, Indigo will customize. Indigo will schedule the flight whenever Deloitte wanted. Indigo will provide whatever the snacks that Deloitte wanted. That means what? You wanted to travel to some place, at that time you have booked one transport, you have booked one bus, or you have booked one plane, or you have booked one rail. Okay, so whenever you book a rail, like everything will be customized to you. At what time you wanted journey to start, at that time only it will start. At what time you wanted to reach the destination, at that time only you will be dropped there. Whatever you wanted on board, everything will be provided, everything will be customized as per your request. Now this is also called as works contract. What many students will think, many students will confuse between works contract and rent contract. I will tell. Let's say I wanted to take all the students to Kulu and Manali. I booked one bus. Whenever I book bus, student will tell, sir, you took bus on rent. No, I did not take bus on rent. Whatever the petrol is there, entire petrol will be taken care by uh, owner of the bus. Whatever the toll, entire toll will be taken care by owner of the bus. Next, entire cleaning of the bus will be taken care by owner of the bus. I will get into the bus, I will go there, I will get down, again I will come to my own place. That means what? Here you cannot call as rent contract, because like I am not taking bus on rent. Driver and petrol, tolls, cleaner, everything is provided by the owner of the bus. Now this is works contract. In this works contract also, if any payment is made, TDS is required to be deducted under section 194C. Next, catering. You know, right? Let's say there is my office. For example, in my office 50 staff are there. That much staff are not there, hardly 3 4. 50 staff are there. I decided everything. I told to my employees, every day food will be provided in the office in the afternoon. So what I told, I went to Kakatiya mess. I told Kakatiya mess, every day you should supply food to my office for 50 people. I told one curry should be there, dal should be there, one chutney should be there. I gave my menu. As per that menu, he is supplying the food. Now, as per my customizations, he is supplying the food. For that, I need to make payment for catering contract. For that also, TDS is required to be deducted under section 194C, because catering contract is also a works contract. Are you able to understand? Manufacture or supplying a product according to requirement of a customer. So according to requirement of a customer, if any product is manufactured, TDS is required to be deducted under section 194C. It amounts to works contract. Excluding manufacturing or supplying a product as per requirement or specification of a customer by using the raw material purchased from any person other than such customer or his associate, exception construction contract. What do you mean by this? Normally, if you take goods from customer, if you customize and give it to the customer, it amounts to works contract. But in case of construction contract, let's say I wanted to construct 3 floors building. I asked builder to come to my place. I told builder I wanted 3 floors, each floor 3 BHK. I told my customizations. I said I will not purchase any brick. I will not purchase any cements. I will not purchase any painting. Everything you need to purchase, you need to construct 3 floors building and you need to hand over that building to me. Now tell me how much is the contract amount, I said. Here, am I supplying any raw material? I am not supplying any raw material. But everything is purchased by builder and he constructed the building and he gave the building to me. Are you able to understand? Here, even though raw material is not supplied by customer, still that construction contract will amount to works contract and TDS is required to be deducted under section 194C. Are you able to understand? Normally, whenever raw material is taken and customized and given back to customer, then only it is treated as works contract. In case of construction contract, even though raw material is not taken, okay, still it will amount to works contract and TDS is required to be deducted. I hope you understood this point. Did you understand? Next, TDS will be deducted on taxable value. That means before GST, whatever the value is there, on such amount, TDS will be deducted under section 194C. Next, in case of owner or seller of natural gas, sells as well as transports the gas to the purchaser till the point of delivery, no TDS will be deducted under section 194C. Let's say I purchased a gas cylinder. Cost is 800 rupees. Transportation charges 100 rupees. See, he is bringing cylinder from gas company to my home, right? So transportation charges are 100 rupees. Total amount is 900 rupees. Now my question is, on this 100 rupees, whether TDS is required to be deducted under section 194C? Answer is no. No TDS is required to be deducted, because whatever transportation service is there, it is ancillary service. Main service is supply of gas cylinder, sale of gas cylinder. So it amounts to sale contract. So this example you read on your own, you will understand, not a problem at all. Uh, so did you understand 194C, important section? Are everyone clear? Yes, let us start. We discuss it till section 194. Now we will discuss section 194D. Under section 194D, if any insurance commission is paid, then TDS is required to be deducted. Under section, sir, how to remember? Insurance agent always speaks about death. Okay, like he has to get policies done. So he will tell, the moment I am coming to your home, there was one accident, 12 people died. So he always speaks about death. So D represents death. 194D discusses about TDS on insurance company. So before paying insurance commission, insurance company is required to deduct TDS under section 194D. If insurance commission is up to 15,000 rupees in a financial year, then before paying that 15,000 rupees, no TDS is required to be deducted. However, if insurance commission is more than 15,000 rupees per annum, then TDS is required to be deducted under section 194D. Are you able to understand? Who will deduct TDS? Any person. Basically, insurance company will deduct TDS when before paying commission to agent. Okay, agent should be a resident agent. Whoever the insurance agent is there, he should be a resident agent. Then only TDS will be deducted under section 94D. What is the rate of TDS? If insurance agent is a company, domestic company, then rate of TDS 10%. If insurance agent is other than company, then rate of TDS is 5%. Let's say like there is one company, health insurance company. If you go to that company, like it has tie-ups with various insurance companies. Star Health, okay, it has tie-ups with Axis Medical Insurance Policy. So various companies it has tie-ups. So if you go to health insurance company, then it will show you 10 medical insurance policies. Whatever you wanted, you can choose that insurance policy. Now, health insurance company, it is a domestic company. Now, whenever policy is done for domestic company, like domestic company is the agent here. Commission will be paid to domestic company. So if commission is received by domestic company, rate of TDS is 10%. If commission is received by any person other than domestic company, then rate of TDS is 5%. Are you able to understand? When TDS is required to be deducted at the time of entry in books of accounts or at the time of payment, whichever is there. 194 DA. Any sum under a life insurance policy. Sums which are exempt under section 1010D. See, when you take life insurance policy, if you take life insurance policy before 1st April 2012, maximum deduction allowed under section 80C is equal to actual life insurance premium paid or 20% of sum assured, whichever is lower. If you take policy after 1st April 2012 but before 1st April 2013, maximum deduction allowed is equal to actual life insurance premium or 10% of sum assured, whichever is lower. If you take policy after 1st April 2013, if you take policy for those who are suffering with disability or those who are suffering with specified disease, then actual premium or 15% of sum assured, whichever is lower. In case of other persons, actual premium or 10% of sum assured, whichever is lower. The thing is, for example, policy taken before 1st April 2012. Now, what is the criteria? Criteria is actual life insurance premium or 20% of sum assured, whichever is lower. Am I correct? Now, if with, for example, let's say life insurance policy is 8 lakh rupees, insurance premium is 1 lakh rupees. Now, actual life insurance premium 1 lakh. 20% of sum assured, 8 lakhs into 20%, 1,60,000. Whichever is lower means 1 lakh is allowed as deduction under section 80C. If you observe, in this case, actual life insurance premium is less than 20% of sum assured. Am I correct or not? How much is actual life insurance premium? 1 lakh. 20% of sum assured means 1.6 lakh. Actual life insurance premium is less than or equal to 20% of sum. So policy is for 5 years. In these 5 years, if SSE dies, then 8 lakh rupees compensation is received. So see, at the time of death, if any compensation is received, it is fully exempt. But after 5 years, SSE is still alive. Then what he will get? He will get maturity amount. Okay, he will get maturity amount. Correct. So whatever the maturity amount that is received is there. In this case, maturity amount is fully exempt under section 1010D. Are you able to understand? So if actual life insurance premium is less than limits, less than 20% of sum assured or 15% of sum assured or 10% of sum assured, then maturity amount is fully exempt under section 1010D. Are you not able to listen my voice? I am speaking at 100% volume. This is the maximum volume that it permits. If possible, try to increase the volume in your mobile. Now, if actual life insurance premium is more than 20% of sum assured, in that case, maturity amount is not exempt. In that case, maturity amount is taxable. Maturity amount is taxable. So the concept here is like in 80C, we have studied limits. Policy taken before 1st April 2012. Maximum limit is 20% of sum assured. After 1st April 2012, before 1st April 2013, maximum limit is 10% of sum assured. After 1st April 2013, for disabled persons, 15% of sum assured. For other persons, 10% of sum assured. If actual life insurance premium is less than the limits, less than 20%, 10% or 15%, then maturity amount is fully exempt. At the time of death, compensation is received, fully exempt. But like if actual premium is more than 20% of sum assured or 15% of sum assured or 10% of sum assured, in that case, maturity amount is taxable. Only maturity amount is taxable, then only TDS is required to be deducted under section 4A. Are you able to understand? Is it clear? I will take one example to explain this better. Let's say I took one policy, sum assured is 2 lakh rupees. Policy was taken on 1st April 2015. 1st April 2015 means what? After 1st April 2013. Now, life insurance premium is 30,000 rupees. How much is life insurance premium? 30,000. Tenure. Tenure is 5 years. Tenure is 5 years. Now, tell me, policy taken on or after 1st April 2013. What is the limit that we need to consider? We need to consider the limit of percent of sum assured. So, actual life insurance premium is 30,000. 10% of sum assured. Sum assured is 2 lakhs. 2 lakhs into 10%, 20,000. Here, actual life insurance premium is greater than 10% of sum assured. Now, therefore, maturity amount is taxable. Now, after 3 years, how much is the maturity amount he received? He will receive maturity amount 2 lakh rupees. Sorry, policy is for 5 years. Na? After 5 years, he will get maturity amount 2 lakh rupees. But TDS is not required to be deducted on 2 lakh rupees. TDS is required to be deducted on income component. Very, very important. Under 194 DA, TDS will not be deducted on maturity amount. TDS will be deducted on income component. Sir, what do you mean by income component? I am getting 2 lakhs, but in last 5 years I paid every year 30,000 premium na, that is expenditure to me. So whatever the amount that I received, from that I need to reduce expenditure. Are you able to understand? Less expenditure for 5 years. How much? 30,000 into 5 years, 1,50,000. Correct? Now how much is the balance? 50,000 rupees. This 50,000 rupees we call as income component. On this income component, TDS will be deducted at the rate of 5%. Are you able to understand? So this is the concept relating to section 194 DA. So are you clear with 194 DA? Did you understand? Sir, is there any threshold limit? Yes, there is threshold limit. Whatever the maturity amount that is received is there. If it is less than or equal to 1 lakh, no TDS. If maturity amount is more than 1 lakh, then TDS is required to be deducted. But TDS will not be deducted on maturity amount. TDS will be deducted on income component. Is it clear? Are you able to understand? Now, shall I proceed further? Very, very important. TDS is required to be deducted on income component. 5% on income component. The rate of TDS was changed. Amendment in Finance Act 2024. If maturity amount is paid on or after 1st October 2024, then rate of TDS is 2% instead of 5%. Okay. So before 1st October 24, rate of TDS 5%. On or after 1st October 24, rate of TDS is 2%. Next, when TDS will be deducted? At the time of payment. Generally, under TDS provisions, TDS will be deducted at the time of entry or at the time of payment, whichever is earlier. But from yesterday onwards, we were discussing some sections where TDS will be deducted at the time of payment only. What are those sections? Salary. In case of salary, TDS will be deducted only at the time of payment. Second one, premature withdrawal of amount from recognized provident fund. In that case also TDS will be deducted only at the time of payment. Next, 194 DA. Okay, maturity amount on insurance compensation. Even on that also TDS will be deducted only at the time of payment. You can see TDS shall be made on income component, maturity amount less aggregate premium paid. Next, shall we discuss 194G? Everybody, 194G. Next, see, there will be lottery organizer and there will be lottery agent. Lottery agent 1, lottery agent 2, lottery agent 3, like that. Now, he printed 3 lakh tickets. 1 lakh tickets are given to lottery agent 1, lottery agent 2, lottery agent 3. For lottery agent 1, fixed amount. For selling the lottery tickets, fixed amount 80,000 is paid. Are you able to understand? For lottery agent 2, variable amount. Variable amount means what? Nothing but commission. how many tickets are sold, 20% commission will be paid. Let's say each ticket cost is 100 rupees. 3 lakh into 100, how much? 3 crores, right? 3 lakh into 100, 3 crores. So he sold 80,000 tickets. 80,000 tickets into 100, that means 80 lakhs. On 80 lakhs, 20% means 16 lakhs is the. Now, third person is there, lottery agent 3. For lottery agent 3, no amount will be paid. He is friend of him, so he did it. The thing is, for lottery agent 3, 1 lakh tickets are given. Out of 1 lakh tickets, 60,000 sold, 40,000 unsold. So this is the case scenario. In this case, whatever the amount paid to lottery agent is there, okay, whoever sells the ticket, for that person, if any amount is paid, okay, whether it is fixed amount or commission, variable amount, if this amount is up to 15,000 rupees, no TDS is required to be deducted. But whatever the amount paid to lottery ticket selling agent is there, if it is more than 15,000 rupees, then TDS is required to be deducted under section 194G at the rate of 5%. Are you able to understand? So, lottery organizer, before paying salary or commission to lottery ticket selling agent, lottery organizer is required to deduct TDS. If the amount paid is up to 15,000, no TDS. If amount paid is more than 15,000, then TDS is required to be deducted. What is the rate of TDS? Rate of TDS is 5%. Okay, but rate is changed with effect from 1st October 2024. Rate of TDS was reduced from 5% to 2%. Are you able to understand? When TDS will be deducted? At the time of entry in books of accounts or at the time of payment, whichever is here. Okay. Now, see, ultimately, one fine day, lottery draw will be taken. Na? Like guest will be invited, guest will pick one lottery, he will read the name. So when he read the name, whatever the 40,000 unsold tickets are there, from this, one ticket won the prize money. One ticket won the prize money. Now tell me one thing, 40,000 tickets are with lottery agent 3. Out of total 1 lakh tickets, lottery agent 3 sold only 6,000 tickets, 40,000 tickets are unsold. Am I correct or not? Now, whatever the unsold component is there, so he won the amount, right? Let's say lottery prize winnings is 30 lakh rupees or winnings is 25 lakh rupees. Now, whatever 25 lakh rupees given to lottery agent 3 is there, on the 25 lakh rupees also, TDS is required to be deducted under section 194. Are you able to understand? Generally, in case of lottery, TDS is required to be deducted under section 194B. But this is a special case. In this special case, TDS will not be deducted under section 194B, but TDS will be deducted under section 194G. So whatever the unsold lottery tickets are there, on unsold lottery tickets, if any ticket is picked and if any prize money is won, on that prize money, like to the, if that prize money is paid to the agent, then whatever the amount paid to agent is there, even if it is prize money, still TDS is required to be deducted under section 194. Are you able to understand? One 194H commission. Yesterday we have discussed cherry definition. So under 194H also, if payer is payer as per cherry definition, then only he is required to deduct TDS. Otherwise, he is not required to deduct TDS. So commission or brokerage other than insurance commission. Why other than insurance commission? Insurance commission is already covered under 194D. So other than insurance commission, if any commission is paid, let's say I am constructing, let's say I wanted to sell my building. I told agent, if you sell my building for 2 crore rupees, I will give you 5% commission. Okay. So he found the buyer. I sold for 2 crore rupees. I paid commission 2 crore into 5%, 10 lakhs commission. Before paying that 10 lakh rupees, I am required to deduct TDS at the rate of 5% on commission. Are you able to understand? As per section 194H. See, 194D insurance commission. 194H other than insurance commission. Okay. So 194D insurance commission. 194H other than insurance commission. Okay. If commission is up to 15,000, no TDS. If commission is more than 15,000, then TDS is required to be deducted. Rate of TDS 5%. On or after 1st October 24, rate of TDS is only 2%. Are you able to understand? If the person to whom commission is paid, if he is a resident, then only TDS is required to be deducted under section 4H, otherwise not. Next. When TDS is required to be deducted, at the time of entry in books of accounts or at the time of payment, whichever is here. See, nowadays there is no PCO franchises. Once upon a time, if we want to get BSNL recharge, we will purchase one voucher. We will scratch that voucher. One number comes. If we call to that number, then our wallet gets top up with 110 rupees, 120 rupees like that. So generally BSNL, MTNL, they will pay commission to those who are selling those voucher cards. Okay, so whatever the commission paid to the PCO franchises is there by BSNL or MTNL, on such commission no TDS is required to be deducted under section 194H. Next, payment made by TV channel or newspaper company to advertising agency for booking or procuring or canvassing for advertisement payment is treated as discount and not commission. So TDS under section 194H is not applicable. See, let's say I will tell one example. There is advertising agent. There is customer. There is TV or newspaper channel. Now, advertising agent got business. Okay, he got business 1 lakh rupees from customer. Now whether advertising agent pay total 1 lakh rupees to news channel? No, he pays only 80,000 rupees to news channel. Now whatever difference 20,000 is there, right? This 20,000 is income of advertising agent. Na? Correct? Am I correct? This 20,000 is income of advertising agent. This 20,000, like in Supreme Court case law, actually it will appear as a commission, but in Supreme Court case law, it was said that 20,000 is not a commission, 20,000 is to be considered as discount, and on this 20,000, no TDS is required to be deducted under section 194H. Normally, if you see, let's say I am advertising agent, like I have 2 hours, 120 minutes of TV9 time is available with me. That means in 120 minutes, I can go to a number of customers. If they want their advertisement to be displayed on TV9, like they should approach me. I will allocate 3 minutes time. For 3 minutes time, I charged 1 lakh rupees. I will not give 1 lakh rupees to TV9. I will deduct 20,000 as my commission and I will deposit only 80,000 rupees. I will give 80,000 rupees only to TV9. But whatever 20,000 is there, it is my income. Now, on this 20,000, whether TDS is required to be deducted, Supreme Court said that this 20,000 is not a commission, it is a discount. So, no TDS is required to be deducted under section H. Are you able to understand? 194I, very important section. So, did you understand 194H, everybody? One 194I. Whenever any rent is paid, before paying rent, TDS is required to be deducted under section 194I. What many students think? Many students think that only with regard to building or only with regard to any land, if any rent is paid, they think TDS is required to be deducted under section 194I, but your contention is not correct, your contention is wrong. Not only with regard to immovable property, even with regard to any assets, movable assets, if any rent is paid, then on such rent TDS is required to be deducted. Deloitte is there. Deloitte took 100 ACs on rent. On 100 ACs, every month rent will be paid. Whatever the rent paid on 100 ACs is there, on that rent also TDS is required to be deducted under section 194I. Are you able to understand? So rent for land, building, plant and machinery, furniture. So even for taking plant and machinery or furniture on rent, if you are paying any rent expenditure, on that rent expenditure you are required to deduct TDS. Sir, is there any threshold limit? Yes, there is threshold limit. Up to 2,40,000, no TDS is required to be deducted under section 194I. This limit was enhanced to 6 lakhs as per Finance Act 25. Okay, don't remember 6 lakhs. For your attempt, 2,40,000 only. So if rent amount paid in financial year is up to 2,50,000, no TDS. If rent amount paid is more than 2,40,000, then TDS is required to be deducted under section 194I. Here there is another subtle point. Co-owners are there. Let's say I am living in one house. That house is owned by A and B co-owners. Now every month I need to pay 15,000 to A, I need to pay 15,000 to B. So whenever rent is paid to co-owners, for each co-owner separately 2,40,000 threshold limit is applicable. That means for rent paid to A, separate 2,40,000 limit. For rent paid to B, separate 2,40,000 is available. Are you able to understand? You know chair definition. Only if pair is covered under chair definition, then only TDS is required to be deducted under section 194I. And only if rent is paid to resident, then only 194I. If rent is paid to non-resident, TDS will be deducted as per section 195. Are you able to understand? Sir, what is the rate of TDS? Whenever you are paying rent for plant and machinery or equipment, rate of TDS is 2%. Whenever you are paying rent for land, building or furniture, rate of TDS is 10%. Sir, when TDS is required to be deducted at the time of entry in books of accounts or at the time of payment, whichever is earlier. Are you able to understand? Next, no TDS on refundable deposits. Sir, what do you mean by refundable deposits? Let's say I am new to Hyderabad. I wanted to take one flat on rent. Initially, they will ask advance, 2 months advance, 3 months advance, whatever the advance amount that I have paid. On advance amount, I am not required to deduct TDS, but on every month rent, I am required to deduct TDS if rent payment crosses more than 2,40,000. Are you able to understand? Next, cold storages. Generally, cold storages are used for preserving seafoods. Let's say I went to cold storage. I told like 2 tons of seafood is there. This needs to be preserved in cold storage. They said okay. Now, like whenever I preserve 2 tons of seafood, they are not only giving cold storage on rent. Along with cold storage, they are providing air conditioning services, and like if I want any additional services, I can also receive those additional services from them. So in Supreme Court it was held that whatever the services provided by cold storage are there, even though prima facie they appear to be renting of cold storage, it does not amount to renting of cold storage, it amounts to works contract. So TDS is not required to be deducted under section 5, but TDS is required to be deducted under section 4. Are you able to understand? Passenger service fees. See, I fly Indigo by Indigo. So what happens? Let's say I am flying from Vijayawada to Chennai. Now I purchase a ticket worth of 4,000 rupees. In this 4,000 rupees, total 4,000 will not go to Indigo. Of course, Indigo takes 4,000. From that 4,000, Indigo is required to pay passenger service fees to Airports Authority of India. See, I am using Vijayawada Airport. I am also using Chennai Airport. In Vijayawada Airport, I am checking in. Security will be done. I will sit I will take boarding pass. I will sit in the lobby. Whenever my flight was called, I will go and get into the flight. So I am using premises of Vijayawada Airport and Chennai Airport. For this, I am required to pay passenger service fees, but I will not pay passenger service fees on my behalf. Airline will pay passenger service fees. Okay, so Supreme Court held that whatever the passenger service fees is there, it is not rent, it is a works contract. Because whenever I go to airport, like, I'm getting various services. I'm getting free Wi-Fi. I'm getting lounge access. I'm getting security check. I'm getting boarding pass. So all these services that I am receiving. So that is why this amounts to works contract and does not amount to rent contract. TDS is not required to be deducted under section 194I. Are you able to understand? Next, lump sum or lease premium or one-time upfront lease charge. One-time upfront lease charges means advance. See, before you take any property on lease, you will give advance, right? Whatever the advance given is there, on such advance, TDS is not required to be deducted. Okay, so this is all about 194. 194 IA. See, whenever you purchase immovable property, other than rural agricultural land. Why? Because when you are purchasing rural agricultural land, for seller, no capital gains are applicable because rural agricultural land. Okay. So other than rural agricultural land, if you purchase any immovable property, you purchase a flat or you purchase a land or you purchase a building or you purchased house property, whenever you purchase immovable property other than rural agricultural land, TDS is required to be deducted under section 1 for IA. Just give me 1 second. My mom is calling continuously. Last లో ఉన్నాను. Now, yeah, whenever you purchase immovable property, if the value of immovable property is up to 50 lakhs, no TDS under section 194 IA. However, what is the value that we need to consider? Stamp duty value or actual consideration, whichever is higher. Okay, 194 IA, stamp duty value or actual consideration, whichever is higher. Let's say stamp duty value is 45 lakhs, but actual consideration paid is 60 lakhs. Whichever is higher means 60 lakhs greater than 50 lakhs. So on this payment of 60 lakhs, TDS is required to be deducted under section 194 IA. Are you able to understand? So stamp duty value, actual consideration, whichever is higher you need to take. If that higher amount is more than 50 lakh rupees or equal to 50 lakh rupees, even if it is greater than or equal to 50 lakh rupees, then TDS is required to be deducted under section 194. What is the rate of TDS? Rate of TDS is 1% of stamp duty value or actual consideration, whichever is higher. Are you able to understand? Next, when TDS will be deducted at the time of entry in books of accounts or at the time of payment, whichever is earlier. But when you are purchasing rural agricultural land, no TDS is required to be deducted. This section quite often we do in our practice. For every 1 week or 10 days, a person comes, he will tell, sir, we are buying immovable property, TDS is required to be deducted. Registration people are saying only if we do TDS, then only registration will be done. So like we will pay 1% TDS, we will generate challans. There will be form 26 QB, I think. In that it is a challan come statement. We will file it and we will give those documents to SSC, then registration will be done. Now here there was loophole. Before 1st October 2024, what is the loophole? Two or three people use it to buy together. Let's say I, Monish and Varun are purchasing one house. The value of house is 1 crore rupees, but I will pay 35 lakhs, Monish will pay 35 lakhs, Varun will pay 30 lakhs. Here, each purchaser is paying less than 50 lakh rupees. So we used to not deduct TDS. Are you able to understand? This loophole came in the eyes of Nirmalamma. Immediately she made provision. She brought the amendment with effect from 1st October 2024. Whatever the property that is purchased, even though it is purchased by co-owners, all co-owners together, if aggregate payment is more than 50 lakh rupees, then TDS is required to be deducted by all co-owners. Are you able to understand? Is it clear? You can see with effect from 1st October 24, where there is more than one transferor or transferee in respect of any immovable property, then the consideration for calculating threshold limit shall be aggregate of amounts paid or payable by all the transferees to the transferor or all the transferors for transfer of such immovable property. Is it clear? 194 IB. Mukesh, you asked me one doubt. You also asked in Telegram. I will give reply in Telegram. This class is exclusively relating to TD. Okay. 194 IB. See, in case of individual and HUF, in preceding financial year, if business turnover is less than or equal to 1 crore, in profession, if gross receipts are less than or equal to 50 lakhs, no TDS will be deducted under section 194I. So those who are not required to deduct TDS under section 194I, they are required to deduct TDS under section 194IB. So shall I give an example? There is one guy with the name Mukesh. Now, Mukesh is having one mobile shop. In 23-24, his turnover is 98 lakhs. How much is his turnover? 98 lakhs. Now, he is having one mobile shop. Now, that mobile shop was taken on rent. Rent is 60,000 per month. How much is the rent? 60,000 per month. Now the thing is, those who are not required to deduct TDS under section 194I. Here, whether Mukesh in preceding financial year, his turnover is less than 1 crore. Whether Mukesh is required to deduct TDS under section 194I? No, Mukesh is not required to deduct TDS under section 194I. Mukesh is required to deduct TDS under section 194IB because amount of rent paid is more than 50,000 per month. Are you able to understand? So those who are not required to deduct TDS under section 194I, they are required to deduct TDS under section 194IB if the amount of rent per month is more than 50,000. Are you able to understand? Sir, what is the rate of TDS? First of all, under 194I, every month TDS is required to be deducted. Okay, but under 194IB, 194I, every month TDS. 194IB, not every month TDS. 194IB, TDS will be deducted only for last month in the finance. Last month in, let's say, last month in financial year means what? Every month rent is 60,000. How much is rent per annum? How much is last month means which month? March month, right? How much is March rent? March rent is 60,000 rupees. From March rent, TDS will be deducted, less TDS. But in the month of March, TDS will not be deducted only for March month. TDS will be deducted for whole financial year. 60,000 into 12 months into 5%. 36,000 TDS will be deducted. Okay. But there is one amendment under section 194 IB also. Before 1st October 24, rate of TDS is 5%. on or after 1st October 24, rate of TDS is 2%. So here TDS rate will change. TDS rate is not, I will tell you, for April to September, TDS rate is 5%. 60,000 into 6 months into 5%, 18,000 rupees. October to March, rate of TDS 2%, 60,000 into 6 months, 7,000. So 60,000 minus 18,000 minus 7,200, 34,800 will be paid to the owner. Are you able to understand? This is how you need to deduct it. Now you will get one doubt, sir. He did not like he is not on rent till 31st March. He vacated the house in the month of December only. Okay, then in December month only TDS will be deducted. Are you able to understand? So very simple. Under 194 IB, TDS will not be deducted every month. TDS will be deducted on last month rent. If SSE vacates the house property before March only, then in the month in which he vacated the property, in that month he is required to deduct TDS under section 194 I. Able to understand? Next 194J. This is something, this is also a bit important. 94. 5 payments total. For these 5 payments, TDS is required to be deducted under section 194J. What are those 5 payments? Fees for professional services, fees for technical services, royalty, non-compete fees, director's remuneration. If any of these 5 payments are made, TDS is required to be deducted under section 194J. For first 4 payments, threshold limit is 30,000. For last payment, no threshold limit. That means director's remuneration, even though 10 rupees is paid, on the 10 rupees also TDS is required to be deducted. Are you able to understand? However, for fees for professional services, technical services, royalty, non-compete fees, for these 4 things, if the amount of payment is up to 30,000 in a financial year, no TDS is required to be deducted. If amount of fees is more than 30,000 rupees, then TDS is required to be deducted under section 194J. Are you able to understand? So it should not exceed 30,000 in a financial year for each category of. Next, payer definition. Sir, who is required to deduct TDS under section 194J? 194J payer. If payer is individual or HUF, if payer is other than individual or HUF, if payer is other than individual or HUF, mandatorily required to deduct TDS. See, this is different from chair definition. Don't confuse. This is different. Listen till the end. Mandatory required to deduct TDS if payment crosses threshold limit. In case of individual or HUF, what will we do? We will check in preceding financial year. If business turnover is less than or equal to 1 crore, in profession, if gross receipts are less than or equal to 50 lakhs, no TDS. In preceding financial year, if business turnover is more than 1 crore, in profession, if gross receipts are more than 50, then what will we do? We will check if the nature of payment is royalty or non-compete fees. Then no TDS. If nature of payment is fees for professional services, or fees for technical services, then TDS is required to be deducted under section 94J if payment crosses threshold limit. Are you able to understand the difference? Share definition is different, 194J definition. Under 194J, in case of individual or HUF, even though in preceding financial year business turnover is more than 1 crore, gross receipts in profession are more than 50 lakhs, still if the nature of payment is royalty or non-compete fees, no TDS. If nature of payment is any other payment, then TDS is required to be deducted under section 4J. Are you able to understand? So this is the difference. Next, only if payment is made to resident, then only TDS is required to be deducted under section 194J. Sir, what is the rate of TDS? For technical fees, rate of TDS is 2%. Okay, next. For royalty on sale or distribution or exhibition of cinematographic film. See, whenever a movie is released, theater will pay royalty to distributor, distributor will pay royalty to the producer. Whatever royalty paid by theater to distributor or distributor to producer is there, on that royalty, rate of TDS is not 10%, rate of TDS is 2%. Are you able to understand? Next, payee engaged in business of operation of call center. So those who are running call center, for call center people, if you make payment, it is technical service only. Rate of TDS is not 10%, rate of TDS is 2%. In all other cases, fees for professional services, non-compete fees, director's remuneration, rate of TDS is 10%. When TDS is required to be deducted at the time of entry in books of accounts or at the time of payment, whichever is here. Next. If I pay professional fees exclusively for my personal purposes, then no TDS is required to be deducted under section 194J. I will tell you an example. Let's say uh, I am a chartered accountant in practice. I am into teaching. But there is Monish. Monish does not like me. Monish hates me. Okay, so what Monish did? Monish filed a case against me in the court. Monish said that Umasankar is not a chartered accountant. He is portraying himself as chartered accountant. He is deviating students. So because in market so many faculties are there, okay, who tell themselves as chartered accountants but actually not. So he thought me also like that. So he filed case against me in the court of law. Now I have to defend the case now. It's a trust issue to me. Many students, if they believe that, then entire my market will be gone. So I recruited one lawyer. I gave my CA final pass certificate. I gave my marks list. I gave certificate of practice given by ICI to me. So all these documents I gave to advocate. Advocate went to the court. He submitted all the documents and he proved that I am the chartered accountant. Now I need to pay fees to advocate, right? I paid 50,000 fees to advocate. Now 50,000 is more than 30,000 now, and this is professional matter to me. I'm a chartered accountant. I'm into practice. I'm into teaching. This is my profession. So with regard to profession, I paid professional fees of more than 30,000 rupees. Now I am required to deduct TDS before I make payment to the lawyer or advocate. Are you able to understand? Now Monish is again angry on me. Okay, so Monish, like I own one building in Vijayawada. Monish again filed a case against me. Whatever the building that Umashankar sir is living in, that building does not belong to Umashankar sir. That building belongs to Monish. He said that that building belongs to him. Okay. Now again I have to defend whatever the documents, that land documents are there. I gave to lawyer. Those documents were produced in court of law. It was proven this building and land belongs to me. Now I need to pay professional fees to the advocate, right? On this professional fees, I am not required to deduct TDS because whatever the professional fees for my personal house litigation is there, that is exclusively for my personal purposes. So exclusively for personal purposes, if any fees is paid, no TDS is required to be. Professional fees is paid, no TDS is required to be deducted under section 194J. Are you able to understand? Next, 194K income on units. Just like dividend, if any dividend is paid on shares, TDS will be deducted under section 194. If any dividend is paid on units, on such dividend TDS will be deducted under section 194K. If the amount of payment is up to 5,000, no TDS. If amount of payment is more than 5,000, TDS will be deducted under section 194K. Payer can be any person, but payee should be resident in India. Rate of TDS 10%. TDS will be deducted at the time of entry in books of accounts or at the time of payment, whichever is. The income is of the nature capital gain. See, on capital gain income, no TDS is required to be deducted. Units sold, you got capital gains, no TDS. But on units, if you get any revenue income, interest, TDS is required to be deducted under section 194A. Next, 194 LA. So we have LA, M, N, R. 194Q is also there, that I will discuss along with TCS section. One 194L. See, whenever government do compulsory acquisition, government will pay compensation, right? If the amount of compensation paid is up to 2,50,000, government is not required to deduct TDS. However, if government pays compensation more than 2,50,000, then government is required to deduct TDS under 94. Able to understand what is the rate of TDS? 10%. But if government compulsorily acquires agricultural land, whenever urban agricultural land or rural agricultural land is compulsorily acquired, then capital gains. See, rural agricultural land compulsorily acquired, no capital gain. Urban agricultural land compulsorily acquired, you can claim exemption under section 1037. Whatever the capital gain is there, it is totally exempted under section 1037. So whenever agricultural land is compulsorily acquired, okay, in that case, agricultural land compulsorily acquired, in that case, no TDS is required to be deducted under section 194 LA. Other than agricultural land, if any other property is compulsorily acquired, then TDS is required to be deducted under section 4 LA. Next, 194M. We have discussed the three sections: 194C, 194J, 194H. Those who are not required to deduct TDS under these sections, they are required to deduct TDS under section 194M. Are you able to understand? So, those who are not required to deduct TDS. Who are not required to deduct TDS? In case of individual HCF, in preceding financial year, if business turnover is less than or equal to 1 crore, or in profession if gross receipts are less than or equal to 50 lakhs, then they are not required to deduct TDS under section 194C, 194J, 194. Those who are not required to deduct TDS under those three sections, they are required to deduct TDS under section 94M if the amount paid is more than 50 lakh rupees. Are you able to understand? So, for works contract, for commission, for professional services, all these three together for a single person, amount paid is more than 50 lakhs in a financial year, then TDS is required to be deducted under section 194. Only if amount is paid to resident, then only TDS is required to be deducted under section 4M. Rate of TDS 5%. From 1st October 24 onwards, rate of TDS is only 2%. When TDS is required to be deducted at the time of entry in books of accounts or at the time of payment, which is here. Shall I explain section 194N, cash withdrawals? Now, actually, when you withdraw money from bank, you are not getting any income. Generally, if you earn any income, when you are receiving that income, TDS will be deducted. But Nirmalamma logic is different. Even though you do not get income, still TDS will be deducted. So there is section 194 and cash withdrawals. When you withdraw money from bank, if the amount of withdrawal is up to 1 crore rupees, no TDS. But if you withdraw more than 1 crore rupees, then TDS will be deducted. What is the rate of TDS? 2%. But in case of cooperative society, threshold limit is 3 crores. If cooperative society withdraws from bank up to 3 crore rupees, no TDS. If cooperative society withdraws more than 3 crore rupees in financial year, then before cooperative society withdraws, whatever the amount withdrawn is there, on that TDS will be deducted. Here, another important point is there. Let's say Varun is so rich. Okay, we have discussed in a day before class for wedding advertisement. Whatever the qualities of wife are there, for wedding advertisement only, Varun spent 5 lakh rupees per advertisement. So Varun is so rich guy. So in the bank account of Varun, 250 lakhs are there. Okay. So out of 250 lakh rupees, Varun has withdrawn 130 lakh rupees. Now TDS will not be deducted on 130 lakhs. Whatever the amount of withdrawal in excess of 1 crore is there. So above 1 crore, how much is there? Above 1 crore, 30 lakhs is there. So on this 30 lakhs, TDS will be deducted under section 194 and at the rate of 2%. Are you able to understand? So not on total withdrawal, TDS will be deducted. Whatever the amount withdrawn in excess of 1 crore is there, on excess withdrawal only, TDS will be deducted under section 4 at the rate of 2%. Is it clear? When TDS will be deducted at the time of payment. But if the person who is withdrawing money, if it is government or any banking company or business correspondent or white label ATM operator, no TDS is required to be deducted. Let's say AP state government, it has withdrawn 10 crores from bank. Who is the withdrawer? Withdrawer is government. No TDS will be deducted under section 4. Able to understand? Here there is this special point. What is special point? Previous year 24-25 is there. Previous year 23-24, 22-23, 21-22, 2020. SSE did not file ITR. He did not file ITR for 2021, 21-22, 22-23, and see 22-23 ITR due date is 31st July 2023. Now the due date is also over. Now the name of SSE is Raj. Now in 24-25, Raj is withdrawing money. Raj withdraws money. So what is the concept? Here the concept is in 24-25, if any person comes to bank for withdrawing money, we need to ask for ITRs of last 3 years. Here he did not file ITR of last 3 years, and last 3 years ITR due date is also over. Now as he did not file last 3 ITRs, 1 crore threshold limit is not applicable for Raj. If the amount of withdrawal, if it is up to 20 lakhs, no TDS. If it is more than 20 lakhs and up to 1 crore, rate of TDS is 2%. If the amount withdrawn is more than 1 crore, then rate of TDS is 5%. Are you able to understand? So generally under section 194 and threshold limit is 1 crore. But this 1 crore rupees threshold limit is not applicable. When 1 crore threshold is not applicable, in last 3 years, if a person did not file ITR and due date for filing ITR is over, then threshold limit is not 1 crore, threshold limit is 20 lakhs. Up to 20 lakhs withdrawal, no TDS. If he withdraws above 20 lakhs and up to 1 crore, rate of TDS 2%. If he withdraws above 1 crore, rate of TDS 5%. slab wise TDS will be deducted. Next, we will discuss 194R. Perquisite. See, if any perquisite is given, let's say I did audit of Lalita Jewelry. Now, he was very impressed with audit. My audit fees is only 10 lakhs, but he paid me audit fees 10 lakhs. He also gave me perquisite, additional bonus 3 lakh rupees. Now, I got perquisite 3 lakh rupees. So, before paying 3 lakh rupees, he is required to deduct TDS at the rate of 10%. So before providing any perquisite, TDS is required to be deducted under section 194R. But if amount of perquisite is up to 20,000 rupees, no TDS under section 4R. If amount of perquisite is more than 20,000 rupees, then TDS will be deducted under section 4R. Next, only if perquisite is given to resident, then only 194R gets attracted. If perquisite is given to non-resident, 195 gets attracted. Rate of TDS 10%. Now, see, I did not receive perquisite in cash. I received perquisite in kind. So, whatever the kind value is there, on that value, 10% TDS will be deducted. But there is no cash component. Now, let's say Lalita Jewelry owner, he was very impressed by my audit. I found 80 loopholes in the financial system of Lalita Jewelry. Now he got very much satisfied. He paid me 10 lakh rupees audit fees. Along with 10 lakh rupees audit fees, he gave me this bracelet. Okay, it's not true, fictitious, but example, he gave me this bracelet. Let's say the cost of this bracelet is 1,40,000 rupees. Now, like he gave bracelet, right? Now he cannot deduct TDS. He has two options. Option one, before he gives bracelet to me, 1,40,000 into 10%, he will ask me to deposit 10% TDS to government. So what I will do, I will pay 14,000 rupees to department. I will produce the challan to Lalita Jewelry. Then Lalita Jewelry will give me this bracelet. Are you able to understand? Second option, if he wants to pay TDS from his own pocket, then he need to do the gross up. He need to assume 1,40,000 is at 90% level. He need to do gross up. On gross up amount, TDS will be deducted. Are you able to understand? Next, there is one case law which is quite often asked in the examination. I am a YouTuber. Of course, I am doing videos in YouTube. Now, let's say iPhone 17 was launched. Apple approached me, yet like you are doing YouTube videos now, do one YouTube video on iPhone 17. I accepted. I did one video on iPhone 17. After video is over, I need to give back the iPhone 17. If I give back iPhone 17, no benefit is received by me, no perquisite is received by me. But after doing YouTube video, iPhone 17, I retained with me. That means I took with me. Apple said you only take iPhone 17. I took iPhone 17 and I retained with me. Now this iPhone 17, I am getting benefit from Apple now. So before it gives iPhone 17 to me, it is required to deduct it. Yes, are you able to understand? So very simple. Whoever the content creators or YouTubers are there, social media channel social media YouTubers are there. So if they do any video, after doing the video, if they retain the product, then TDS is required to be deducted under section 154R. If they give back the product, no TDS under section 4R. Are you able to understand? So this is all about TDS. One section is pending, 194Q. This I will explain with TCS section. So shall I start discussing TCS sections? Everybody? No TCS? 206C1 sale of certain goods. So you can see list of goods are there here. If these goods are sold, TCS is required to be collected. TCS is opposite to TDS. In case of TDS, payer will deduct TDS. In case of TCS, seller along with sale value, additionally he will collect TDS. You know GST na? Let's say I went to hotel, I ate food. Now I need to pay 1000 rupees. Along with that, additionally, I need to pay 5% GST. So what restaurant is doing? Restaurant is collecting 1000 rupees. Along with 1000 rupees, 5% GST will also be collected by restaurant. Am I correct or not? Same concept. Just like how GST is additionally collected, in the same way, seller along with the taxable value, additionally he will also collect. Yes, are you able to understand? So what are those goods? Alcoholic liquor for human consumption, tendu leaves, timber, scrap, minerals being iron, coal, lignite. Okay, coal, lignite, iron ore. So whenever these five goods are sold, what are they? Alcoholic liquor for human consumption, tendu leaves, timber, scrap, minerals. Not all minerals. Coal, lignite, iron ore. Whenever these five products are sold, the seller who is selling these five products, he will collect taxable value. Along with the taxable value, additionally he will also collect TCS. Sir, what is the rate of TCS? Alcoholic liquor for human consumption 1%, tendu leaves 5%, timber 2.5%, scrap 1%, minerals 1%. So this is the rate of TCS. Who will collect TCS? Seller will collect TCS. From whom TCS will be collected? TCS will be collected from buyer. Sir, when TCS will be collected? At the time of entry in books of accounts or at the time of receipt of amount, whichever is earlier. That means either on accrual basis or on cash basis, whichever is earlier, TCS will be collected. If buyer is a public sector company, central government, state government, embassy, high commission. See, if buyer is these persons, then no TCS will be collected. That means government is purchasing coal, government is purchasing lignite, then no TCS will be collected. Next, see, generally, what is the chain? There will be manufacturer or producer, then there will be wholesaler, then there will be distributor, then there will be retailer, then there will be ultimate. Am I correct? Now, whenever alcohol is sold by manufacturer to wholesaler, then TCS is required to be collected under section 206C1. Whenever it is sold by wholesaler to distributor, then also TCS will be collected under section 201. Whenever sold by distributor to retailer, then also TCS will be collected under section 1. Whenever sold by retailer to customer, then no TCS will be collected under section 206C1. That means what? This is applicable only from manufacturer to wholesaler, wholesaler to distributor, distributor to retailer. Whenever goods are ultimately sold by retailer to customer, no TCS will be collected. Is it clear? Next, see, seller will collect TCS na. Who is seller? Seller is the person in preceding financial year in business if turnover is more than 1 crore or in profession if gross receipts are more than 50 lakhs. Then only such seller is required to collect TCS. Every seller is not required to collect TCS. Okay. Next, 206C. Will explain 206C1C. Lease, license or contract of parking lot, toll plaza, minor query. Let's say there is a multiplex theater, mall is there. Okay, Orion Mall is there. In Orion Mall, basement parking is there. Na? So whenever parking lot is given on lease, along with lease value, additionally TCS is also required to be collected. So parking lot, mine, quarry. So if any of these are given on lease along with the taxable value, additionally TCS will be collected. Rate of TCS is 2%. See, my parking lot, toll plaza, mine or quarry. The transaction can be contract or the transaction can be lease, the transaction can be license. You name the transaction anyway. Whenever you give parking lot, toll plaza, mine or quarry, either on lease, contract or license, you will get amount, right? In addition to that amount, additionally, you are required to collect TCS at the rate of 2%. Who will collect TCS? Lessor or licensor or contractor. From whom TCS will be collected? From lessee or contractee or licensee, TCS will be collected. Are you able to understand? When TCS will be collected? At the time of entry in books of accounts or at the time of payment, whichever is here. Section 206C 1F. Whenever any motor vehicle is sold, on sale of motor vehicle, TCS is required to be collected under section 206C. But the value of motor vehicle should be more than 10 lakhs, then only TCS will be collected under section 206C1F. If value of motor vehicle is up to 10 lakh rupees, no TCS will be collected. Are you able to understand? What is the rate of TCS? 1%. Now, car is there. With regard to car, manufacturer will be there, distributor will be there, wholesaler will be there, retailer will be there, customer will be there. Manufacturer sells car to distributor, cars to distributor. On this, whether TCS is required to be collected? No, TCS is not required to be collected. Distributor sold cars to wholesaler. In this also, TCS is not required to be collected. Car is sold to retailer. Then also TCS is not required to be collected. But whenever cars are sold to ultimate customer, in that case, TCS will be collected under section 206C1F. Are you able to understand? Sir, the car purchased is sports car. Whether TCS is required to be collected, whether it is luxury car, normal car, whether it is having 4 wheels, whether it is having 5 wheels, 6 wheels, that is not the criteria. The only criteria is value of the car. If value of car is up to 10 lakhs, no TDS, no TCS. If value of car is more than 10 lakhs, TCS is required to be collected. Sir, consideration is not paid in cash. Consideration is paid in the form of non-monetary consideration. Then also TCS is required to be collected. Sir, consideration is not paid by way of bank. Consideration is paid in 5 rupee coins. Like you can see YouTube video, 16 lakhs Creta car was purchased with 5 rupee coins. Then also whether TCS is required to be collected? Yes, TCS is required to be collected. Able to understand? Next, text section 206C1G. Listen this very carefully because there is an amendment in Finance Act 2024. Section 206C. Whenever overseas tour program is booked, then the person who is booking overseas tour program, from him additional TCS will be collected. Sir, what do you mean by tour packages? You can see in Make My Trip, Agoda, or you can see in Clear Trip. In all these websites, if you want to go to foreign, you can book tour package like 4 nights, 5 days stay, 3 nights, 4 days stay. Like this tour package will be there. They only will book flight tickets. They only will book the hotel. They only will provide you the food. They only will arrange the tour operator. They only will arrange you the local cab. All this will be provided by tour operator. Only thing you need to do is you need to pay lump sum amount for tour operator. Are you able to understand? So whenever you book a tour package, then TCS will be collected under section 2061G. Who will collect TCS? Seller of overseas tour program will collect TCS. From whom TCS will be collected? From buyer. See, if buyer is non-resident, then no TCS will be collected. When TCS will be collected? At the time of entry in books of accounts or at the time of receipt of amount, whichever is earlier. Sir, what is the rate of TCS? If tour package cost is up to 7 lakh rupees, rate of TCS 5%. If tour package cost is more than 7 lakh rupees, rate of TCS is 20%. Are you able to understand? Remittance under LRS. LRS means what? Liberalized remittances. So, whenever you want to transfer money from India to outside India, your brother is studying outside India, you have to transfer amount from India to your brother. Now what you will do, you will go to foreign exchange dealer. You will give 10 lakhs. You will ask him to convert 10 lakhs to dollars and transfer those dollars to your brother located outside India. Foreign exchange dealer will convert and he will transfer. So whenever you are doing remittance outside India, whenever you are making payment outside India, then TCS will be collected under section 2061G. If the amount remitted is up to 7 lakh rupees, no TCS. If amount remitted is more than 7 lakh, then TCS will be collected. Are you able to understand? So, from whom TCS will be collected? TCS will be collected from authorized dealer, foreign exchange dealer. Sorry, who will collect TCS? Foreign exchange dealer will collect TCS. From whom TCS will be collected? TCS will be collected from remitter. Okay, the person who is making payment outside India, from that person TCS will be collected. Sir, what is the rate of TCS? For education or medical treatment, if any amount is sent outside India, rate of TCS is only 5%. Other than for education, other than for medical treatment, if you are making payment outside India, then rate of TCS is 20%. Here, if you take education loan, you are transferring education loan outside India, then in that case, rate of TCS is not 5%, rate of TCS is only 0.5. Are you able to understand? So generally, you are making payment outside India for education, for medical treatment, rate of TCS 5%. For other purposes, rate of TCS 20%. But if you take education loan, this education loan amount is remitted outside India, then concession, instead of 5% TCS, 0.5% TCS will be collected. Is it clear? Next, 206C1H, TDS under section 194. These two sections are interlinked. First, I will explain section 206C1H. There is seller, there is also buyer. In case of seller, in preceding financial year, turnover is more than 10 crore. Okay. Now, seller sold goods more than 1 crore. Sold goods more than 1 crore too. Now, above 1 crore, whatever the value of goods that are sold, on that excess of 1 crore, whatever the amount that is sold, on that TCS will be collected. Let's say taxable value is 180 lakhs. That means goods sold are more than 100 lakhs. Now TCS will be collected. What is the rate of TCS? 0.1%. If PAN is given, if PAN is not given, 1%. So on this TCS will be collected. Plus TCS at the rate of 0.1%. 0.1% don't apply on 180 lakhs. It should be applied on income above 1 crore. Okay, that means what? 180 lakh minus 100 lakh. That means on 80 lakhs, you will apply 0.1%. 80 lakhs into 0.1%. How much? 8,000 rupees. So how much will be collected? 180 lakh, 8,000 will be collected. Out of this, 180 lakhs will be recognized as sales. 8,000 will be considered as TCS payable to government. Are you able to understand? TCS payable to. If PAN is not given, then not 0.1% TCS at the rate of 1%. That means 80 lakhs into 1%, 80,000 will be. Okay. So 80,000, no PAN. If there is PAN, then 8,000 TCS will be collected. This is section 206. Quite opposite is 194Q. 194. There is seller, there is buyer. In case of buyer, in preceding financial year, turnover is more than. Now, buyer is buying goods more than 1 crore. Let's say buyer bought goods of 160 lakhs, taxable value 160 lakhs. Now, buyer is required to deduct TDS. Rate of TDS is 0.1% if PAN is given. If seller do not give PAN, 5% TDS will be deducted. Okay, careful, not 1%, 5%. TDS at the rate of 0.1% in excess of 1 crore. That means 160 lakh minus 100 lakh into 0.1%. That means 60 lakh into 0.1%. 6,000 TDS will be right, and balance 1 crore 59 lakh 94,000 will be paid to. This is when if PAN is given. If there is no PAN, then rate of TDS is 5%. 60 lakhs into 5%, 3 lakhs TDS will be deducted. If after reducing 3 lakhs, whatever 157 lakhs is there, that will be paid to. Are you able to understand? Next. Now you will get one doubt. Sir, in case of seller, in preceding financial year, turnover is more than 10 crores. In case of buyer also, in preceding financial year, turnover is more than 10 crores. Now, seller says he is required to collect TCS under section 206C1H. Buyer says he is required to deduct TDS under section 194Q. Yes, I am sorry, limit is not 1 crore, limit is only 50 lakhs, in excess of 50 lakhs. Limit is not 1 crore, limit is more than 50 lakhs. Okay, I am sorry, I am getting continuous calls from morning. I got deviated. So limit is not 1 CR, limit is 50 lakhs. Okay. So under section 194Q, under section 194Q, under section 206C1H, in these two cases, limit is 50 lakh rupees. That means if the amount of goods sold or if amount of goods purchased is more than 50 lakhs, then TCS provisions are applicable, TDS provisions are applicable. So under section 206C1H, if amount of goods sold are more than 50 lakh rupees, then if PAN is given 0.1%, if PAN is not given 1% TCS will be collected. The TCS is not on total amount. TCS will be collected on amount in excess of 50 lakh rupees. Are you able to understand? This is why, you should be there in live class. If I tell to camera, if I gets disturbed, type of mistakes will happen. Next, see, this is the scenario. Seller is there, buyer is there. There is coincidence. Seller is telling he is required to collect TCS under section 206C1H. Buyer is telling he is required to deduct TDS under section 194Q. In this case, Nirmalamma told whenever there is collusion between 206C1H and 194Q, in that case, 206C1H is not applicable, 194Q is applicable. Are you able to understand? This is the next. Last, we will discuss due dates. TDS due dates, TCS due dates. April to, sorry, yeah, April to February, whatever the TDS that is deducted is there, that is to be deposited to government on or before 7th of next month. On or before 7th of, whatever the TDS that is deducted in the month of March is there, that is to be deposited on or before 30th April of next finance. So April to February, TDS is to be deposited before 7th of next month. However, March month is closing month na, so many transactions will be there. So relaxation was given. You need not deposit before April 7. Time limit is given. Before April month ending, you should deposit that TDS amount. However, for TCS, there is no such rule. Okay, April to February, TDS is required to be whatever the TCS that is collected, that is to be deposited on or before 7th of next month. March month TCS is also required to be collected and it is also required to be deposited on or before 7th of, okay, same. Only for TDS that benefit is there. For March month, you can deposit up to 30th April. For remaining months, you should deposit before 7 of next month. For TCS, April to March, for every month TCS collected is required to be deposited before 7th of next. Return due dates. TDS return, TCS return is required to be filed on a quarterly basis. Okay, so TDS return, TCS return, Q1. Q1 means April to June. Na? Q1 return is required to be filed before 31st July. Okay, Q2, July to September. Q2 return is required to be filed before 31st October. Q3 return, October to December, is required to be filed before 31st December. Sorry, I'm sorry, Q3 is required to be filed on or before 31st January. Q4, Jan to March, return is required to be filed on or before 31st May of next financial year. So 2 months time is there for last month TDS return. TCS return due date is half. See, TDS return due date is 31st July for Q1. TCS return due date is 15th July. 31st October, 15th October. 31st January, 15th January. 31st March, 15th March of next. Sorry, 15th May of. So most of the TDS sections are covered. Miscellaneous concepts are there. Okay, if PAN is not given, higher rate of TDS will be deducted or higher rate of TCS will be deducted. Likewise, interest on late deduction of TDS. Those small concepts, please study on your own. Most of the part I covered in TDS TC. So that's it for now. Thank you very much.